May I request everyone to kindly be seated. Good morning. I'm Arup Chatterjee from the Finance Sector Group. A warm welcome to everyone present and those participating remotely. ADB is proud to host this special seminar on green investment banking schemes on the sidelines of the two-day conference on green financial systems and the role of MDBs and IFIs today and tomorrow in this venue. This special seminar is very important and timely, and we are delighted to have amongst us a high-quality audience of policymakers, regulators, supervisors, and other interested parties from ADB developing member countries and other parts of the world. The special session today will explore the role of green investment banks, the role they can play in scaling up investments in climate action and sustainable development goals, and how to establish them. I'm pleased to invite our Director General, Sustainable Development and Climate Change Department, Bruno Carrasco, for moderating this special seminar. Bruno Carrasco leads ADB-wide knowledge innovation policies and strategies in all thematic and sector operation areas of ADB and ensures compliance with environment and social safeguard policies. He oversees the administration of trust funds and global funding initiatives, as well as management on strategic and policy matters. So without further ado, let me hand over the proceedings to our Director General, Bruno Carrasco. Bruno, the floor is yours.
Very good. All right. Thank you very much for that introduction, Arup, and a very good morning to all of you. I'm delighted to join you on this special seminar on green investment banking scheme. I am very excited that we've been able to bring together a very impressive group of participants. So thank you very much for coming. We still do the hybrid, but it's nice to see increasingly faces coming together. Today's seminar, of course, will focus on unleashing the potential of green investment banks to transform the financial sector for, of course, financing green and just transitions to meet the climate targets and aspirations for a better environment and attaining sustainability. The seminar today, of course, will be aiming to provide a greater understanding of green investment banks, the important role that they have in the economy, their benefits, and, of course, some of the challenges. More specifically, we will aim to do three things. First, of course, learn about the feasible options that they represent for supporting the low carbon and resilient development in the financial system. Secondly, we will look at how we can identify key success and sustainability factors of green banks, looking at various greenback cases. And thirdly, and lastly, we would like to share insights for across the developing economies in Asia Pacific to see how we can build from these lessons and look at establishing more effective green banks, and particularly looking at their operations. So most of your countries, if not all, have, I'm sure, in development banks, and many of these development banks are in that transition towards green development banks. So we certainly would also like to hear from your own experiences. We have assembled in this seminar a group of outstanding experts, and we're very pleased at that, who will guide us and help us to uncover the potential of green banks financing, including the just transition. They will also, of course, share their experiences in their respective green banks, particularly in the United States and in the United Kingdom. These distinguished presenters will also be more than willing to answer any questions that you may have in terms of the challenges and opportunities that green banks may face. So this is really something that we will also like to hear your questions that you may have. I therefore encourage all of you to listen carefully and to please come in and raise any questions that you may have, and that will lead to a very interactive and productive seminar. So thank you very much for that. Now, I'd like to begin with Dr. Ulrich Volz, who's sitting to my left. Dr. Volz will give us a backgrounder on scaling up green investment banks and the limits to project-based mobilization of private capital through green investment banks. Professor Volz is Professor of Economics and Director of the Center for Sustainable Finance at SOAS, University of London. He has collaborated with us on many occasions. He has co-authored a number of papers with us. He's also a Senior Research Fellow at the German Institute of Development and Sustainability, a visiting professor at the London School of Economics and Political Science, and of course, Honorary Professor of Economics at the University of Leipzig. Over to you. Thank you.
Oh, good morning, everyone, and thanks a lot to ADB for having me. It's great to be back after a long pandemic break. So, yeah, I'll try to give a bit of an overview of what green investment banks are and what they can do. So, first, after a brief intro, I'll give you a bit of a background, and I don't think I need to say very much about the very urgent need to scale up green investment, but also the limits to current approaches, which are very much centered around project-based mobilization of private capital. And then I'll try to make the case for a much greater role of green investment banks. I'll talk about some key considerations regarding the establishment of green investment banks, or kind of transforming existing public development banks into green investment banks. And then I will specifically address the question, what can DFIs, MDBs like the ADB do to support a greater role of green investment banks in the global south? So that's my game plan. And let me first give you a definition of green investment banks. There are indeed a lot of definitions. I'll just give you the first one from the OECD. A GIB, or Green Investment Bank, is a publicly capitalized entity established specifically to facilitate private investment into domestic, low-carbon, climate-resilient infrastructure and other green sectors, such as water and waste management. And I think that captured it pretty nicely. So for the time being, the slides are not moving. So for the time being, we have actually only, well, 3 handfuls of green investment banks or green investment bank-like entities. Most of them are actually in the US at state level, and we'll hear from Connecticut Green Bank later on, and also we'll hear about the Green Investment Bank in the UK, which was actually privatized. So it's now part of a commercial financial group. So we have a couple of green investment banks, but not that many. And I will try to convince you that we need much more green investment banks and that they need to play a leading role in financing the low-carbon just transition. This clicker is it's clicking too well. So we have this huge financing gap, and I will argue that green investment banks ought to play an important role in filling that. And I'll try to convince you that green investment banks can actually be a very cost-effective way of achieving this financing, and the ADB, I think, can play a very important role in the Asia-Pacific region in helping the establishment of new GIBs and also established financial institutions to transform themselves into green investment banks. So a bit of background. You're all very familiar with the various numbers circulating regarding the need for greater investment, of course, in clean energy, but all kinds of other critical infrastructure on the adaptation and mitigation side. And of course, there's the whole SDG financing agenda. And the problem is that for the time being, we haven't been very good at mobilizing private capital. We all know that there's a scarcity of public funds, and of course, the MDBs have set out to mobilize trillions, but this billions to trillions agenda, I think, if we're honest, has failed. So this project-based approach, project-based de-risking approach of blended finance, even though we have some very nice examples, at scale it has not been successful. And here I have my favorite quote from Charles Kenny from the Center for Global Development, who a little bit provocatively said, "The idea that you can use a little bit of public money to bring to life a vast array of private investment projects in infrastructure and services isn't just fiction, it's utter fantasy." And I have not come across many people who actually disagree with that. And so we need to mobilize private capital, but we need to do it in a much better way. And sorry, I'm having a bit of problem with this clicker. Okay. Sorry. But the good news is that we actually do have a very well tried and tested approach to mobilizing private capital, and that is through public development banks. So the MDBs, for example, have used relatively small amounts of paid-in capital to mobilize large amounts of private capital. And there is a huge demand for safe assets, which public development banks or multilateral development banks can offer. And so they have a 1-to-9 leverage ratio on their paid-in capital. And so there is now, of course, a very important debate about the capital adequacy framework reform at the World Bank and at MDBs. And so there's a lot of discussion how MDB balance sheets can be used better, and that's a very important one. But we also should be looking at the role that national development banks can play in mobilizing private capital, and how DFIs and MDBs can help them in doing so. And so I'm going to argue very strongly that GIBs actually can be key vehicles to mobilize private capital, because also the private capital domestically. So if you look at developing Asia as a whole, even excluding China, the region is actually a net capital exporter, which is not what we want to see. We need much more domestic savings being mobilized domestically for investment in local infrastructure and so on. And what is lacking are proper vehicles to make that happen. And green investment banks, or public investment banks more generally, can be key vehicles to achieve that. And so there are, in principle, two options. One is work with existing national development banks, increase their capital, make them fit for that job, also give them a mandate for green investment, or the other option is establish new green investment banks. And I'll talk a bit about the trade-offs later on. The important point is that institutions like the ADB can support both approaches with existing instruments, but also, of course, there should be a discussion on what new instruments may be created at institutions like the ADB to help a greater role of GIBs. So, the case for green investment banks. First of all, it's important to highlight the limitations of private finance. And when I highlight this, I don't want to say that we need to get rid of private finance, absolutely not. So we need commercial private financial institutions, but we also need to complement them because there are important limitations, especially in the developing world. One is there is a lack of long-term credit, which is a big problem when you want to finance structural transformations such as the low-carbon transition. There is also a scarcity of private finance, private bank lending to smaller and newer innovative companies. And importantly, commercial banks also tend to be very hesitant to fund activities with uncertain returns and positive externalities. And a lot of the stuff that we need to get financed very urgently has huge external positive externalities, which from a private commercial perspective don't matter, but they matter greatly to our societies, and we need financial institutions who will finance them. So these are the limitations, and these are, of course, then also supporting the case for public development banks. And there's a long list of reasons why they can do a lot of good. They can provide counter-cyclical finance. They can provide finance for structural transformations. In particular, they can foster real innovation and entrepreneurship. They can provide patient long-term capital. And they can fund new sectors which often face high uncertainties. And very critically important, they can showcase the viability of different types of green investments. And given their broader public mandate, they can also help improve infrastructure for information, data. They can help develop skills needed for financing green investments, and they can also help deepen local capital markets. And last but not least, also, they can help put a greater focus on financial inclusion. So they can, in many ways, contribute to the financing of local, regional, and global public goods, and that's what we need a lot of. I'd like to highlight that already public development banks are playing a critical role at the multilateral, kind of global level, regional level, and national level. We have 522 public development banks at the moment, but only a few of them, so less than 20, actually do have a very explicit green mandate. But they finance around 10% of global investment, so they are really important financial actors. And I will argue that we need them to become key financiers of the green transition. And if we look at their current lending profile, we can actually see that a lot of the financing that they provide is long-term financing, which is exactly what we need, but we need more of that with a green focus. And this is why we should be having public development banks with a specific green mandate, with a very strong expertise in financing green projects, and they can add a lot of value. They can help overcome investment barriers, so they can really develop targeted approaches to financing green investments. They can address a shortage of information on, for example, climate risk. They can work with market participants the same way that regular public development banks do. They can help build local expertise in low-carbon technologies, projects and investment. And again, super critical, they can demonstrate the profitability of low-carbon investment to accelerate the market development, and also, in the next step, bring commercial financial institutions into the game. And last but not least, just like the ADBs doing, a lot of national development banks are working closely with governments in developing policy frameworks, and that again is where green investment banks can add a lot of value. So let me now highlight a few key considerations in the development of green investment banks. Like all financial institutions, obviously, green investment banks can work better if the broader macro framework is stable, if there is a functioning financial sector. Very importantly, for financing green investments, you need a clear development strategy, for example, regarding climate policies and goals, and this will facilitate the work of green investment banks. And for green investment banks themselves, it's absolutely critical that they have a very clear mandate, a mandate with a public purpose for investing just transitions, focusing on adaptation, mitigation. You know, you can add different foci, but really this public purpose perspective is critical. So it should not be just focused on returns, because for that we have commercial financial institutions. And there is a discussion to be had regarding the greening of existing public development banks versus the creation of new institutions. And I would say that it depends very much on the context. So as Bruno mentioned before, most countries have already public development banks, and it may be easier to work with existing development banks and kind of equip them with an updated green mandate, build capacities and so on. So if that is a viable option, then there are good reasons to go for that. But there may be also very good reasons why countries want to establish a new dedicated green investment bank. So one thing that's of course absolutely critical is that green or not, any public development bank should be well governed. It should be well managed. And here we have a bit of a checkered history, as you all know. We have examples of very well functioning public development banks, and we also have, and often in the same, or sometimes in the same countries, also examples of badly governed public development banks. So if you have a well-governed public development bank with a strong track record and so on, this may be a starting point. But obviously, if you have a failing institution, you don't want to add a green mandate and then hope that everything will be working well. So in some cases, it will be better to create a new green investment bank, because it also depends not only on the quality of governance, but also on the conviction of existing institutions, whether they're ready to have this transformation. Some public development banks have a very strong mandate already for certain types of financing, for example, SME financing, and it may be very difficult to transform an institution that has a focus on SME financing into an institution that would focus on infrastructure financing. Yeah? So you'll have to see. Of course, critical at the end of the day is that you build up a stock of high qualified staff. So whether you reform an existing institution or set up a new one depends on the specific context. There are good reasons for both. Well, the clicker doesn't like me. Okay, now it likes me too much. Okay, well. Sorry. I hope I get extra time for that. Okay. If we're talking about setting up a new GIB, of course, we need to capitalize it. And there are different ways of doing that. You can finance that through first of all, you can have different processes. I mean, government executive action. In some countries, you need to involve parliament and so on. But the key question is really how to capitalize the bank. And kind of straightforward way would be to use government finances. In some cases, public development banks have been capitalized by the central bank. So there are different ways. Government appropriations, utility bill charges that could be then used, carbon tax revenues, and so on. But also, and that's something I will talk about later on, you could use international resources from MDBs, DFIs, global funds to capitalize the GIB. And I think this is where we need to have much more of a discussion. One can also bring in private capital. And there are also even discussions at the World Bank level, kind of have non-voting shares and so on. But what's absolutely critical is that the institution, a new institution, has to have a great degree of accountability, independence, and public transparency. And as I mentioned before, it's absolutely vital to get the mandate right. Yeah? So the mandate should be guided by a public purpose that is anchored to green and just transitions. So getting the mandate right is absolutely vital. I need to speed up a little bit. There are different types of interventions green investment banks can make. They can directly finance infrastructure projects and so on. They can also provide risk mitigating enhancements. I mean, pretty much like any public development bank. Also, there are different ways. They can provide loans, equity, mezzanine capital, investment funds, bonds, structured notes, grants, and so on. It's all pretty straightforward. But let me get to one issue that is really important, especially for institutions like the ADB. How can DFI support green investment banks in the global south? And here there are, in principle, two ways. The first one is through technical assistance and capacity building. So building a green investment bank will require a lot of expertise. You need a lot of well-qualified people who can drive the operations forward. And just like with public development banks, institutions like the ADB can provide technical support in developing strong governance structures, building sustainable finance expertise. And so this is important for existing public development banks that want to transform into GIBs, but also this is important for institutions that are developed from scratch. So that is one important aspect. And of course, there can be also support to governments in kind of helping to set up mandates and so on. But then the second important area relates to the financing. And here it's important that green investment banks will develop a strong standing in capital markets, also that they will have a strong credit rating, because they need to raise capital at low rates so that they can finance at cheap rates. This is absolutely vital. And oops. Sorry. Okay. So, and the cost of capital problem is really a critical one. So we know that investment in green infrastructure requires a lot of high upfront cost. And of course, if you have high cost of capital, it's going to be much more difficult. And here you can see the cost of capital for a solar PV project in 2021 on the left-hand side for advanced economies in China, where interest rates were around 4%. and then for emerging developing economies where they were around 12%. Now, it makes a huge difference whether you want to finance a project with 4% or 12% cost of capital. Green investment banks, to really play the catalytic role they should play in financing low-carbon, climate-resilient infrastructure, they really need to have the right level of funding cost. And so the problem here is that the refinancing conditions of any public development bank, including green investment banks, are basically tied to the credit rating of the sovereign. Yeah? So there is a kind of sovereign ceiling effect. And that is a big problem, because if the sovereign has a high cost of capital, the public development bank has a high cost of capital, and then it's going to be very difficult to really get the financing going. And here, public multilateral development banks, DFIs, can play in, can come in and play a really important role. In particular, DFIs could provide paid-in or callable capital to capitalize green investment banks. So this could help to improve the standing in capital markets and enable these green investment banks to issue bonds at lower rates than without this international support. Of course, having, and that's my timer, but I'll be done soon. Having, of course, an involvement of MDBs, DFIs in these institutions would also help from a governance perspective. It would be reassuring that these institutions are well run. So providing capital is one way. Another way is to provide some kind of a guarantee on bonds that green investment banks would issue. So that would not change the credit rating, but it would, or the bond issuances would benefit from the triple rating of the guarantor. And then a third option, which I would say is inferior, is that a DFI could themselves issue bonds and raise capital at low rates because they have AAA rating, and then pass that on to Green Investment Bank. But the problem here is that you won't have the leverage effect that the National Investment Bank could have otherwise. So having some kind of credit enhancement for the Green Investment Bank, or even some kind of capital provision would be ideal. Is it moving? Yes. So this is my last slide. So, so my key message here is that green investment banks, even so either transformed ones or kind of entirely new ones, can really play a critical role in scaling up green investment in the region and, of course, elsewhere as well. They can leverage private funds and maximize total investment by partnering private resources. So they can, by issuing bonds, they can attract domestic savings and really scale up investment. They can play a really important role in showcasing the viability of innovative green investments that can be later followed up by private financial institutions. And they can also play an important role in mainstreaming ESG considerations across the financial sector. And so it's great that the ADB is having this discussion about how to support green investment banks, and it's a great pleasure to discuss this with you now. Thank you.
Thank you very much, Ulrich, for a fantastic presentation to kickstart this event. We've heard the importance, or he's presented the importance of long-term financing, looking at the importance of bringing in greater externalities, particularly when we're looking at climate, recognizing the importance of counter-cyclical support, as we saw during the pandemic. Important considerations he highlighted on the quality of governance, essential, and of course making sure that these banks have very strong balance sheets. We are a AAA rated institution, and through that we're able to pass on the lower cost of funding to our member countries. So with that, thank you very much. Now we will turn to our second speaker, who is my great colleague, Jung-Kyu Lee, who is the Chief Financial Sector and who has been leading a lot of the work on financing across ADB. Jung-Kyu is going to be making a presentation on some of the key considerations on ADB's climate finance investments. So over to you, Jung-Kyu. Thank you.
Thank you very much, Bruno, and also the kind introduction. Actually, the photo here, as you see, is a 10 years ago face. He looks like a pretty young. But you know, as we had a discussion yesterday at our dinner, welcome dinner, and the word we share is, you know, I actually raised that what was the famous, one of the famous word from the movie title and Wizard of it's Wizard of what? Wizard of Oz, right? Okay, and then the Alice said, "We're not in Kansas anymore, right?" So, but we feel that right now we are not really Kansas anymore, and the impact of the climate change is really real. Like 10 years ago, 20 years ago, when I was a kid, when we feel that, when we recognize that, the impact is very different. And so that is a kind of, you know, I think it is a beginning in our the presentation. And I don't know whether okay, here, and over my screen, it does not come over, so I kind of keep on looking back. Actually, here we, you know, it looks like a little, very interesting title because he opened the stage, Professor Waltz, and opened the stage for the importance of the GIBs and working together with the GIBs and conditions for the GIBs and also the public GIBs and private GIBs and existing GIBs and also the creating GIBs. And here, we're trying to look for, because we are ADB, we really want to look for the link between these GIBs concept and ADB. So why we need to work together and what can we work together and then how we can work together. So I think it is one of the good way we can consider together if the GIBs is concept with the business models is there and ADB is here and ADB's modality, ADB's commitment, ADB's modality and ADB's product, how we can link together. Maybe it's a good the food for discussion also today. And then the interesting what I am telling you is the why we are thinking about this option GIB suddenly. Why ADB, like one of the MDBs, and some people said it's a development rock star in Asia and the Pacific, and why we need to think about this. And then what is prepared and what has been done so far. So why and what, and then we'll talk about that how part, how we can work together. So we discussed that issues, challenges, you know, some of the lessons. Definitely these discussions will be more realized, will be supported, evidenced by the next following two presentations and also the comments. As you know, we have the one case for Connecticut Bank, the other actual case of the UK, the GIB, and two different models. It's a little bit of different. Starting point was very similar, but current status is very different. So these are the whole flows in today. And then the ADB's positioning. This is really the why part. Why? And like I said, we're not in Kansas anymore. The impact on the economic development and the people in Asia Pacific is really large, huge, and we don't need to go back. And we say climate change is real. We don't have a different, you know, the points or argument about that. Climate change is real. Impact is getting bigger and huge. How we can handle. As a development bank, it is very natural response. ADB announced as a climate bank in Asia to deal with this large damage on the development in Asia and the Pacific. So we announced in 2018, 80 billion climate target. And then recently, we also, again, the raise, not the target, but ambition. Over this 2019 and 2030, climate finance ambitions to 100 billion. So 80 billion target and 100 billion. We have really have been committed to resolving this issue, because we know that the climate change is real, damaging is huge. And then the next one is beginning from this why, and giving us a rationale to think about the options, think about the approaches, think about the programs or actions. And then we look back and what ADB's current strategies, what ADB has been doing so far. So ADB has been successfully setting up our strategy 2030 and also strategic operational approaches to deal with this climate change. So for example, ADB is scaling up support in these three major areas. One is tackling climate change. The second one is building climate and disaster resilience. And climate change definitely impacted the disaster. So the disaster resilience is also a very important area. And then the enhancing environmental sustainability. This is also the very important, the sustainability side. And then to these, helping this scaling up, support in these three major areas, we actually put in place these 5 actions to support DMCs from the beginning of the supporting institutional development and framework. This is really the beginning things. And without strengthening, supporting institutional development framework, going to other stages, and the impact and also the handling, the following, the actions, outcomes, we believe that it is not going to be really maximized there. So we want to begin the strengthening these institutional development, the frameworks, and moving towards a strengthening partnership network. So that is also the one of the area, and ADB is keen to work together with our local partners and the DMC partners in national and the sub-regional level. And then the what part, we have 3 things actually, and what we have been doing, this is a sort of common point and we can think about how we work together. First one is a policy-based loan, second one is a financial intermediate loan, third one is a sector loan. And I don't need to get into this, detailed stuff and what does that mean, policy-based loan and financial intermediate loans. And I assume that, and most of you already familiar with this one. So these are the sort of things what we have been doing so far. And then we are thinking how we can work together with these GIBs, Green Investment Banks, or the local or national or the regional financial institutions are really towards supporting seriously making the economy towards a net zero. And the next one is another, so based on this ADB's modality, I just want to share the examples, specific examples. So this is some of the area we're thinking and working together with the GIBs or financial institutions who are working very hard towards a net zero. And in that case, for example, the 2022 and the climate change PBL was approved. And this climate change PBL is basically to deliver its nationally determined contributions and also to transform vulnerable sectors and toward the climate resilient and low carbon economy. So this PBL plays a key role and to help the DMCs and deliver its own NDCs and nationally determined contributions, also transform their all vulnerable sectors to strengthen and deal with this climate change. And it also includes definitely the policy reforms. That's a condition. And then next one is another, we think together, how we can work together is the financial intermediate loans, one of our strong interests. This financial intermediate loans basically MDB lending through financial intermediate loans. And then this actually can play a various role, including the catalyzing, scaling up, and also accelerating this net zero, all these transitions. We actually have been doing, and ADB has been doing these financial intermediate loans, and I think probably the DG Bruno also has been one of the best person to tell about it, and also we have super senior director, and Christine is also here and is probably talking about the importance of this financial intermediate loans. And then the examples, and we want to share, for example, the last year we approved SDG Indonesia, one green finance facility. So this is kind of function of NDB, it's a function of GIBs and its facility. So ADB lend the money and the government lend the money to this specific facility. This is a state-owned infrastructure financing institution. So these are the sort of the structure and how we work together with this the financial intermediate loans is one of the consideration we probably work together with the GIBs or financial institutions at the national level and the regional level, very serious about the net zero. And another example is the rooftop solar power generation projects in Sri Lanka. This is also ADB provider funding, and then it is to establish a lending facility. So this to support the rooftop solar financing. And when you look at it, I underlined that. It began from 2017. By the end of 2019, 2,081 sub-projects have been approved, amounting to 23.5 megawatts at that level. It's national level and the local level. This is really amazing collaboration platform, we believe so. And then the how part. How part is based on this why climate change is real, and then what we have been doing so far. This how part is very interesting part. And actually, whether we want to help or work together with existing institutions, or we want to help create the new institutions, it really depends on the local context. And there is no one size fits all. So important thing is that how we work together very closely. ADB is willing to work together, how we work together, what kind of assistance we provide, including lendings and equities and equity investment, also technical assistance and all other setting up from the beginning of the journey of the setting up and strengthening the framework and to the external collaboration. I think these are the part of that. But one thing I'd like to share with you, almost time is up, and these issues, how we work together, and especially for whether these GIBs, MDBs, ADBs can help GIB leverage public funds, how much we can leverage. And also how much we can help GIBs can showcase the financial viability of this old project. Or how we can help transform the financial sector and also localizing SDGs, because the green investment banks are working together with the local community. They know households, they know MSMEs and SMEs in the local community. So it is really win-win solutions if we set up some sort of collaboration platform, closely work together, and through our ADBs modalities, we just mentioned the PBLs and FIRs and sector development loans. So here, I think we are pretty much sure, and based on these two the presentations, and next stage, and we will learn very specific cases and the products, and from this the U.S. case, Connecticut Bank case, and also the U.K. The GIBs. And so I think I would stop, and then they give the podium to our chairs. Thank you.
Thank you very much, Jung Kyu, for that presentation, the why, what, and the hows of how we position ourselves as a climate bank for the region, focusing a little bit on some of the instruments, PBLs, FILs, and bringing some brief examples of how we work in two particular countries, Indonesia and Sri Lanka. So thank you very much for that. Next, we will turn to our discussant, who is none other than Mr. Pavit Ramachandran. He will be joining us virtually. Pavit is currently the country director for the Mongolia resident mission and is now country director designate for the Philippine country office. So without further ado, Pavit, over to you. Thank you.
Good afternoon to everyone. Very pleased to be here. Let me first commend the two presenters, Dr. Ulrich and Jung Kyu, my good friend, for their insightful presentations. I think certainly from Dr. Ulrich, there was a compelling case made for the establishment of green investment banks in what is now the emerging ecosystem around green finance to address some of the constraints we know about fiscal space, constrained budgets, even looking ahead into the near future, to unleash entrepreneurship, to catalyze and scale up private capital, and to demonstrate the viability of green projects more generally. Let me share my own thoughts on how ADB can support DMCs in promoting green and sustainable development. And more particularly, I'd like to share some experiences from Mongolia with you, from my vantage point here as country director in the office here with ADB. Needless to say, and I think both presenters made a strong case for establishing that the stakes are really high in the global climate fight. This will be won or lost in the Asia-Pacific region, the region that's most impacted by climate change, and is also the world's largest contributor of greenhouse gas emissions as it stands. Asia Pacific also experiences more weather-related disasters than any other region in the world. And we have seen these impacts, unfortunately, are growing. We saw record-breaking flooding in Pakistan and Bangladesh recently, affecting millions of people. India experienced its hottest ever recorded temperatures just a couple of months back in March, and last year as well. And Typhoon Rai, more closer to home in the Philippines, caused more damage to households, over 1.5 million households, than any other typhoon in recent decades. Such trends are unfortunately expected to continue. As Junkyu very persuasively presented, ADB has committed itself to become the region's climate bank. And we've set ourselves a climate ambition of 100 billion cumulative climate finance, and dedicating up to 75% of our operations to supporting climate action by 2030. We've also committed to align our operations with the Paris Agreement, with both our sovereign operations and non-sovereign operations reaching 100% by 1st July 2023 and 1st July 2025, respectively. Some of ADB's green initiatives include the green and blue bond programs, which are designed to assist in DMC's transition to their net zero transition and to low carbon and climate resilient growth. We also have the ASEAN Catalytic Green Finance Facility, which is an infrastructure fund initiative that promotes environmental sustainability. I think the point that was made by Dr. Ulrich, that GIBs in the region could be an option to further achieve our ambitious but necessary target of climate finance, I think the case was well made, leveraging both public funds and private resources, promoting innovative green investments, and mainstreaming ESG principles more generally. At the same time, I feel it will be important that this really is a whole financial sector, whole of government approach, and including commercial banks, where we see the adoption and embracing of green principles and capacity building more generally towards that objective. I agree with the points raised by both presenters on the necessary requirement of well-functioning public development banks or national development banks, and their potential or possible focus on green investment. In particular, a focused mandate, independence, and accountability will be crucial, while ensuring cost effectiveness and additionality will need to be assured. To this end, I must stress that good governance, and this was a point that Dr. Ulrich made, will be of crucial importance. Without this, I think this has to underpin any such transition towards a green investment bank. Let me just give you the example in Mongolia. The Development Bank of Mongolia, a state-owned enterprise focused on promoting export-oriented SMEs and long-term infrastructure development, has had significant governance issues. And the immediate priority from the government side is to clean up the balance sheet, recover non-performing loans, while reforming corporate governance, legal and regulatory environment, and associated business plans and practices in the medium term. Once such corporate governance has been improved and a restructuring plan is prepared, DBM can then, or the Development Bank of Mongolia, can possibly then start focusing its mandate on promoting green investments in Mongolia. However, this transition will take time and will need full commitment from the authorities and comprehensive planning. So, I mean, this goes back to the point that Ulrich was making about context being everything. So, I mean, I think the Mongolia example just is a case in point in that regard. But we do have a viable alternative. The Mongolian Green Finance Corporation, or MGFC, could be an alternative that could work in the near term. The government would need to complete the process of making equity investments into MGFC, which has already been capitalized by the Green Climate Fund through both equity and grant investments and local commercial banks. The intention is for this to serve as a joint public-private finance national vehicle to overcome some of the constraints around climate change mitigation and focus investments towards green, affordable, and gender-inclusive financing for households and energy efficient technology through wholesale finance. So just to end, let me just say that ADB can support green and sustainable development in our DMCs in many ways, some of which we heard from Junkyu. But let me stress 3 points here. First, capacity building will be needed on green finance more generally, green taxonomies, green project identification, tagging, and monitoring. Our technical assistance support can help DMCs build up capacity in these regards. This will be important to actually build a robust pipeline of green projects looking ahead. Second, policy-based loans can be utilized to leverage crucial reforms over the medium term and to promote necessary policy actions. Junkyu mentioned the PBL in the Philippines, the first of its kind focused on climate change. Mongolia is now preparing for a climate PBL next year. We also have another modality, the multi-tranche financing facility. I think, Junkyu, you didn't mention that in your list, but the idea here is to look at long-term programmatic approaches to support a roadmap towards development, and this can also catalyze private sector financing towards climate change transition. And the third, the FILs are a viable option. In Mongolia, we have made good experience with supporting the Credit Guarantee Fund, a state-owned enterprise, through an FIL modality. This is the financial intermediation loans. And the ongoing project has been able to alleviate SME financing constraints by backing credit guarantees since 2015, more or less. And finally, in conclusion, I want to emphasize the importance of leveraging technological advances for mobilizing green finance. It's important to harness innovative fintech solutions, and we're seeing this across the region for leveraging and further mainstreaming green investment. This can relate to exploring innovative financing instruments like crowdfunding platforms, digital and thematic bonds using mobile banking platforms, or the tokenization of debt. We saw the first tokenization of a green bond in Singapore recently, and also through equity and green instruments. So thank you again, and wish you all a productive discussion.
Thank you so much, Pavit. He has highlighted the importance of the whole of government, whole of economy approach. He generally agrees on the points raised by the two presenters on GIBs, highlighting the importance of independence and accountability, and making sure that the GIB is working in a manner that is cost effective and is creating value. He highlighted a couple of cases in Mongolia where that didn't happen, one in the case of Development Bank of Mongolia, and then another change that is happening in terms of helping to strengthen that institution. And finally, on the Mongolia Green Finance Corporation and opportunities there. In addition to the points that Junkyu had highlighted on the various instruments that ADB has at its disposal, he brought out more strongly the importance of TAs on capacity building, helping many of the DMCs to make that transformation, and on the importance of fintech and bringing in innovation. With that, let us now turn to the session on questions and answers. We've got about 5-10 minutes for that. I would like for any of you who have any questions to please raise your hands, introduce yourselves, and indicate who the question is addressed to. Keep your questions or comments to the point, please, so that we can get more of you involved. And so let's open it now. I think we also may have questions from our participants coming in virtually. But let's see if any of you would like to start. Over to you. Who wants to break the ice? Looking if those in the virtual world are a little bit more willing to come in, but I don't see any questions either. Yeah. Just give it a couple minutes. Yes, thank you very much. Over to you, please. Okay, that's one question. We have a second question. that is appearing. What would be the role of ADB to support non-bank financial institutions, NBFIs, such as insurance, catastrophe insurance, microfinance institutions, fintech, to accelerate development of green and transition financing? And that's from Eddie. So with those two questions, maybe we can start. So I think the first question is to you, Pavit. Maybe any thoughts on tokenization?
Yeah, I mean, I think we have the example, Bruno, as I just mentioned, of the first tokenization of a green bond in Singapore. I think we've got to start thinking more generally about how we can build on this ecosystem that exists outside of ADB. I think the conventional way of looking at green finance, where we were thinking of developed countries, developing countries, and MDBs. I think there's also a role for some of our non-borrowing countries in the ecosystem, whether it be Hong Kong or Singapore, and trying to harness some of this innovation that's happening with fintech, with the issuance of green and themed bonds, and seeing how that experience can then be brought to our DMCs more generally. Yeah.
Thank you very much, Pavit, for that. Maybe Junkyu, would you like to take the question on the role of ADB to support NBFIs?
Okay. All right. So I think it is very important reminder, not only the banking sector, and also the contribution of the non-banking financial sector, especially insurance side. And it looks like our insurance colleagues and probably ask these questions. And then because there's a parenthesis about the catastrophe insurance and also the microfinance institutions in the fintech. All of those are, ADB has a very specific framework, like financial inclusion, how we can utilize, how we can support the financial inclusion, and also how we can support the insurance market development, especially because of the role of insurance in terms of risk transferring, risk sharing, focus on those catastrophe side and under the disaster risk financing framework. And we have the disaster risk management and also disaster risk finance framework. So currently we are really pushing for that raising this insurance standing and especially contributing those insurance in the more and more for this disaster risk financing and the climate change with their the risk transfer and the risk sharing role. And we are currently thinking and many instruments and but those insurance instruments, like from the public to the private, and in between the public and the private, and so like beginning from the contingent disaster risk facility, and actually years ago the ADB actually processed a very big program and helped the Philippine government and with this contingent disaster at the facility, and over this all options like 6 or 7 options, and we can, depending on the country context, and we can help the insurance grow and to play more with that, the public contribution or hybrid contribution, or in growing the own contribution of the private insurance. And also the fintech, ADB has been second to none in terms of using this fintech innovative technology, especially to help out the specifically targeted underserved and the unserved and the segment of the population, like women and also micro business and with this fintech technology. And so we have a very specific cases and like operations, and we have been successful. So from the beginning and to the now and during the last couple of years, and we have been putting framework, and also we have been putting our programs and the projects to increase the insurance and the microfinances contribution as of the fintech. But now we need to put a lot of effort to enhance the role of insurance, especially for this disaster financing area.
Thank you very much for those points. I think Ulrich may want to also come in. Thank you.
Yeah, thank you very much. Thanks, Pavit, for very good comments, and in particular for highlighting the need for a all-of-government approach. And indeed, kind of the topic of green investment banks is just one specific topic in a broader universe. And we need a really ambitious approach involving the government, central bank, financial supervisory authorities, and also other public actors to really set a broader governance framework for scaling up sustainable finance and investment. And I think the points that Pak Idi from OJK, who's actually a close friend, raises are very important. And I think that, for example, we need to put a lot of effort into setting up the infrastructure for really scaling up digital finance solutions. Actually, last year for the Indonesian G20 presidency, I wrote a paper on various ways how digital finance can be used. And I think, especially with disaster risk finance insurance, there are a lot of opportunities, but also the example that Pavit mentioned with the tokenization of bonds is a good idea. So the specific example of Singapore, where the Monetary Authority of Singapore, on behalf of the Singaporean government, issued green infrastructure bonds that people could purchase through online banking, at the ATM, or through mobile banking, is a good example that's actually building on something that the Kenyan Central Bank did previously, not specifically regarding green bonds, but I think we need a lot of different approaches. But I would say that green investment banks could play a really, really important role in all that, because they can do things that commercial actors cannot do, and so in that way very much complement the existing landscape. Thank you.
Thank you very much. So with that, I think we can thank Ulrich, Junkyu, and Pavit for the presentation and discussions. Thank you also for listening in. I think what we'll have to do is, in the interest of time, we will keep that, and we will hopefully be able to get back to you either on email or on the sidelines. I would like now for us to move to the second presentations. So I guess if you want to stay, please do so. We've got the presenter coming in virtually. So under the second presentation, we're going to learn about the potential for green investment banks based on the experiences of GIBs in the US and in the United Kingdom. So to start off, we have with us Dr. Hunter, Chief Investment Officer of the Connecticut Green Bank since 2012. He has led a team that develops innovative financing programs that have deployed $2.2 billion in public and private investment in energy efficiency and renewable energy using approximately $300 million of public resources. I would now like to hand over the floor to Mr. Hunter. Thank you.
Okay, thank you. Thank you very much. Can you hear me?
We can hear you loud and clear. Thank you.
Okay, great. I know it says that my connection is unstable. So can you still hear me?
Yes, we can. Please proceed.
Okay. All right, great. But then it's not showing the slides, but I have a copy of the slides here, so I'll be able to proceed with the presentation. But thank you for the kind introduction. I'm delighted to be part of this event, even if it's only virtually, for this very important discussion about green investment banks, how they can be very useful tools to scale and accelerate investment to help us meet our goals to combat climate change. This is actually my second time working with ADB on this important topic. Just before COVID in 2019, I visited Manila and participated in a forum around energy efficiency for local government units. So I'm very glad to be with you again, even though, again, remotely. So we've heard from Professor Vols about what are GIBs, about the limits of private capital in making certain climate investments that we need to finance, and also how DFIs and MDBs show how public institutions can leverage in many multiples in private capital for development projects. Dr. Lee explained ADB's strategic operational approaches and financial modalities of ADB and in this regard. And Dr. Vols then explain how GIBs can, as specialized financial institutions, can work with market participants to overcome investment barriers to mobilize private capital for climate finance and investment. So what I will do now is to continue this conversation is to give you a real live look at a green bank at ground level, and hopefully bring to life some of the points made by the two presenters before me. So if you could advance the slide to the one with the sun rays on the, I think it's the second slide there. This is the Green Bank of Connecticut. It has been around for about 12 years. We were established in 2011, and I joined about a year in from that to start some of the initial investment programs. Why we exist is at the lower part of that slide, which talks about increasing and accelerating investment in our economy to help meet our climate goals, develop a more resilient, healthier, and equitable communities. Equity is very important, meaning that all participants in the economy, residents, homeowners, businesses, nonprofits, governments, should all participate and benefit from this transition that we are undergoing and play their appropriate role. And at a high level, what we do is, as a quasi-public entity, we use our limited public dollars, as Professor Voles was discussing, to leverage in multiples of private capital. And guiding us is this vision that we are a planet protected by the love of humanity. And what that means is we have to protect and make more sustainable the only home that we all have. And this is what drives us at the Green Bank each and every day in terms of our work on to deal with climate change. Next slide, please. These are some of the goals that we have here in terms of equity and dealing with vulnerable communities. We talk about vulnerable communities as those least able to do things on their own and need more assistance, as well as reaching a broad cross-section of our society. And we have a target that no less than 40% of investment in climate that we manage will go to these vulnerable communities in low-income areas. The Connecticut has greenhouse gas emission reduction goals of 45% below 2001 levels by 2030, which is consistent with the US goal of 50% below 2005 levels by 2030. And we also have a desire to be 40% of energy from renewable resources by 2030, and 100% zero emission buses in many of our communities by 2030, and completely across the state by 2035. So the takeaway from this is that all of these goals will require substantial amounts of capital, mostly from the private sector, but encouraged by good public policy and stimulated by government incentives and public investment. And that's where the role of green banks come in. Next slide, please. This is just showing about us. We are a quasi-public organization. Our focus, as you know, is on renewable energy and clean energy resources, as well as environmental infrastructure. Our support, as was mentioned by Professor Voles earlier, he mentioned two sources, bill surcharges. That is one way we get our supply of revenues each year. About a $10 per household levy results in $25 million per year of proceeds that we are used for investments. And then we have a carbon tax that generates for us about $5 million a year. We also, these days, because of the Biden administration, has devoted much more money to climate policy after 4 years of the federal government being pretty much absent in that regard. We get funds from those sources. And we also issue green bonds, and we also have portfolio investments that generate about $10 million a year. Taken all together, we have about 50 million or so in revenues that are generated through the Green Bank every year. Next slide, please. A little bit about the how we are governed, our governance structure, board of directors. About 1/3 are from the agencies of government or parts of government. You'll have the state treasurer, you'll have the Department of Energy and Environmental Protection, you will have the Department of Economic and Community Development, which uses money from the government to stimulate jobs and things like that. We also have our Office of Policy and Management, which is basically the budget arm of the government. So those important agencies are represented, but also we have representatives of labor, representatives of the environment, representatives for low income. So there's a cross section of people who are represented on our board to represent a number of the interests that we have at play when we're dealing with climate investment. And importantly, we have a deployment committee, which that's what we call our risk committee, which meets, if you go to the next slide, which meets 4 times, it says 2 times a year, but actually meets 4 times a year to review transactions up to $2.5 million. Beyond that, our entire board has to weigh in on the transactions. The staff can approve transactions up to $500,000 for programmatic purposes, meaning that the programs have been established and approved by the board. Now, the next few slides, I'm just going to ask you to click through just as, and these you can review on your own, but the typical budget committees, you'll have the next slide, it'll say the audit committee, and then if you go to the next slide, it will say the joint committee. I do want to stop there for a moment and just mention that this committee is rather important to us because it manages our interaction with our electric and natural gas utilities. In our country and in our state in particular, but it's quite common in the United States for the power utilities and the gas utilities to run programs that manage energy efficiency programs, so that the regulator gives to those utilities the responsibility to make their enable their users of the services more efficient. And so there's a little bit of money that is, again, with the bill surcharge that they use for these purposes to drive incentives into the market. So we work with them, they use their incentives, we use our financing programs to get people to act. Next slide, please. And this just shows how we are organized pretty much around the solutions we want to bring to bear into the market. The home solutions is for ordinary residents in their homes. The building solutions are for commercial as well as residential real estate. Residential real estate being apartment dwellings or social housing. Community solutions really address state and local government type of installations, and our investment solutions relate to our capital markets activities, which are our long-term bonds, our green bonds, as well as we have innovated in the crowdfunding space a regular issuance of a 1-year investment certificate, which is available for as little as $100 and for up to $10,000 more generally. So we bring that to market every 90 days, and that allows the public to participate in the benefits of investing in the green climate space. Next slide, please. And this is just represents some of the benefits of our green bank to our local economy. I think it was mentioned by Professor Bowles that the MDIs have a leverage effect of 9 to 1, I think was the figure that he mentioned. You can see here that our leverage ratio is about 6 to 1. $300 million roughly of public funds that we have put to work, resulting in 1.7 billion of economic investment in our state. And that has resulted in more than 25,000, that this number is out of date, more than $25,000 of direct, indirect, and induced jobs, environmental benefits, as well as all of these investments result in greater revenues for the state, and that generates a tax charge as that activity. This can be from wages, this can be from corporate profits, however it's derived, but it's actually tax positive to the state. Obviously, the energy burden is reduced, and one additional fact in the lower right-hand corner that is typically overlooked: public health savings. Because when you have less particulate matter in the air, you have less respiratory impacts for citizens, whether that's asthma, cardiac issues, and things of that nature. So that results in big savings for our society. Next, if you can press one more time. And we were a winner of a Harvard Award in public governance, so recognizing all the benefits. Next slide, please. And this is just a simple schematic of how we work. By doing all these investments, we allow either the business, the building, or the home to use less energy, and it's either generated more cleanly by replacing grid power, which is natural gas, substantially natural gas generated with cleaner solar PV, or we can use energy efficiency to reduce energy spend and reduce energy burdens. Next slide, please. This is how we operate in our programs. We operate basically in 4 ways. We have incentive programs that are required for us to administer by the state. Previously, we administered a solar PV program across across a residential single-family homes. Now we administer a electric battery storage program, and that we do in concert with the utilities. But that is the only aspect of our role, which is handing out money. Everything else is financing. And the financing comes in basically three flavors: co-investment, where we will work alongside private capital jointly in a project. Typically, we will be in a subordinated position to credit enhance the transaction. We also can work in the next sleeve there as credit support. This is where we will offer a loan loss reserve that de-risks the transaction somewhat. And the final sleeve over there on the right, you see warehousing. A number of these projects can be small for a bank to take up. And they're particularly in SME type of transactions. These can be irregular transactions, but what we do is we invest them and put them on our balance sheet, and then we can pool them later and issue bonds against them. We have done that before. In fact, we were the first ones to issue bonds for real estate-backed secured transactions in energy efficiency. Next slide, please. And what this shows are the actual programs that are aligned with those sleeves. I already mentioned the battery storage program. The PosiGen transaction there at the top is solar PV for low income and moderate income families. There are tax benefits that these families cannot take advantage of because low income, they have very low tax bills. So if you get a tax credit, it's not very useful. So PosiGen was able to turn it into a lease, and we were using our balance sheet to get them started because of the knowledge we have of how solar funds work. And then you look at the Smart E-loan in the next sleeve. This is where we provide that loan loss reserve, and that has brought in local lenders to the tune of more than $110 million over the last 10 years. So it's really been a very strong program. And what the banks like about it is not only do they get the loan, but they also get the customer. So we get the environmental benefit, and they get what they want in terms of financial benefit. In terms of warehousing, the CPACE transaction is commercial property assessed clean energy. And this is, you might call these rates. In the UK, they call them rates. We call them property tax, but it's a system where there is a special assessment placed on a property in return for financing, so that the financing stays on the property, secured by the property, and will stay there until it's paid off. Why do we do it that way? Because regardless of whoever is living in that property, or doing business in that property, they will benefit from the energy efficiency improvements or clean energy improvements like solar PV that are going to remain on that property indefinitely. So it's a good way of doing long-term financing and getting around some credit issues. Next slide, please. This is just to demonstrate how many capital providers we work with. We work from everybody from a small credit union all the way up to private equity and the capital markets. So we work across the range, and that's because we match the risk and sector preferences of capital to the projects we support. And there's just a blend of capital, but because there are so many different dimensions to these projects, and we have to play matchmaker. Next slide, please. This just explains a little bit more about the Smart E loan. Before Smart E, there were very limited options for homeowners to fund modest improvements to their home. Quite often you would have to take out a secured loan on your entire home just to do the financing to improve your boiler or put in central air conditioning. We convinced the local lenders that that wasn't necessary, that there would be very low losses from these particular borrowers, and we were correct. In fact, when we met with lenders more recently, they said these loans perform just as well as home mortgages, just as well as home mortgages. So we were able to get them to lend longer and at more moderate rates in return for a loss reserve. Next slide, please. You can look at this structure a little bit later. These are just the structural diagrams, but I just want to let you know that's in this package of slides. Next slide, please. Here is the PosiGen situation. Again, I talked about this, so I'm not going to repeat, but I do want to point out that for a $5 million initial investment by the Green Bank, you can see the CT, which is the abbreviation of the state of Connecticut, results in the lower part of the slide. Nearly $120 million of investment so far and growing. And that's considerable leverage. Next slide. Again, that's a structural diagram, so you can keep going. And I do want to, this will be the last one that I will talk about. This is our joint program with the utilities. The utilities, as I mentioned, they have their own incentive programs. They work with SMEs for a Small Business Energy Advantage program. And what we do is we buy the loans from the utility, and we do that jointly with a mid-sized commercial bank. And that reduced, if you go to the next slide, if you look to the right, it reduced the cost of funds from the utility from 10% down to a low of 3% when interest rates were very low. And now they're hovering at about 5%. So a very dramatic reduction in cost of funds by getting the Green Bank involved with private capital. So I am going, if you keep going to where you see the hydro facility, keep going, maybe one more. There you go. This is just to show that we also work in larger projects. We have 3 hydroelectric facilities that we have financed in the state. There's a ribbon cutting, in fact, in 2 days for our latest project that is completed. Next slide, please. And we've also worked on anaerobic digestion. Organic waste is about 1/3 of the waste stream in Connecticut. And so we have financed some digester projects, and we intend to do more. Next slide, please. And this is just to signify that we have issued Green Liberty bonds. That's our signature bond. You can go to that website there and find out more about how we have transformed the market for green bonds. Next slide. And this is the crowd-funded transaction that is issued every 90 days to raise money for the Green Bank to fund that small business energy advantage program that I mentioned with the utilities. Next slide. I think that does it for us. Keep going. Thank you very much. There are the websites, and happy to take any discussion when it's my turn. Thank you.
Thank you very much. Thank you very much, Bert, for a very comprehensive presentation. We've seen a lot of the important points that were raised in the earlier presentations about governance. You've presented how your corporate governance structure is functioning, again, bringing the importance of that back to light, the importance of leveraging, and all the many different products that you've been developing, which is so fascinating. So thank you very much for that. Next, we would have 2 discussants on this presentation. So let me introduce our first discussant. We have the pleasure to have with us Mr. Chaudhry Liaquat Ali. Mr. Ali is working under the Sustainable Finance Department of an institution that I know well, the Bangladesh Bank, the Central Bank of Bangladesh. He joined the Bangladesh Bank in 1999 and has worked in the Department of Banking Regulation and Policy Department, as well as other departments. Over to you, Mr. Chaudhry. Thank you. Yes, yes, of course, yes.
I would like to thanks to ADB for inviting us as a discussant. Firstly, in the morning session, we have listened from Mr. Bowles, Professor of SOS University, and Mr. Jokia, Chief of Finance Sector Group, ADB. We listened about how the importance of establishing Green Investment Bank and what are the challenges for establishing the Green Bank and what are the challenges for funding for the Green Investment Bank and what are the roles of the as a multilateral development bank like ADB. And I thank Mr. Hunter for informative and insightful presentations. From the Hunter presentations, we see that the Connecticut Bank basically is a quasi-public organizations. And it focuses on clean energy, that is renewable energy, alternative energy, so on. And the Green Bank is helping Connecticut flourish by the offering green solutions for homes and buildings. And we also see the 3 goals of the Connecticut Green Bank. One is leverage limited public resources to scale up and mobilize private capital investment in the green economy. And strengthen Connecticut's communities, especially vulnerable communities, by making the benefits of green economy inclusive and accessible to all the individuals and families. And number 3, pursue investment strategies that advance market transformations in green investing while supporting the financial system. Now I would like to share what Bangladesh banks as a regulator of the country I will share and in comparison with the Connecticut Bank. Connecticut Bank focuses the green financing to clean financing. And as a central bank of the Bangladesh, and my department, Sustainable Finance Department, as a regulator to guide the banks and FIs with a product. That means we consisting of 68 green products under the 11 sectors, including renewable energy, so on. Connecticut banks uses green bond, but in our country, as a regulator, Bangladesh Bank already issues a circular for policy for green bond financing for banks and FIs. I'll later discuss briefly in the later review. And Connecticut Bank take assistance from the different sources which lower the cost of fund. Similarly, to promote the sustainable finance or the green finance, Bangladesh Bank facilitates it to our commercial banks and NBFIs by the refinance scheme under a low-cost fund. And Connecticut Banks is a global example of the green growth, but our aims, that means Bangladesh Bank's aims, to greening the financial system as a whole, not a single banks. So let I share, actually Bangladesh banks started its journeys for greening the financial systems in the year 2011. You shown the slide. When we issued a policy for green banks and environmental risk management guidelines. Then we issued a circular to give a target for achievement by the banks and FIs as a 5% of the total investment should be the green finance. And for better outcome and gap between the demand side and central bank desires, central banks created a dedicated department named Sustainable Finance Department in the year 2015. And at that time, we circulated to the banks, they should keep 10% of the CSR fund, keep as a climate risk funds for the risk minimizations of those finance. In the year 2017, we issued ESRM guidelines, environment and social risk management guidelines, where we incorporated a environmental and social due diligence checklist. That means one generic checklist we are incorporated in the issuance of the ESRM guidelines in the year 2017. And in the year 2022, we moderate the ESRM guidelines by incorporating the one generic ESDD checklist and 10 specific, sector-specific ESDD checklist. And the analysis of the gap between the central bank desires and demand side desires and the bank desires, we come forward to moderate our sustainable finance policy. Listen, in the year 2020, we issued a circular sustainable finance policy for banks and FIs, where we incorporated 68 project initiatives under the 9 sectors. Those sectors are renewable energy, energy and resources efficiency, alternative energy, liquid waste management, solid waste management, recycling and manufacturing recyclable goods, environment-friendly brick productions, green environment-friendly establishments, green agricultures, green CMSME, and green socially responsible finance. Then we already disclosed and circulated in the year 2021 National financial inclusion strategy. This strategy actually is formulated by our government with the assistance of the UNCDF. And in the 2022, lastly, we issued a circular for raising the fund by issuance of the green bond. And if you see to our website, you see the why we issue the green bond policy. Where in the policy we include a green bond taxonomy. And what are the objectives of the green bond taxonomy? These are the climate change mitigations, climate change adaptations, and sustainable uses water and marine resources, transition to circular economy, pollution prevention and control, and protections and restoration biodiversity of the ecosystem. In the bond taxonomy, you will see the 88 activities are there for issuance of the bond under the 8 sectors. That is low carbon electricity, heating and cooling, green establishment and built environment, energy resources efficiency in the industry, low carbon transport, circular economy, and waste, water, and water management, so on. And for promoting the sustainable, because as you know that Bangladesh is the most climate vulnerable country in the rank 7th of the world as per the IPCC resolutions. So the sustainable finance and climate finance is most costlier for the economy. So Bangladesh Bank issues to promote the sustainable finance and green finance 3 refinancing schemes. 3 refinancing schemes. One is a green transformation fund. Another one is a technological development fund, and another one is a refinancing scheme for investment. Here I shows that what are the performance from the refinancing scheme. And lastly, we introduce 5 billion taka refinances in the local currency under the GTF. We expect from these refinance activities per year 35,000, around the 36,000 tons CO2 gas reduce the emissions from these outcomes. So at the end of the session, we want to see our economy, that means 50% of the industry finance as a sustainable finance by the year 2030, and the 100% by the 2050. And my country and my banks is the slogan for green economy is that go green, live green, and live for others. Thank you very much.
Thank you so very much, Dr. Ali. I think it is as a regulator, and you well presented the what the Bangladesh Central Bank is currently doing, and also compared to Connecticut Bank and all of their the specific the policies and the bond and also the other products. Thank you very much. It is very touching, the motto, right? And you said about that one. So ADB is finding out how we're so eager to work together with the Central Bank of Bangladesh. And we are seeing, as you can see, pretty much some time constraint. And before I say about time constraint, I would like to give the apologize to you, and because the Gigi Bruno is supposed to moderate this session, he was in an urgent call, so he needs to step out, but he will come back later in the afternoon session. So at the moment, and please, we are seeking your kind understanding. And now, so I'm suddenly taking over this moderating role, and we are having a little bit of problem of the time management. So The next discussant is, not because our presenters have an issue, but because we have so exciting topics. These contents are so rich. So here we have Anjun, our ADB colleagues, and I believe, and Anjun is already remain connected there. And Anjun is a senior public management specialist, and Anjun is also responsible for managing many TA projects in CWPF, and he was he also worked as a senior economist in IMF before. So Anjun, are you there? And can you please remit, and sorry to ask you this one, and to go proceed another long presentation, you can give us like, if you can, like, 1 or 2 minutes if it is possible. And we can have your written the comments later so that we can circulate. Can you please go ahead?
Thank you, Junkyu. Many thanks, Dr. Hunter, for a very comprehensive presentation and providing us valuable insight about the Connecticut Green Bank operations. I would say your discussion about the role of board of directors and the different board committees in the Connecticut Green Bank is important, and it further strengthens our belief that the good governance is the foundation for success of any business. Likewise, information about the legal structure, flow of capital, well-thought market segmentation, and targeted customer solution provides valuable guidance for the new ventures, newcomers in this area of green banking. All of these commendable efforts led towards raising $800 million for under the public and private partnership with a strong social and environmental impact. Based on your presentation, I was thinking, and I believe that there are few potential areas where MDBs can play a strong role, and many of those already have been discussed by my colleagues, like the strategic technical assistance and capacity development needs, and support DMCs in the development or strengthening of the green finance frameworks. Concessional loans or concessional financing is another area. Engaging with the policymakers to streamline regulations, which can help in the development of capital market, I think is very important in DMCs. And likewise, from MDBs, like for example, from the ADB side, I think important contribution can be through efficient and effective advisory services towards green PPP transactions. I have just a couple of 2 or 3 questions you can say, which you may answer during your question answer, or maybe some other time. It would have been better or beneficial for the participants if you can share some key lessons learned and challenges faced during establishment of this bank. How did you convince the investors, attract customers, satisfy regulators? So this information would be useful for the new ventures in these areas. And finally, I think if your bank can consider developing some knowledge tools, knowledge solution in partnership with DMCs, so that knowledge solution can help other DMCs in establishing such green investment banks. With this, thank you so much once again, and over to you, Junglu.
Thank you so very much, Anjun. I think you really got to the point in role of MDBs and including ADB, and also your points about the key lessons and challenges, and including that the customer satisfaction and working together with the regulators. And I think it is that point, engaging policymakers to streamline, and I think it is very, very important. Technical assistance, I think all of these areas, and we can work together. It's really good point. And now it's understanding the time constraint, and maybe we can, if you are fine, and we can move on to the presentation 3. And this is another very interesting case, like I said from the beginning, and this was publicly funded, set up, and then later sold to the private investors and Macquarie Investment. So we have now Adrian Barnes, and head of Green Analytics and Green Investment Group, Macquarie Asset Management, and I think it is he's already online. And let me just quickly look at and how I can introduce him. And actually, all right, okay. All right, and Mr. Barnes has been with the Macquarie Green Investment Group, called GIG, and since joining the UK Green Investment Bank in 2013, and acquired by Macquarie to form GIG, Macquarie GIG Green Investment Group, in 2017. So it was sold in 2017, and GIG is now part of Macquarie Asset Management, the world's largest infrastructure asset manager. So let me ask Mr. Adrian Barnes and to present. And Adrian, are you there? Oh, I see Adrian.
Yeah, I'm
okay.
here.
Yeah.
Thank you very much.
Yeah. Happy to have you. Please go ahead.
And I will do my best to try and recover you some time and give the discussants plenty of time to react. So thank you, everyone. This is the case study of the creation of the UK Green Investment Bank and what it achieved in its 5 years of operation and some reflections on that. So next slide, please. I have a couple of pages of disclaimer. I won't make you read through them all, nor will I read them out, but turning financial products. And I've already had a very kind introduction there. So going straight on to the sort of key introductory points. UK Green Investment Bank, launched by UK government in 2012. During that period, we committed £3.4 billion to 100 investments in the UK, created a dedicated offshore wind fund. In 2017, Macquarie acquired the UK Green Investment Bank. It was privatized. We'll come on to some of the reasons for that when we come towards the end of the presentation. And we're now part of Macquarie and Macquarie Asset Management, the world's largest infrastructure asset manager, now operating on a global basis. Next slide, please. The mission of Macquarie of GIG within Macquarie Asset Management is accelerating the transition to net zero. And so, as you'll see in this presentation, a lot of the things that we still do are very much underpinned by how the Green Investment Bank was set up. So I head up. We've got the kind of 3 points of focus there on developing and investing in infrastructure, powering clients, and also sort of managing the assets of clients. And then I head up the green analytics function. So I'm an environmental scientist by background, and my role really is the role of my team is to evaluate the environmental contribution of our projects. Next slide, please. We will come back to this a little later. The requirement, the mandate of Green Investment Group is to invest in activities that contribute to at least one or more of the 5 green purposes: reduction of greenhouse gas emissions, natural resource efficiency, natural environment protection, biodiversity protection, and promotion of environmental sustainability. It's in sort of 10 years of our operation, we have invested in projects that will, when fully operational, deliver a lifetime emissions reduction of 212 megatons of CO2 equivalent, and generate 590 terawatt hours of renewable energy. So some pretty large numbers, and as you'll see, that's a combination of the investment we did as GIB, the investment we mobilized alongside it in that time, and then the subsequent investment from the Green Investment Group. Next slide, please. And this is just a kind of brief summary of some of the points on Macquarie Group, which is an international organization. So obviously one of the major changes of since UK GIB joined Macquarie is that we're an international investor. investing in a variety of project types globally, but also to build the mission of helping push the industry forwards. But I will return to that. So next slide, please. And then the following one onto the UK Green Investment Bank. So in terms of background, the context of the UK Green Investment Bank, it was created by the UK government, really in the context of, in 2012, that the process for creating the UK Green Investment Bank really kicked off in about 2009. And it was in the context of these kind of ambitious environmental legislative requirements. And also, those of you, a number of you, I'm sure, will remember the global financial crisis of 2008 had left a lack of liquidity in capital markets, particularly ones that were willing to finance infrastructure creation. And so these targets were looking jeopardized. These are kind of the environmental targets as they were at the time. So since that greenhouse gas emissions reduction target of 80% by 2050 has subsequently been updated to require 100% reduction and therefore a net zero commitment by 2050. But the achievement of these targets was somewhat in jeopardy, and that was one of the motivations for creating the UK Green Investment Bank as a vehicle to help mobilize investment into infrastructure assets to help the UK government meet these obligations. Next slide, please. And so really it was brought about by a combination of these political, these policy and macroeconomic factors. I already mentioned on the right-hand side, liquidity and the global financial crisis. At the top, the public policy goals that I showed on the previous slide. And then on the left, there was a fundamental change in the support framework in terms of government incentives for new infrastructure types. So previously, the main instrument for supporting renewables investments was something called the renewables obligation, which was effectively a subsidy mechanism, not met by government, but met by bill payers for renewables. The government wanted to make sure that the societal cost of deploying renewables came down, and so it would move into an auction-based mechanism called Contracts for Difference in the UK that was actually very transformative in helping lower costs of some of these technologies. But there was a backdrop of cross-political consensus. At the time, there was a coalition government with two parties, but also the opposition was very supportive. And those were kind of the key features. If we go on to the next slide, these 5 defining features of the UK Green Investment Bank really established what it was setting out to do. So operational independence from government was very, very clear that it needed to be an institution that could work within the context of private finance and understand private finance, whilst it was a government organization. That operational independence was very, very important, and it did cause tension at times. There was political lobbying on a few of the investments we made, which was, I think, very, very strongly rebuffed. And so we were very careful to maintain that independence and to make investment decisions based on their own merits. Green and profitable, that was the mission. We'll come back to that again in a second. It had a specific initial remit in terms of addressing perceived market failures in offshore wind, waste and bioenergy, and energy efficiency. These were priority sectors. Notable about that was that when the UK GIB was initially created, onshore wind and solar energy were specifically excluded from the mandate, so they were ineligible. And the rationale behind that was they were deemed already to have sufficient investment support from private markets. And so that point about not crowding out private capital was very important. the wind sector and the onshore wind and solar PV sectors really didn't need that support, and so they were not permitted to invest in those. The mandate was later increased to encompass broader forms of renewable support, but actually we ended up maintaining that focus on those three target sectors. We did work across the capital structure, debt, equity, mezzanine. Over the history of the UK Green Investment Bank, it started out very much with a debt and operational assets focus. So refinancing debt packages, because that's where there was a gap in the market. As we went through that 5-year transition period, the opportunities for investment in operational assets, acquisition of operational assets, the opportunities for providing debt saw us crowded out by private sector capital, which is a good thing. And so we moved more into the early stage development projects. And that's very much influenced the position that the investment group under Macquarie is in today. And I mentioned that final point about additionality to existing private capital. It was a very strict requirement that we did not crowd out private capital. So let's move on to the next slide, please. So in terms of those, how they shaped the expertise of the people, the UK government sort of chose the initial staff, who then built up a staff of 100 people, which was split between the headquarters in Edinburgh, Scotland, where I'm based, and an office. It was about a 50-50 split between Edinburgh and London. Of course, the investment professionals, it was very, very essential that we attracted people with relevant experience in project finance, equity advisory, etc. But just as important as that was technical knowledge. So we had in-house experts, as well as relying on external advisory consultants. We did have in-house technical experts on some of these areas that were able to vet those projects for features of technical risk. The green team, of which I was part, provided the overall environmental analysis that made sure we invested within that green mandate. Also, policy and government engagement professionals and communications was quite important, and maybe we can, in terms of those lessons learned. Next slide, please. So in the creation of the UK Green Investment Bank, there were a few points of tension that needed to be resolved in the structure of the organisation, the tension versus green and profitable, and the tension versus profitable and additional, because these are all key features demonstrating environmental outcomes whilst delivering commercially acceptable returns that in projects and assets that did not crowd out private sector investors. So next slide, moving on to the first of those. Additionality, this was prior to Brexit, so the UK was in the EU at the time, and due to the Treaty of Rome obligations on state aid and preventing states from acting uncompetitively between each other, it was illegal to give financial help from the state in a way that would distort fair competition. And therefore, as a result of that, the additionality requirement of not crowding out private capital was an essential feature of the bank. In terms of how that worked in practice, we were on each and every transaction required to do market investigation and to obtain assurances from counterparties that they had exhausted other sources of private capital. I wouldn't say that's necessarily the same as being a lender of last resort in the same way that a lot of multilateral development banks are, because there was an element of timeliness to it. So if an investment could not be made without the UK Green Investment Bank at that time and in place, then that was deemed eligible. it wasn't an additionality process so exhaustive to the extent that you could definitively justify that no one else would ever finance this project. It was more that it was needed to make a transaction without delay, and therefore helping the UK government with those targets. And so we did have these specific focus areas, as I said, that were restricted in mandate. And as you'll see, the kind of success of the Green Investment Bank in leveraging capital instruments meant that ultimately led to the sort of fulfillment of the mission in terms of bringing liquidity back to those markets and making them viable for so we've gone to the next slide, please. In terms of defining the green part of the mission, and this is really very much my area of responsibility, the parameters of the UK Green Investment Bank were set by lawmakers, by the UK government in legislation, and that required that set up the organisation with these articles of association to contribute to that any activity undertaken must contribute to one or more of the green purposes. You'll have noticed from the start that these green purposes with which the UK Green Investment Bank was set up in 2012 are identical to those continued to be applied by Green Investment Group today. And I suppose if you look at that in the context of what's happened since, you'll see a very close degree of overlap or similarity to frameworks like the EU taxonomy, in that contribution to an environmental objective is a requirement. Similarly, we also had to assess harms, negative impacts and risks against these green purposes, and ensure that as well as contributing to one, we were not delivering significant harms. And so that was something that was very much a feature of the investment appraisal process. I suppose just talking briefly on that and the structuring of that, we had a multi-stage investment appraisal process whereby subsequent initial and then pre-final and then final investment committee papers were taken to two committees. There was the formal investment committee, obviously. We also found it very valuable to set up what we called the deal review committee. Macquarie actually has a similar structure whereby investment professionals who sit on the investment committee are able to review and comment on transactions in a less formal environment before they go to formal IC approval, which really helps ensure that investment committees are operating at maximum efficiency and using the limited time of the people to best effect. And I think that was quite key that during that structuring phase, feedback can be given on the acceptable limits of a transaction, and that there's a lot of work that goes into that before that informal structuring before something is presented to the investment committee as ready for approval. Green analytics team, or the investment ratings as we were back then, contributed to those various stages, providing an initial screen at the initial investment committee stage, and then as the due diligence progressed, incorporating more of that information from due diligence to give a final definitive opinion on the alignment of a transaction. So next slide, please. Coming towards the end, so I have plenty of time for the discussions. So in terms of investment track record, over the period from 2012 to 2017, the UK Green Investment Bank committed £3.4 billion and mobilised about 12 billion. So I guess that's sort of interesting to contrast that mobilisation ratio of about just under 4 to 1 with the 6 to 1 ratio that the Connecticut Green Bank was talking about there. I suppose that the difference being that we were working in slightly different markets and working with very large infrastructure projects. So we weren't really making investments below the kind of 50 million pound mark. We didn't have a specific threshold, but I suppose when you're an institution with only 100 investment professionals and 3.8 billion is the total amount available to us, and as much of that to deploy within a short period as possible, you inevitably end up having to prioritize higher volume transactions. Commitment. As well, and this sort of led the way to where GRG is now. We set up what was at the time Europe's largest dedicated renewable energy fund, the UK Offshore Wind Fund, and that was really managing third-party capital, attracting 1.1 billion investment from other private sector investors, and that fund remains a kind of key feature of, and its successor funds remains a key feature of our approach within Macquarie Asset Management. We'll talk about that at the very end. Market share there, just showing that we mobilized a significant amount of capital, and the kind of outcomes of green impact. These are some of the numbers we figured. I won't go into too much detail, so we'll go on to the penultimate slide. Just the next one. Thank you. Sorry, previous one. Thank you. So just kind of rounding out on the features of the UK Green Investment Bank. It was launched in what was a relatively short time, but it was time spent to structure the objectives, the mission, the principles, and the legal constraints very closely, and ensure that they were robust, and the governance structures and that independence was aligned to best industry practice. And as well as being aligned to that, the mission of the GIB was to help the market develop its approach to effective green investment. So things that we developed, like external assurance of our annual green reporting, are features that sort of got to be ahead of the peer base, but also sharing those tools and that knowledge with the market. And so final slide, really just coming full circle to where we are now. The Green Investment Group within Macquarie Asset Management is really the legacy of UK GIB. A few sort of headline numbers there in terms of £26 billion now committed and arranged to support green energy projects. Globally, there is a big global spread of our investment activity in those, I think it's now approaching close to 30 markets, and a variety of asset and infrastructure types. So thank you very much for your time. I hope you found that useful.
Yeah, we would like to give lots of accolade to you, and thank you very much, Adrian. I think you really touched upon from the backgrounds and also the great legacies, and we really like to hear from you that actually GIB allowed the rapid establishment of these current the institution and also the business cases in using the capital market access and others, and I think it was very, very useful. And actually, this is a very enriched topic, so it's just within 20 minutes managing, it's not easy, as you know. So we would like to continue to have the discussion and out of this, the meeting room. But now we have a very great and two the discussants, and one is Dr. Adi, and the Minister of Finance, Indonesia, and currently serves as head of the Center for Financial Sector Policy. And he started his career as an executor at the Finance Education and Training Agency of the Ministry of Finance. And also, he also served as a working secretary of the 2018 IMF World Bank Group National Committee for 2018 annual meetings in Bali. And we also have our super senior director, Christine, here. So because of the timeline, and I'm kindly asking, and both of our wonderful discussion to limit and 5 minutes and 5 minutes. And I know the Dr. Adi prepared a lot, but we would like to, we're not going to go away. We'll be here and today and tomorrow, right? So, and also we can share, and if you provide your written the discussions also. Okay, Dr. Arya, please go ahead first. Okay. Yeah.
Thank you very much, Ching-Sil. Thank you very much also ADB for having me, and we have a great discussion today. I would like to convey at first my presentation or remarks that the Indonesian government is very committed to the climate change risk mitigation and sustainable finance initiatives. This is also signifies the role of the government when we just launched the energy transition partnership program with the G20 under Indonesian leadership in G20 chairmanship last year. And Indonesian Minister of Finance currently also serve as part of the coalition of finance minister tackling climate change action. And last but not least, we just also launched the ASEAN Taxonomy Board under Indonesian chairmanship in ASEAN. And we're looking forward also for energy transition mechanism down the road. I would like to address my response to the Adrian presentation in two parts. First, I will be responding on the GIB role in promoting sustainable finance, and hopefully I can do fastly on the Indonesian experience in case of promoting sustainable finance, which will include recently initiatives that I already mentioned before. First, let's focus on these slides. We do believe that the GIB is part of the key initiatives to tackle the challenges. Currently, government intervention through GIB and GBI-like entities is required to promote green economy, especially with its early stage of development. The existence of GIB is substantial, attracting private investment, of course. Thus, shifting from generated-led government-driven to market-driven approach is really wonderful. As a matter of fact, green sustainable projects are still perceived more costly and risky than conventional projects. Private sectors may seem this to be unattractive for investment. Therefore, these types of projects need government still intervention. Unfortunately, in many developing countries, the financial market is not yet well equipped with the capacity to effectively assess the cost and risk associated with the green projects. In this case, the government through GIB or GIB-like entities should lead the process to stimulate this investment. Developing countries may consider the establishment of GIB and GBI-like accelerate green and sustainable finance project. We would like to pursue or to strengthen the GIB comparative advantage. This is in my second presentation. The independence, the clear mandate, and finance approaches. Most or some GIB are also mandated to remain profitable. I think that's partly UK GIB also included. The measure of outcome need to be more balanced, not only rate of return or leverage, but it should provide impacting investments such as emission safe, job creation, alignment with national targets. The point where GIB can find right balance between green and profitability and additional is somewhat encouraging and also a challenging task. Thus, GIB provides important intervention principles to enhance private investment, such as resolving market failures and crowding in private investment. My second part of the response is actually trying to delineate how Indonesia current target on climate mitigation adaptation. I can convey that in September 2022, the Indonesian government issued the enhanced NDC. My next presentation, I think. Committing to achieve its target reducing emission by 43.2% with adequate international support by 2030. Indonesia Pro Environmental Development Fund is very limited. The total projected can be at expensive as $281 to committed NDC and beyond until 2030. And 1/3 can be supported by government budget. That means 2/3 of it, we need private investment. We need blended finance. Various fiscal policies have been compared to encourage sustainable finance, namely climate budget tagging and at the national and regional levels, various innovation financing policies such as sovereign green sukuk, green retail sukuk, sustainable development goals, SDG bonds, and the latest policy also trying to accelerate a carbon pricing-based funding perspective, both carbon trading and carbon tax mechanism that been targeted as soon. From the state budget side, policy support is also provided through tax facilities, guarantees, and also government investment policies. At least in the last 10 years, Indonesia has produced a framework for sustainable finance. For example, in 2015, Indonesia Financial Service Authority launched the Sustainable Finance Roadmap, 2015-2019. The roadmap phase 1 has 3 focus in green lending model and capacity building, etc. In 2016 and 17, OJK regulation also strengthened the sustainable finance to financial service institutions, issuers, and publicly listed companies. In 2022, total green bond and sukuk issuance of Indonesia, including sovereign green sukuk issuance, has reached $5 billion. The Central Bank of Indonesia has issued regulation to loan to value for green property mortgage and to support green building development. Furthermore, Indonesia's stock exchange just launched IDX ESG Leaders Index that measures price performance and stocks that become leaders in ESG rating. To accelerate the presentation, I would like to also emphasize the importance of energy transition finance. In case of Indonesia and most of developing countries, we continue to take action to accelerate the clean energy transition. In November, we just launched Energy Transition Mechanism country platform, which has been explained by Jung Soo. I think this is great and strong collaboration with ADB. And we want to identify that 15 gigawatts of fossil fuel energy plants for early retirement can be done as soon. In November, we also signed an MOU to explore the first project in ETM project, which is early retirement of 990 megawatt coal-fired power plant in West Java. In the ASEAN Taxonomy Board, we appreciate the progress made by ASEAN Taxonomy Board Working Group 1. And we continue to just launch the revision of the Taxonomy Board, Taxonomy ASEAN in last March. We need to remain supportive to the global dynamic of the transition activities issues. At the same time, we need to also play ASEAN leading role in better defining the transition agenda so as to enable the interoperability between taxonomies, stronger placement of regional strategy, to encourage the revisit of the already in place regulation transition, as well to accommodate the needs for achieving Paris Agreement commitment. Last but not least, I would like to go to my concluding remark or the response that in my last slides, that the government intervention is still required to promote green economy, especially as its early stage of the development. Yeah. The existence of GIB is substantial, attracting private investment, thus shifting from the government-led to market-driven approach. Third, developing countries may consider the establishment of GIB and GIB likes to accelerate green and sustainable projects. Indonesia has 2 similar GIB type of the agency, which is the first, the Indonesia Country Platform by PTSMI, and the second is by Indonesian Environment Fund. Last but not least, the role of policymakers is still substantial in providing supportive regulation and incentives. Thank you so much.
Thank you very much, Dr. Adi, and you did a fantastic job. I know you prepared a lot, and actually, I really like to hear from him, the current efforts and also the government intervention related to this, the GIB, like the 2 institutions, and he explained, and also the importance of this GIB as to scale up green finance and together with the role of policymakers. And I think we are seeing a lot of collaboration in the future. And now let me introduce my senior sector director, and Ms. Christine Engstrom is, the official name is the sector director designate, but this is a little awkward, but it's her very soon, and senior sector director. She will be leading ADB's finance sector office under the solution group. And Christine was the director of the private sector financial institution division of ADB for approximately 10 years, managing a team supporting financial institutions through loans, equity guarantees, and technical assistance throughout Asia for business lines, including trade finance, SMEs, mortgage lending, and leasing. And I see that she's perfectly poised and to give this very wonderful and useful comments based on the UK bank case. Please go ahead, Christine.
Thank you, Junkie, for that very warm introduction. It's embellished a little bit with a super senior as well, too, so thank you. But I'll make it quick because I know that we need to take a break here, and I just want to thank everyone for joining us today. I think it's been a really interesting discussion in terms of how do we look at some of the approaches in the developed countries and bring them to our emerging markets. And I really like some of the examples in terms of the more practical approaches from the Connecticut Bank as well as from the UK bank as well too. I think that green investment banks can be one effective model to help address many market failures in certain situations. And clearly we need multiple different approaches. And we need private and public sector solutions as well, too, which is what ADB is looking at, especially as we're going through a large reorganization, as some of you may know, we are trying to bring the two sides together. I think that GIBs can offer tailor-fitted financial structuring and targeted approaches, and they can definitely enter into the markets where there are market gaps and then catalyze the private sector as well, too. Thereby fulfilling our sustainable development goals and then bringing green operations into the market. Next slide. I think it's important for us to take a look at, when we're moving into these different approaches and looking at different solutions for our emerging markets, really carefully looking at the context of what we are bringing into the market and what that market looks like and where really are the gaps. And I think in terms of the UK GIB, it was interesting in terms of the period that it was launched, so 2012 as we heard. So still the economy was pretty racked by the global financial crisis, as well as UK was vulnerable to different Euro area sovereign debt crises as well too. You saw investor confidence being very low. There's a lot of concern in the banking market over overvaluation of assets and aggressive risk weighting that may weigh down on the capital of the banks themselves. Credit growth was super weak as a result, and you saw that banks were not really that active in the market and were retrenching as well too, and especially when it comes to, of course, then long-term investments as well too, they'll be incredibly more risk averse. And then you saw the public debt in the UK being quite high, 30 percentage points above GDP, which was higher than pre-2008. And as we all know today, we're seeing many situations where public debt is quite high as well too. But then we're also seeing the drive for this bank, which was very clear public policy goals about greening the UK, as well as broad political support. And I think that we're in an environment now where ADB is trying to support more policy actions and getting the governments to become more committed to some of these goals. But we're asking them to go further than what maybe they're ready to do, which is why ADB needs to bring in solutions as well as our private sector too. So you have that coupled with this strong climate change drive, and you have the government then turning towards a public sector solution, but that then brings in the private sector as well too. So next slide. So I think really key lessons learned here from this particular example is, what were the key factors to making it sustainable, not only green sustainable, but also very importantly, commercially sustainable. Because we need to make sure that when we're setting up these institutions that they are, as Dr. Adi was saying, that they are able to then transition into the private sector and be supported by the private sector so they don't drag on public finances. But clearly there's a role for the public sector to initiate these as well too. And I think these are, obviously when Macquarie came in and picked up this bank, they were looking at their track record and how they were run. And also just in terms of kind of what we've seen in the past where you have very specialized non-banks or banks in our emerging markets, there are key areas where they had failed in. And as we heard earlier, that it's very kind of checkered experience in terms of their success and failure, but very important points to learn here. The first being, of course, corporate governance. We can't stress that enough in terms of operational independence from the government and the independent board and chair. I think in this instance, you saw very clear mission and strategy with very strategic emphasis on certain sectors where the private sector wasn't able to play in, right? And then also, as you heard earlier, a very strategic approach on crowding in the private sector, so not pushing them out of the market, and then limiting the distortive effects on the market, which is very important as well, too. Again, with the idea that we need to shift towards crowding in more private sector because clearly the governments aren't going to be able to fund the needs for the for climate finance going forward without the private sector. Also, I thought was really interesting as well too in terms of the Connecticut Bank example, going into more detail in terms of the product that they were talking about, in terms of the loan loss reserve, bringing that in as a way to then bring in and attract private sector investors as well too. So you're seeing also different types of more granular products that are offered to support the overall strategies of crowding in the private sector. Really important technical expertise. Do you have the technical expertise in the country? Do we need to develop it? Let's start looking at this right now to cover really multi-disciplines that are needed to run these types of banks. Not only technical skills such as green as well as banking, but also advisory skills as well too. Policy, government-related skills as well too. If you look at IDFC in India, that was set up many years ago, one of its successes was its ability to actually work with the government on policy reforms, to bring in that private sector viewpoint, to make sure that the reforms going forward had some type of view of multiple different people who could build the infrastructure environment as well too. So I think that's important. And then measuring and reporting green impact as well too, I think is important. And just last slide here. I won't go over how ADB is contributing to the climate agenda because it's been discussed, but one key point, and you'll hear about this more tomorrow, is about what we do in the private sector. And that is, especially through the financial institutions, we are providing equity, debt guarantees, and technical assistance to directly banks to help them green themselves as well too. And then also working closely on public-private sector solutions, which I think is the way forward. And with that, I'll leave it here and then turn it back over to Junkyu. So thank you so much and enjoy the rest of your conference.
Give a big applause. Thank you so very much, Christine, and also Dr. Ari, and both of our panel discussants did a really great job, and it's complementing my kind of incapacity to handle this wonderful session. And it is really great, to hear about its GIB. It's one very useful options, but the next story is that I think it's much more really useful and to us. And I did not ask Christine to sort of, provide us a 2-hour summary of our 2-hour session, but it looks like Christine did a fantastic job. It's really the summary, at the end of the day, we really need to work together with the policy makers for the policy reform, but this policy reform, and we have to bring in the private sector and also the crowd in the private sector and the private market, and best practice, establishing best practice and sharing that. This is very important. And also one of the presentation, today, she mentioned the Connecticut Bank and specific the product, and I also look at their website and loan loss the revenues provision and specific that product, and working together with the local community bank, and I think all of those are very, very useful. And we already passed 30 minutes where we're supposed to finish. Actually, my heart keep on reminding me I gotta receive questions, and we need to get into another interactive question and answers. But I'm very sorry. I'm gonna give my apology to all of our question raisers here. And so maybe if it is fine, and we're coming back 30 minutes later. And then we're going to have our Managing Director General's the welcoming remarks for our regulator session. And so this regulator session will begin called the session 1 and 3 o'clock. And Bruno will come back, our DG will come back, and to moderate and also to provide our scene setting session. And before I say let's have a break, and there is one thing left for speakers and panel discussants. And my team member reminds me, we actually forgot to take a group photo for this session. All right, so sometimes we forgot, but it is really good and to recover that memory. So now, except our speakers and the panel discussants, all of our other colleagues, and go out and for a break and drinking juice and refresh fresh air. But please, speakers and panel discussants, just stay here just 1 or 2 minutes, and then we're going to take a group photo. So I'm not going to call it a day, but I would want to call a break. So let's have a break. Okay. Thank you so very much. Let's give a good round of applause to our speakers and the discussants. Thank you. And speakers and discussants, and please come out. Please, let's take a photo. The morning session, as you know, it is a special seminar. It's on green investment banking scheme. And now we're going to begin the so-called session one. This session one is assessing, monitoring, and addressing climate-related risk in the finance sector. International experience and options will be shared. And Bruno will chair and by doing his synthetic presentation. So let me just quickly recap and quickly say what we're going to do right now. As a part of this opening event, and we're going to have our MDG, Managing Director General Woo Chung-um, to give us welcome remarks. And then after we have our welcome remarks, and we're going to have a group photo session for the whole participants. So group photo session for the whole participants will be held at that, I think it's a courtyard, I think so, in the center. So my role is to bring all of us and go there and to take wonderful photos. And it is, I think it's a step-up podium is already prepared. So I believe in it would be very good photo. But it's not just only for speakers and panelists, for everybody. It's just, I just want to make sure, you know, our understanding, it is for everybody. And then we have, after we have this welcome remarks and then group photo session, and then we'll go back to the so-called session one, like I said, and MDG, after taking a photo with us, and MDG will leave, and then we will have our DG Bruno to come back to moderate the session one, beginning from 3 o'clock to 5 p.m. today. And then after we have this 5 p.m. Session one, we're going to have a cocktail reception. This cocktail reception is standing, I believe. It also, a lot of good foods will be prepared for you, and it is there. It will be prepared there outside of this hall, and so that will be another fun event. So it's exactly 2:40, 10 minutes late, and I apologize to everybody again. So let me introduce our Managing Director, Mr. Woo Chung-um, to give us welcome remarks. Managing Director, please come in. Let's give him a big applause. Thanks.
Okay, good afternoon, everybody. I hope you enjoyed your lunch. Welcome to ADB, especially for those people who haven't been here for the last 3 years plus due to the pandemic, or those people who actually haven't been here in the past. Special welcome to all of you to join us here today. And we're still getting used to getting back into the face-to-face with a hybrid, and I think we are finding a fantastic convergence of the face-to-face and hybrid so that we get the maximum coverage. But at the end of the day, there's nothing like seeing each other face-to-face and having a great discussion. And I would like to give a special recognition of the distinguished partners in this room. From Bangladesh Bank, we have Mohammed Khurshid Alam, Executive Director, and Chaudhry Liaquat Ali, Director for Sustainable Finance Department. From the Philippines, Lynn Javier, Assistant Governor, Policy and Specialized Supervision, Subsector Banco Central de Filipinas. His Excellency Pentirong, he's the Undersecretary of Cambodia, Minister of Economy and Finance. He's His Excellency for many people, but for me, he's my friend. I've known him for the last 25 years, and it's really good to see. Where are you sitting? I don't see. Oh, yeah, there. Good to see you. He was with ADB about 20 years ago. From Indonesia, we have Inarno Jajadi, Chief Executive of Capital Markets, Financial Derivatives, and Carbon Exchange Supervision, and Adi Budiarso, Director for Center for Financial Sector, Minister of Finance, as well as our finance sector group, who's been working in the front and the back, behind the scene, virtually, to make sure it happens. And also some of the other old friends like Mr. Hao Zhang, good to see you. He was the former DMD of the IMF. But again, he's my friend from whatever years ago, so I'm still trying to get used to all these important people who used to be my friends. I hope they're still my friends, Actually, during the annual meeting last week in Songdo, Korea, I met up with a lot of people externally and internally. And I saw one of my colleagues who I haven't seen in a while, and I was talking to other people. I said, "Oh, she was my friend, 20 years ago," and then I was immediately corrected. I'm still your friend, not just in the past. So, so why are we here today? My colleagues who help prepare for my interventions, usually they get nervous because I veer away from the speech that I'm supposed to read. So, so please bear with me. I often like to start off on this kind of presentation with the reason why are we here, right? And that's because we want the bright future for our future generations. And we want our children, grandchildren to have the same beautiful planet that we have today. But based on what we see all around the region and around the world, I don't think we are on the right track. We have natural hazards happening everywhere, every 100-year events happening every other year, and that seems to be accelerating. And oftentimes we hear about the experts talking about the tipping point, and that used to be 100 years later, but we don't know how close we are. So we got to avoid this, and we have to make sure that we are in line with the Paris Agreement ambitions, because it's an existential threat for all of us. So what do we do? Everyone has a role to play, and we need lots and lots of projects which will support our development while reducing the greenhouse gas emissions. And the thing that I would like to emphasize is that sustainable development and development are not mutually exclusive, they are in one. For us to achieve our long-term goal of poverty eradication, we do need to handle climate change and sustainable development issues effectively. Without that, we can't achieve it. We do need to deploy a lot of new technology which can help us quantum leap our economic development to the low carbon and climate resilient economy. Again, as a bank, what do we do as all bankers here? It's about finance. ADB and other financing partners need to step up our efforts to scale up climate financing. And under Strategy 2030, we set up an ambitious climate finance corporate target of $80 billion for the period 2019 to 2030. This was done in 2018. But in the midst of the pandemic in 2021, we decided to be much more efficient. That was a time when all of our countries are struggling to cope with the pandemic. And there was a temptation to just focus on that and don't take care of the long-term issues. And we had to remind ourselves that COVID-19 pandemic will go away at some point, but climate challenge will not go away until we do something about it. So we decided to up our ante and say, okay, our minimum target is 80 billion, what else can we do? Let's strive for 100 billion. So that's been our newly announced ambition by 2030. We're still getting there. We have a lot of work to do, but we think that's possible. Now, is that enough, $100 billion? What's needed out there, it is estimated that some $1.7 trillion a year is needed for climate-adjusted infrastructure investments all around. And we are here to discuss how we can close the monumentally large funding gap for climate change efforts. And we need a vibrant financial system that can play its part in scaling up climate finance to achieve low carbon and climate resilient development in the developing countries in our region. So how should we proceed? Earlier today, we had a special seminar that talked about green investment banks in forms of public, non-profit financial institutions, which are also mandated and even built to develop, facilitate, and scale investments in projects that can help reduce greenhouse gas, as well as make the economy climate resilient. The session discussed how financing institutions can be transformed to become green investment bank institutions or to create new ones beyond what we already have today. We heard ideas from green investment banks in the US and the UK to learn from their rich experience in this regard. The succeeding discussion this afternoon until tomorrow will also look into climate risks in the financial systems, which is the second of our major themes. And climate change exposes economies to physical and transitional risks that can undermine the success of financial institutions, financial systems, and economies. So financial institutions need the resources, instruments, and skills to forestall these risks. We have gathered a broad array of top central bankers from Asia and Europe at this conference, alongside representatives from the banks for international settlement. They will assess climate financial risk in the financial sector, help us understand supervisory expectations for climate risk management, and micro and macro prudential options for supervisors and regulators. This touches upon our third major theme, scaling up climate finance, as I mentioned earlier. Supervisors and regulators can help create low carbon and climate resilient economies to lower climate risks for the financial sector. For example, measures reducing capital requirements for loans that fund projects aligned with the transition to the net zero economy, referred to as green supporting factor, are one area for discussion. Supporting disclosure frameworks and sustainability reporting standards and coordination with other financial authorities are another area for discussion as well. Supervisors can also mobilize private capital towards a transition to low carbon and climate resilient economy by supporting disclosure frameworks and sustainability reporting standards. And finally, the Asian Development Bank and other international financial institutions have an important role to play in meeting all these goals, which is our fourth major theme. The multilateral development banks and financial institutions are uniquely positioned to support financial supervisors, regulators, and policymakers in actions that will facilitate each area we will discuss, and creating green investment banks, managing climate risks, and scaling up climate finance. So once again, I'd like to thank everyone for coming today, both physically and virtually. And I wish you a very productive conference. And based on who's here today, I'm sure it will be very, very stimulating discussion. And please enjoy yourselves too in Manila. It's a bit hot, but it's better than being cold, right? So I'll see you around in the next couple of days. Thank you very much.
Ladies and gentlemen, let me get your attention. We are about to begin our session 1. Session 1 has a little bit unique structure. When I said unique structure, it makes me really excited. Actually, one of the unique structure is our Director General and Mr. Bruno Carrasco will give us scene-setting presentation. This scene-setting presentation is a title, Greening Financial Systems and the Role of IFIs. And this is very, very interesting presentation. And he's going to give us like around 15 to 17 minutes. And then the DG Bruno will be sitting here and to call our speakers and check whether our virtual speakers remain connected. And then we're going to begin this session 1 based on the scene-setting presentation. So I hope that after lunch, usually we feel a little drowsy, but I really hope that our DG Bruno will make you really super excited with this scene-setting presentation. Title is also very exciting, Greening Financial Systems. All right, so let me introduce DG Bruno again, and we are happy to get you back here. Please come over here.
Very good. Here I am again, and as if it wasn't hard enough to keep your interest and attention, our good friend Jung-kyu has made it even more challenging by placing me after the lunch session. So we'll try to be exciting, we'll try to be inspiring. Usually finance is not usually considered in that same category, but we'll give it a try. So let me begin by, again, thanking all of you for joining us today. Distinguished guests, ladies and gentlemen, colleagues, a very good day to all of you. Thank you for joining this knowledge exchange on greening financial systems and the role of international financial institutions. We have a lot of interest in this area. As many of you know, it's an important area that is fast moving, fast changing. and we need to be able to get a better understanding through these events. We get to hear a little bit more of what are your challenges, but we also get to hear from a lot of the experts on what they're doing in their respective countries. The conference itself is organized against the backdrop of the Asia-Pacific region, which is very much at the center of climate change. We in Asia-Pacific account for over 50% of total greenhouse gas emissions, as you may have heard before. But on the other side of the coin, we're also increasingly getting exposed to those climate-augmented natural disasters, and that's taking a greater toll on lives, livelihood, and a lot of the assets. We saw last year, for example, with the terrific, very, very distraught floods that we saw in Pakistan, and the impact that that had across lives, livelihood. We are seeing the frequency of many of those events happening more and more, and a lot of times we're seeing more destruction. Sitting here in Manila, we do get our fair share of typhoons. They're now becoming across the year. They're less seasonal, and they can be very, very destructive, as we've seen in the past. For that matter, ADB is transforming itself into the climate bank for the region, for Asia Pacific. And for that matter, we need to change a lot of the ways we do business. The financial system has a very important role in that transition, and through events like this, I think we also learn from you and can help in terms of driving that change. In the first session today, in other words, this session, we will have what I hope to be a very exciting conversation on assessing, monitoring, and addressing climate-related risks in the financial sector, and looking at the international experience and options. I think that when we look at the impact of climate change, it can be analyzed through a risk lens, recognizing both physical risks in terms of the loss of infrastructure, property, and other assets that I referred to earlier, as well as, of course, the transition risks and understanding the value of such things as potentially stranded assets and the impact on the economy, and what will that be in terms of the impact on financial systems. When climate change impacts do materialize, we see physical and transition climate risks that generate potentially large economic costs. We can't be looking the other way when this happens, as these costs translate into, again, potential economic losses, including financial institutions. As such, the climate risks and financial risks are very much a clear and present danger. Climate risks also represent a potential systemic risk for the financial sector, so we need to be very careful monitoring that. And across the discussion, central banks, as you know, continue to debate whether indeed climate risks pose a risk to financial stability. In response, investing in mitigation and adaptation measures have been adopted in a big way across the Asian Development Bank in terms of helping to build climate resilient infrastructure as, again, the role of the region's climate bank. Pre-COP26, pre-Glasgow, our president, President Asakawa, committed to a level of ambition of $100 billion of own financing over the period 2019 to 2030. And this will also be coupled with our commitment to Paris Agreement alignment of our operations, starting 1st of July, 100% on the sovereign portfolio and 85% on the non-sovereign. So we are very much already gearing up, and we are developing a pipeline of projects that will have that Paris alignment. Let me also indicate that we recognize that there continues to be very significant financing gaps to address the zero goals that many of your countries, if not all, have already committed to, and it is indeed imperative to work together to mobilize public and private financing at scale under a multi-pronged approach. Public financing in no ways can meet the bill. We need to find ways to be able to mobilize commercial resources, financial private resources to complement a lot of the public resources that are going into this. In terms of financial markets and institutions, they are essential. They have an essential role in terms of funding many such things as climate-proof infrastructure, clean energy projects, renewables energy, and sustainable infrastructure writ large. And it does, and I think this is an important element, it does represent tremendous business opportunities across many countries in the region. There is a process where there will be an increasing move towards greater manufacturing of components of plants that are looking at renewable energy, that are looking at new technologies, and there is a very important consideration in terms of how Asia-Pacific can integrate further into that value chain and be able to continue to support that transition. If we look at the financial supervisors, regulators, and central banks, likewise, they will play a very fundamental role in this whole process. They implement, of course, the policy frameworks that enable financial institutions to provide the funding on such things such as the transition and adaptation. They must ensure that financial institutions adequately manage exposure to the climate risks and that the financial system is indeed resilient to these risks. Accordingly, financial institutions need to be front and center of the climate challenge in terms of both potential downside risks, including credit risk, but also in terms of the solutions as part of the efforts to use financial markets, as I said, to mobilize additional funding for climate. I would next like to touch on a slightly different subject, and that is the role of an international financial institution such as the Asian Development Bank and how it can support, or how we can support climate challenge and address some of the topics in this conference. I would like to therefore share some views on three areas. The first one is supporting regional supervisors. Second one is more on supporting supervisors' contribution to scaling up green finance. And third, ADB's role in supporting climate investment. And you may have heard a little bit on this before, but I think it deserves a little bit more discussion. So let me start by supporting regional supervisors. Climate risks are indeed financial risks, and as such, they fall squarely under the mandate of the central banks and supervisors. As such, the network of central banks and supervisors for greening and financial system, I will refer to it as NGFS for short, of which the Asian Development Bank is indeed an observer, has developed a series of recommendations that many of you are aware of for supervisors on how to address climate risks. I would like to share 4 such recommendations. First recommendation is on assessing and identifying climate risks for domestic financial institutions and the financial system. For that, supervisors need to develop a clear understanding of the sources of climate risk in their financial sectors, and of course, the transmission channels, the transmission mechanisms of climate risk to the economy and to the financial system. Methodologies are being developed to assess climate risks for the financial sector, and these still need to be further developed, fleshed out. And often what many of you will realize is that there is a scarcity of data. That makes things even more challenging. That doesn't stop us from building databases and being able to invest more in that. In addition, past observations are of limited use in the context of climate change. We can't look at history as a determinant of the future. This is something new. This is a shock to the system. However, methodologies and data are constantly improving and already provide useful guide and information for supervisors as well as financial institutions. Turning to the second recommendation, it's about developing and implementing climate risk management expectations for supervised financial institutions. This is a very important element. As you know, financial institutions' ability to manage climate financial risk is paramount to the resilience of those risks. Yet we know from survey work, initial surveys of risk management practices highlight that financial institutions are really not yet prepared to manage those climate risks. And I think that's a an important statement. Sometimes it may be considered a bit of a sweeping statement, but I think that there's a lot of merit in that. And largely it's because of what I mentioned before. The processes are not there, data is weak, and even tools need to be developed. So these are all important considerations as you look at what can be done in your countries. Now, against this background, international supervisors bodies like the NGFS that I mentioned earlier, as well as the Banking Committee for Banking Supervision, recommend setting supervisory expectations, again, going back to managing those expectations. So setting up supervisory expectations for financial institutions. And these need to be looked at. They should cover such things as governance, business and risk management strategies, but also such things as what we're doing at ADB, looking at scenario analysis and how scenario analysis can change, and even looking at stress testing of the portfolios, as well as, of course, increasing disclosure of such climate risks. So that's all, in some ways, important work that's ongoing that builds up that ability to better identify and assess those risks. International supervisory bodies also recommend engaging supervised entities in implementation of the supervisory expectations and, when needed, of course, mitigation measures. Let me now turn to the third recommendation. That's about support and implementation of climate risk disclosure frameworks for firms. So public disclosure by financial institutions of information related to their climate and environment risks significantly contributes to market efficiency. It ensures that market participants are, as well as supervisors, have adequate insight into the risk exposures, risk assessment processes, and capital adequacy for financial institutions. If I'm a financial institution and I'm lending to the next coal-fired power plant, you know there's a reality that over a life of a 20, 30-year lifespan, you may be stuck with some stranded assets, right? How does that follow or reflect on the balance sheets of the financial institutions? So this is a very important consideration. Several disclosure frameworks and guidance are indeed available to financial institutions, such as the Task Force on Climate-Related Financial Disclosures recommendation. We at ADB published our first one last year, our inaugural report, and it was very enlightening to have the whole conversation, discussion leading up to that publication. We are committed to preparing our second one for next year. There are also, in addition to the TCFD, we have the International Sustainability Standards Board and the draft non-financial reporting directive by the European Commission, among others. Supervisors want, of course, to help define such standards, and that's obviously the role of supervisors, and to ensure that the metrics they require are relevant for their tasks. And in this context, the disclosure of the transition plans is, of course, gaining increasing traction as key information about both the transition risk exposure of firms and their contribution to the transition process is shared with greater market participants. Fourth and the final key recommendation that I'd like to highlight is to implement appropriate climate risk mitigating actions. So as many of you know, at the micro-prudential level, climate risks must be accounted for in Pillar 1 capital requirements, and the Basel Committee for Banking Supervision has published, of course, guidelines on how financial institutions can implement these. Under Pillar 2, additional capital could be required for banks with inadequate climate risk management. Again, I don't know across many of our countries, developing member countries across Asia and Pacific, how far that discussion has happened or has taken place, but that's something that we need to continue to discuss. Climate risk mitigation measures can also be part of the macro-prudential policies as more and more supervisors acknowledge that climate risks are potential systemic risks, and therefore supervisors could engage systemic and concentration buffers as possible options. Let me now turn to the next item, which is supporting supervisors' contribution to scaling up green finance. So again, given the financing gaps that I mentioned earlier, there is a very important role of financial institutions to help mobilize those resources. So supervisors highlight that early and orderly action, which strongly limits the global temperature increase, is by far the best scenario for financial stability. Scaling up green finance is, of course, necessary, and we're doing that at ADB. Supervisors may wish to contribute to this in several ways. I think first, as economists, we recognize that incentives through regulatory requirements is a very powerful mechanism if done right. Financial regulators could reflect climate environmental considerations to support the greening of finance in the different regulatory tools at their disposal, such as, of course, regulatory capital requirements. One option suggested in this context is to support the green finance by reducing capital requirements for loans that fund projects aligned with transition to a net zero economy. This is the so-called green supporting factor. Alternatively, and perhaps a little bit, excuse me, a little bit more under question is, can supervisors increase capital requirements for loans and projects that work against this transition? So going back to the point I mentioned earlier, lending to, say, a coal-fired power plant. Some financial authorities, like the Hungary's central bank, have started experimenting with such schemes. However, at this early stage, empirical evidence is not yet available on the effectiveness of such schemes. They also raise concerns about side effects on financial stability and spillovers across jurisdictions. I know also a number of countries in Asia Pacific are also undertaking some pilots on this. Second, by supporting disclosure frameworks and sustainability reporting standards, we can see that climate disclosure is indeed crucial to mobilizing investment for transition by raising the visibility to investors in terms of opportunities in the low carbon space. So there's a lot of potential interest by private investors, but there's a lot of risks. And how can either financial institutions or international financial institutions rather can help in terms of removing some of those risks, and we'll talk on that a little bit later. So for this, the disclosure frameworks should provide information on the contribution, positively negative, of firms and projects to the transition, notably through disclosure of their transition plans and impact on climate change. So we'd like to see more and more financial institutions sharing those transition plans. Supervisors should also support such global disclosure frameworks, which increase, of course, the transparency to investors. That will help, of course, improve investment decisions and, amongst other things, reduce the risk of greenwashing. The ADB, of course, is contributing to this, and with this work, we are very much supporting climate-related financial disclosure. Third, through coordination with other authorities, supervisors are not able to be the sole or leading players in addressing climate change. Coordination between the government authorities is necessary, of course, to implement a comprehensive policy mix that allows the economy to enter a more virtuous cycle that significantly curtails emissions growth, boosts economic growth, and enhances bank stability. So we've got to get those policy decisions right to get into that virtuous cycle. Alongside supervisors, again, the Asian Development Bank is pleased to be able to work with other multilateral development banks to support coordination of such packages. Let me now turn to my final point, which is about ADB's role in climate investment. Again, we see tremendous opportunities, and as the bank, the climate bank for the region, we need to step up. Others are stepping up, and it's good to see that change happening. I think that as part of an IFI, I've been in this bank for many, many years. In some ways, I've never seen the excitement and the interest of working with ADB in this case in very many new areas for us. But we're here in the region, and we need to engage with others in this quest. So IFIs such as ADB have a key role, as I said, in terms of climate investment, both in terms of mitigation and adaptation. Adaptation, in many instances, is the harder one. Of that $100 billion that I've mentioned earlier, we've got about 2/3 going into mitigation, 1/3 going into adaptation. Over the years, ADB has expanded and refined its toolbox of instruments in support of climate finance. bolstering its claim to serve as the, again, climate bank for the region. In addition to the level of ambition on climate financing that I mentioned earlier of the $100 billion, we're also committed to developing transformational policies through such things that Junkyu mentioned earlier, the climate change policy-based loans as a dedicated instrument. The idea is to work with countries to be able to see how we can reach those net zero goals. Countries have already determined their NDCs, and we need to make sure that we're able to follow pathways that indeed deliver on those net zero goals and on time. So there's a lot of work that can be done in this area. And the policy-based loan helps to remove some of those distortions that exist in terms of policies across many sectors, energy, it could be, agriculture, and through the removal of those distortions, we can attract more private investment, amongst others, into these areas. The financing of policies outside of PBLs also is very important, and we've had a lot of discussions on such things as the financial intermediation lending modality. There is a lot that can be done, as you heard also earlier today. In addition, ADB has recently launched a very innovative debt financing vehicle called the Innovative Finance Facility for Climate in Asia and the Pacific, also known as IFCAP. It was recently approved by our board, and we launched it at our annual meeting 2 weeks ago. IFCAP provides an innovative means to partner with countries to be able to provide much greater financing for, in this case, climate change. What it does is basically it builds on guarantees provided by contributing countries that will indeed allow us to free our headroom and allow us to be able to leverage on those guarantee mechanisms to deliver more financing. We were talking this morning about the ratios with IFCAP. For every $1 in, we are likely to get approximately $5 in leveraged investment, so catalyzing resources. So that's a very powerful means that we have. It's also what we refer to as a public good. We very much would like to see other IFIs be able to build on this work. In addition to direct financing, of course, ADB is scaling up efforts to catalyze third-party public and private climate finance. And we've got an office of PPP that is also contributing strongly to this work. In terms of unlocking private climate finance flows at scale, we have many other instruments. We have, of course, our PCS, our preferred creditor status, that allows us to do a lot of interesting work, including syndication. We have the ability to act as anchor investments, given the long-term financing that we have, and also in terms of helping to support the markets through sustainability bonds, for example. Blending, leveraging grant resources is also a very important point. If we can blend to be able to catalyze more, why not? And we've got a lot of initiatives in that area. Risk mitigation, such as political risk and credit enhancement products are also part of the toolkit. We could go on. We, again, mentioned earlier creating enabling environments across countries, looking at strategic partnerships, including with GFANS, and of course, capacity building that was raised earlier on greening financial systems. So these are all part of the kind of the broader toolkit that we have at our disposal. And of course, events like this, where we can convene experts, we can convene government officials, regulators, and exchange ideas. So all very powerful. These issues, of course, will all be explored and discussed further during the roundtable and into tomorrow's sessions. So with these thoughts, if I haven't put anyone to sleep yet, I feel happy. If not, I'm sorry about that. Let us now move to the panelist session and listen to others and their perspectives on why financial institutions need to be front and center in understanding and assessing the climate challenges, and also in terms of the solutions on how to mobilize funding through financial markets and supporting the greening of our economies. With this, I wish you a very productive and enjoyable conference. Thank you very much. So now is where I ask my co-panelists to join me on stage. So we have together today a couple of panelists, which are I will introduce, but let me begin by asking our panelists to please take a seat. And then we are joined by many other panelists on the virtual stage. Okay, so I will begin by introducing to my left Lynn Javier, who is the Assistant Governor on covering policy and specialized supervision subsector at the BSP, Banco Central ng Pilipinas. Welcome. We're also joined by Mr. Mohammed Khurshid Alam, who's Executive Director from the Bangladesh Bank, the Central Bank of Bangladesh. Again, thank you very much for being here and welcome. I would like also to take this opportunity to introduce our virtual participants. If you are joining us virtually and if you'd like to put on the camera, let me begin by welcoming Mr. Fernando Restoy, who joins us from Basel. He is chair of the Financial Stability Institute at BIS. We're also joined virtually by Chris Faint, who is the head of Climate Hub Division at the Bank of England. We also have with us virtually Mr. Livio Straka, who is the Deputy Director General, Macroprudential Policy and Financial Stability at the European Central Bank. I believe I have not missed anyone. So with that, we are done with the introductions. So now we can get into more of the substance. So in this session, the idea is I get to pose some questions. Oh, very good. So I can see now some of our participants on the screen, so very good. Maybe just so that everyone can see, because we don't see your names all that well. Fernando, do you want to raise your hand? There you go, there's Fernando. Chris Faint, there we go. Hi, Chris. Livio Straka. Very good, so welcome. We can see you well. I hope you can see us, and more importantly, you can hear us. So with that, let us then go straight into the panelists. And the idea is to get a little bit your understanding on many of these important issues. How do you see some of these challenges from your respective institutions and your respective countries? So I am going to take the liberty to come to you in 2 rounds. So a first round, everyone will get a chance to answer some questions that I've raised, and then there'll be a second round. So if we can do this correctly, we should be able to close by 5 p.m. So we're at 3:30 right now. Okay, so maybe let us start with BSP and Lynn Javier. Lynn, what do you see as the main sources of financial risks that climate change and the transition pose to your financial system in the Philippines? And maybe how are the climate risks distributed in your financial system? If you can share a little bit on that. You can talk about banks if you want to discuss a little bit on the insurance side, credit markets and others. And maybe the last question in this round would be more about which financial policy measures are in place to support financial institutions in scaling up funding for the transition and adaptation investments. It's a lot of questions. Let's see which ones you would like to.
Yeah, okay. Hello, good afternoon. Thank you for inviting the Banco Central to be part of this seminar. So the Philippine financial sector is largely dominated by banks, so it's bank-centric. So the total resources of the Philippine financial sector, 80% of which is held by the banking industry. So having said that, the impacts of climate change, physical or transition, we have to look closely at the structure of the Philippine banking system. Now, in the Philippines, we have the large players and the small players. Let's talk about physical risk. So the small players, particularly the thrift and rural banks, they're located in the regions. Now, that includes regions that frequently experience extreme weather episodes. So we're talking about operational risk because also of the disruptions that they're experiencing in strong weather events. So with this, the impact of climate change is translated through credit and operational risk channels. Credit because the same borrowers are also located in those areas as well. Now, we're looking at the bigger banks right now. They also have touch points and branches in these regions also affected by extreme weather episodes. But they also do have exposures to sectors that make that might have transition risk exposures. So again, we're looking at credit risk. This is the reason why when the BSP issued their regulations, or regulations on the sustainable finance framework, we initially started with the governance expectations. I heard governance being mentioned earlier in this morning's panel. These regulations are actually anchored on earlier reforms implemented by the Banco Central. That is corporate governance reforms and having effective risk management systems. So we've set out responsibilities and expectations from the board of directors, senior management, as well as the control functions. And then we issued more granular expectations on risk, on managing credit and operational risk exposures as they relate to climate change. Now, beyond that, beyond looking at credit and operational risk exposures, there's also the aspect of financial inclusion. The BSP is promoting a financially inclusive and sustainable ecosystem. So let's look at Typhoon Haiyan, which happened in 2013. So it's it's the strongest typhoon that hit the Philippines. Yeah. So apart from ensuring that the affected banks would be able to immediately resume operation, we're concerned that households and businesses in that area would be able to get funds to rebuild their houses and to resume normal operations. So we could see that it also affects communities and economic activities in those regions. Again, looping back into the banking system, but that might affect also the levels of non-performing loans, et cetera, et cetera. So I guess what we're trying to communicate in adopting the sustainable finance framework in the banking industry is that change will not happen overnight. And that's very important, particularly if we're promoting financial inclusiveness, because we don't want to have unintended consequences also of abruptly adopting the sustainable finance framework, because this would mean banks cutting finances to sectors that have not yet transitioned. And the micro, small, medium enterprises and the vulnerable sectors would suffer from this abrupt or knee-jerk reaction. So we don't want that to happen. We've highlighted in our issuances the value of engagement, engaging your clients, engaging your other stakeholders in terms of the transitioning to the sustainability agenda. So I'll pause here, DG Bruno.
Thank you. Thank you very much. I appreciate those points. I know that with the typhoon, sometimes it's not so easy to get insurance. I know that a lot of times you've got a lot of difficulties in coming up with either parametric standards and so on and so forth. So we do recognize that probably the Philippines is as stretched as one can get in terms of natural disasters that are coming your way. But thank you very much for those points. I think that it would be good maybe in the next round to understand a little bit more what those timelines are in terms of the adoption of the sustainable finance frameworks and how do you see the key sectors coming through. Let me now turn to a representative from the Bangladesh Bank, and let me ask him, in terms of the microprudential measures, which microprudential measures, Pillar 1, 2, or 3 are in place, and 3 are in place to address climate risks in the financial sector in Bangladesh, and how do they compare with those in other countries in the region and more broadly the international standards? I'd like to hear your views on that. Thank you so very much.
Thank you. Thank you, Mr. Bruno. At first, I must give thanks ADB for selecting time-bound subjects for this conference for today, and also thanks for inviting us. Now, different countries are facing climate change risk. So all the governments, including Bangladesh, are looking for a way to mitigate these risks and try to prudential guidelines through Ministry of Finance and other related agencies, including Central Bank. I have a question. You have macroprudential measures. Regarding this, macroprudential measures tools usually used by the regulators to ensure the safety and soundness of the individual financial institution. These measures are organized into 3 pillars. Like pillar 1, measures, that is adjustment in risk weights, concentrations, limits, There are currently no specific capital requirements related to climate risks in Bangladesh. However, some regulators have started to assess how climate risk could impact banks' overall risk profiles and whether adjustment to capital requirements are necessary. I'm telling you about the general scenario. For example, the European Banking Authority has proposed that banks should conduct a climate stress test to assess the impact of different climate scenarios on their capital position. Number two, that is pillar 2 measures, supervisory review process and capital adds. Regulators are starting to include climate risks as part of their supervisory reviews. For example, the Bank of England requires banks and insurers to include climate risks in their risk management frameworks and to develop strategies to mitigate those risks. Number 3, pillar 3, measures disclosure obligations. Regulators are starting to develop disclosures requirement related to climate risk. I can give here an example. The Task Force on Climate-Related Financial Disclosures has developed a set of voluntary disclosure recommendations that cover climate risks and opportunities. Regulators in some jurisdictions, such as the European Union, are considering making TCFD-style disclosure mandatory. There are some difference in how different jurisdictions approaching the issues of climate risk. For example, the European Union has been at forefront of efforts to incorporate climate risks into prudential regulations with the proposed European Union suite of sustainable finance disclosure regulations requiring financial institutions to disclose how they integrate sustainability risks into their investment decision making. Now, in prospect of Bangladesh, I'd like to say that in the morning, my colleague, Mr. Chaudhary, has elaborately described the central bank position, especially our prudential guidelines. We have issues, lots of guidelines for sustainability, for green financing, how to mitigate the risk in the financial sector. You know, Bangladesh is a vulnerable country in terms of climate changes, as we have a coastal, huge, big area. Recently, we have faced partially Mocha, and it was devastating, but luckily we saved. Partially we have been faced, and there are a lot of damages. And regarding heat, we on the northern side of Bangladesh, huge heat was recorded this year, and other calamities every year we are facing. Considering this, central bank with the consulting with the government, that is Ministry of Finance, we are working for mitigate the risk and encouraging the banking sector to invest environment-friendly areas. Moreover, we are already working in green bond issue. A circular has already been circulated to the banking center for sustainable finance policy. They are implementing. And you know, Bangladesh is a Muslim dominating country. We have taken policies for the special area for this Sukuk bond, which is also related with the environment-friendly financing, and Sharia-based financial instrument regarding climate, that also been underway. So prudential guidelines from central bank with the Minister of Finance, we are taking it seriously, and we hope by 2030, we will be able to 50% of banking sector to green financing policy, implement green financing policy. Thank you.
Very good. Thank you very much. It's not by accident that we have representatives from the Philippines and Bangladesh, countries that are been very much affected by a lot of the climate-induced natural disasters. And I know that there's been a lot of destruction in terms of a lot of the infrastructure, loss of lives. So in some ways, the two of your countries are in some ways facing a lot more those risks than others. So in some ways you're at the front. Yes. Okay. So thank you very much, Mr. Alam, for that intervention. I'd now like to turn to our non-regional participants. I would like to now bring in the European Central Bank and Livio. My question to you is, how do the physical and transition risks compare in Europe? If you can share a little bit how you look at that from where you sit, and how are they distributed across the financial system in Europe? Do they constitute a systemic risk for the financial sector? And what are some of the macroprudential measures that are appropriate in your situation? Thank you.
Thank you, Bruno, and so good afternoon over there. And it's a pleasure to be in this event. And I'm sorry not to be physically in Manila, because I like very much the ADB headquarters in Manila. I've been there a couple of times. So probably I would say that Europe is not, due to geographical position, is not not yet, at least in the extreme, exposed to the extreme risk that you have seen in Philippines or Bangladesh. Although, of course, we have had, events right now. There's a big flood happening in northern Italy, for example. So it's not that we are immune, but probably in a less extreme way. Of course, the risk of not seeing the physical risk manifesting so evidently, of course, is also a temptation to postpone decisions and to see the risk as not as material. So there's also this concern as well. But I suppose that in Europe right now the focus is more on transition risk. As you know, the EU has a very ambitious climate agenda. So it really seriously aims to cut emissions to the in keeping with the Paris Agreement. And this will imply a very large change in the economic structure and also very large investment in renewable energy. So that will bring about a large change in the economy. And of course, the financial sector and we as regulators, supervisors of the financial sector, we are adapted to that reality. Again, without forgetting about the physical risk, which is also down the road, material. And there is so from the point of view of the ECB, which is central bank, a relevant discussion is also, should we look at this relationship as unidirectional, so the climate and the transition and physical risk representing a risk for the climate, for the financial sector, or should we also think about, how the financial sector can be used actively, to green the economy, and that is a discussion that we have internally. I mean, probably in many cases, there is a sort of divine coincidence that, by protecting the financial sector from transition risk and physical risk, you also contribute to greening the financial system. So in a sense, there is not a contradiction between these two elements, but there is also this discussion. So how far we should actively go in kind of shaping the financial system towards the green transition. And so there is a number of tools that we are considering, both the EU level, but as you know, there is a discussion, so, internationally in the Basel Committee and so on, whether, is it probably better to have macroprudential tools. In Europe, we have a macroprudential tool called systemic risk buffer. And this, we are discussing whether the systemic risk buffer might or might not be used for climate risk. So there is a discussion, but I would say that so far, most of the action has been on the side of supervisors, or macroprudential supervisor. So we have had a number of climate stress tests. So I would say the climate stress test is probably the chief tool now to address the impact of climate, both transition and physical risk on the financial sector. as you probably know, the Basel Committee now is a work stream on scenario analysis. The NGFS scenarios are also being adapted to the needs of climate stress tests. And let me also remind you that ECB is also sharing the NGFS scenario work stream. So, within the network of green financial system. So we are also open to your input, your feedback on what is needed in terms of the climate scenarios to be fit for purpose for climate stress tests. And one element that I wanted to mention briefly, because this was also covered by others, is the issue of supervisor expectation and supervision. So we in terms of the so SSM, our European-wide supervisor, we have been very active in terms of setting expectations for banks, in terms of business model, in terms of governance, in terms of credit risk. We clear deadlines, so we have some deadlines for the end of this year, other deadlines for the end of next year. We are implementing a new data tool, and also we're also carrying out a targeted review of the residential real estate, which is another kind of interesting area of work. How climate risk affects the residential real estate, the value of residential real estate. So this is probably where the Europe, most of the action is happening right now. I mean, in none of these, none of these actions have a direct impact on bank capital, but they might in the future. So it's not excluded that that this kind of supervisory guidance, if the banks don't comply with it, it's not excluded that in the context of Pillar 2, this could not translate into additional capital requirements. I mean, for the time being, we don't see it, but it's not excluded either. And just my last point, I mean, we also recently carried out the so-called economy-wide climate stress test, which is a top-down. So normally we do supervisory climate stress tests, which are bottom-up. So the banks will come up with the results, but we also have stress tests that are top-down. So we do the work and we test the banks, we stress the banks based on the data, of course, from the banks. And so we have done this in a new version, the second version of the economy-wide climate stress test, which is will be released soon. And there we also have new scenarios. So also new methodology. I guess the general message which comes out from this stress test in Europe is that the impacts are not yet very material. Okay? In particular on the upside in terms of risk, and also banks are not yet well prepared. They don't have the internal controls, the governance. So the banks are lagging behind. And this is where we are pushing them the most. Thank you.
Thank you very much. Most interesting insights, Livio. Appreciate that, and I would love to be able to engage further on those stress tests for the interest of the participants here. But maybe we can turn a little bit to that later on. Let us now turn to Bank of England. Chris, what is expected across commercial banks in terms of climate risks management that you oversee? Do financial institutions meet supervisory expectations? Again, going back to that question in terms of climate risk management, and what is it that they need to do more of and better of? Let me turn it over to you. Thank you, Chris.
Thank you. Well, also thank you for inviting me here today. Sorry I can't be there in person. My diary just didn't allow it, but it looks like a great event. So what I can do is I can provide a bit of perspective on what the Bank of England has been doing in this space, which, Pablo, it builds on some of the points that you've been making and the other panelists have been making. But let me just dig into some of the supervisory work that we've been doing. And maybe I'll just focus my comments in two main areas. The first one is the supervision work we've been doing, the supervisory expectations. And then I can dig into a little bit more detail about the work that we've been doing on regulatory capital, thinking through some of the bigger questions on if and when regulatory capital is an appropriate tool to manage risks. It's actually been some time since we've been looking at supervisory work. So I was kind of surprised to see that actually it's been 8 years since we started talking about the financial risks in firms that we supervise. And we issued our first supervisory expectations, it was actually 5 years ago in draft form. So they've been around for some time now. And when I say we issued them, we issued them to all of the banks and insurers that we regulate. So that's over 1,000 firms. And we decided to do that because whilst the largest firms will have the most complex exposures that they need to understand, actually some of the smallest firms with regional concentrations or concentrations to certain sectors can actually be materially impacted. So since that time, over that period, what we've been doing is seeking to ensure that those firms are embedding an understanding of climate risks. And this is a really hard space for us to supervise because in most areas, when we set expectations for firms, we say, this is what you need to do. This is the end state. This is the date by which you need to have delivered that end state. You can't do that in this space because we don't know what the end state looks like yet. The tools and data aren't available to get to the end state. So instead, what we're supervising against is firms making sufficient progress over time to ensure that they deliver ambitious progress, and we're supervising that progress rather than actually supervising adherence to the end state. So it's a very, very different type of supervision. Over the last couple of years, we've undertaken a number of different reviews, and we've also undertaken our own scenario analysis, which allowed us to really dig deep into the largest banks and insurers. And I think it's fair to say that what we've seen is across those largest firms, there has been a significant investment in the understanding of climate risks. So there has been a moving on in their understanding, but we believe every single firm has some way to go. So we think that every firm needs to continue to invest and needs to make more progress. And by that, I mean, they need to ensure that they're developing their tools, their toolkits, they're embedding climate into the right discussions, and they're making sure that those discussions are impacting their strategic decisions going forwards. And if anyone's interested, we issued a Dear CEO letter in October last year, and that listed our latest thinking on some of the best practices that we've seen in firms and some of the practices where we think firms could go a little bit further. But if I just broaden out a little bit, I think it's worth us taking stock of why it is a challenge at the moment for firms to embed risks and the roles that each of us have to have in building up this understanding of risk. So the first one is obviously the firms. They need to continue to invest in capabilities and embed climate across all of their operations. For us as regulators, the central bank, we need to ensure that we are developing our supervisory practices. We need to be holding firms to account, but also I think we've got a really important role in helping firms to understand these risks and develop those capabilities. But really importantly, and I think this touches on a point you made, Pablo, there's an important role for governments here. In the UK, the predominant risk for us is from transition risks. And as an example of that, heating buildings represents just under a fifth of the UK's greenhouse emissions. So in order for it to meet its net zero commitments, you're going to have a huge amount of investment in retrofitting houses. But there's analysis that says if you retrofit houses, that can lead to some impairments because of the cost of retrofitting houses. So for firms, for banks to understand what that impairment risk profile looks like, they need to understand from governments what the trajectory of that transition path is and the role that the governments will have in helping to fund those pathways. And that's just one area. That's just one set. That's just one part of one sector. There's also the travel sector, the automobile sector, all of these sectors. So government has a really important role in delivering this. But there's been a number of headwinds to over the last couple of years, to put it lightly. So government bandwidth to do all of this has been limited. You could say, well, in the absence of government bandwidth, in the absence of government clarity, we should just wait. But we cannot do that because the net zero target is not moving. The carbon in the atmosphere is continuing to grow. So what we're saying is firms need to be really bold. They need to make judgments on what those paths will look like in the future, and they need to continue to determine what transition means for their institutions in the absence of government policy. And then when government policy comes, that will help the situation. And then just, I think the last point, and maybe this is a nice precursor to some of the points that Fernando is best positioned to speak to, is the role of the international community in helping to drive consistent, sensible standards, both in the regulation that we undertake, but also in the disclosures that we have. If we don't have sensible regulation, we're going to have an inconsistent playing field. And if we don't have good disclosures that are consistent, we're not going to have all the information that we need to understand risks. So I think that's the ecosystem that we need to see building up. And just as a last point, Livio touched on the role of regulatory capital. This is a huge question. What is the role of regulatory capital? When is the appropriate time for firms to hold regulatory capital? Talking to the member from the Philippines' point before, at what point is it right to use regulatory capital to mitigate risks, balanced against the role of regulatory capital, the incentives that regulatory capital could create that might actually disincentivize the transition to net zero? That's particularly important at the macro-prudential level, but is also relevant at the micro-prudential level. So at the Bank of England, we did a lot of research on this over the last year. We put out a paper earlier this year. I haven't got time now to speak through each of the findings, but very happy to come back to that. But what we've done is we've raised a number of questions that said it's really important to get to the bottom of the role of regulatory capital, but we need to be very careful. We need to think about all of the considerations that come with holding capital, resilience, and incentives, and the role for net zero. I will leave it there. Thank you.
Thank you very much, Chris. You've raised some really good points. Makes us all think a little bit how far we have to go in this pathway. Very, very good. The role of government to incentivize those changes, the transition pathways, incentives or disincentives, etc. So really good to hear those points, and hopefully we can come to some more of those during the questions and answers. Let us now turn to FSI. Fernando, it's good to see you again. Is there a case for macroprudential policy in addressing climate-related financial risks? If so, what are the challenges and trade-offs that authorities will face when designing and implementing such policies? And sitting where you sit, you also have a lot of contrasting cases that you see. Is there anything, some good practices that you would recommend to our participants here in Asia? Thank you very much.
Okay, many thanks, Bruno. Pleasure to see you again. I'm delighted to participate in this conference and this particular panel. I mean, what is the role of regulation here? I think there is broad agreement. I think the previous speakers have actually confirmed this, that the climate-related financial risks, both physical and transition risks, can potentially affect banks' safety and soundness. So they can indeed actually amplify the credit market and operational risks associated to banks' exposures to firms and sectors directly affected by climate developments, but also by the policies aiming at reducing carbon emissions. So there is no doubt that the current macro-prudential framework needs to evolve to fully take into account those climate-related financial risks. And the FSI, we have been actually looking at the issue. We believe that in principle, the most promising avenue is to do this by adapting the Pillar 2 supervisory review process. That includes, by the way, the formulation of supervisory expectations that you were stressing before, Bruno, and certainly also relying much on Pillar 3 disclosures. In what respects capital, we feel that, while Pillar 1, in particular minimum capital and liquidity requirements, might play a role, it might not always be the best suited instrument to address risks, such as climate-related financial risks, which typically materialize over long and uncertain horizons. And I think it's more or less in line with what Chris was suggesting before. What about macroprudential policies? Now coming back to your question, Bruno. In fact, if something is really macro, it's certainly climate. And based on that, there's a natural inclination to immediately accept that implications of climate-related financial risks on financial stability should be addressed by macro-prudential policies. But I'm afraid that things are not that simple. Let me try to explain why. Standard macro-prudential policies typically aim to preserve financial stability by meeting two objectives. First, increasing the resilience of the financial system, together, of course, with the micro-prudential framework to make it able to face the materialization of macro risk. And second, containing the actual accumulation of systemic risk. It's not only about actually increasing resilience, that could be done as well with the macroprudential framework. It's also about trying to mitigate those potentially systemic risks. For example, when addressing the risks posed by microfinancial imbalances, such as excessive credit growth or housing bubbles and financial instability, standard macroprudential instruments, such as, say, the countercyclical or the sectoral capital buffers, do contribute to both objectives. So by increasing capital requirements in good times, banks become more resilient, leaving loss absorption capacity that can be used when the cycle changes. At the same time, those additional capital requirements produce disincentives for banks to continue lending, thereby directly contributing to mitigate the macro financial imbalances that would generate a financial stability. So those two objectives are clearly addressed by standard macro prudential instruments when facing macro financial imbalances. But the standard macro prudential instruments aiming at addressing climate-related financial risks, think about the capital loans on specific dirty exposures, those instruments indeed support banks' resilience in respect to the materialization of climate-related financial risk. But unlike the macro actions aiming at containing macro financial imbalances, the climate-related financial risk-oriented macro instruments might not help much to reduce those risks and could exacerbate some of them. For instance, a Brown penalization factor, I think you mentioned this before, Bruno, Brown penalization factor for capital requirements will normalize, reduce new available funding for Brown industries. While this could be in principle the desired objective, this action will normally deteriorate the credit quality of existing exposures and make it more difficult for affected borrowers to get the required financial resources to transition to more sustainable business models. By those two unintended effects, climate-related financial risk-oriented macro policies, if not carefully designed, could well increase rather than reduce transition risks. Notice in that regard that using a green supporting factor rather than a brown penalization factor is unlikely to be of much help to avoid unintended consequences. At the end, a more favorable regulatory treatment of certain exposures in relation to others will still move lending away from dirty firms, no matter what they do with those funds. And at the same time, that regulatory subsidy for green exposures will, by definition, imply lower capital coverage of the intrinsic risks of all borrowers classified as green, thereby increasing the potential for financial stability issues. So in order to mitigate these potential side effects, authorities need to carefully define the scope of application of such macroprudential policies. For instance, rather than focus on capital requirements for existing Brown exposures, regulators could focus on new lending by banks. In addition, authorities will need to discriminate between new funds to maintain the current business models from funds used to make firms' activities and production processes more climate friendly. In other words, the focus of regulations should be to penalize funding of dirty projects rather than dirty firms, and in particular, transition funding for currently dirty firms that aim to become cleaner should in no way be penalized by macro-prudential policies. So arguably, all those refinements entail substantial operational complexity. So the attempt to distinguish between new and old lending requires difficult decisions on how to treat credit renewals, pre-approved credit lines, or refinance operations. But more importantly, the identification of green projects requires a potentially costly assessment and monitoring of borrowers' strategies, business plans, and in particular, their ability and willingness to assign a specific funding to the developments of concrete projects. In any case, I think that while accepting this an operationally complex task, I believe that failure to overcome these challenges may render such macroprudential policies ineffective and potentially counterproductive for financial stability. Therefore, we believe that until there is capacity to apply macroprudential tools in a sufficiently precise manner, there could be arguments to focus regulatory attention in a macro dimension, namely to ensure that individual banks put in place a solid strategy to identify and properly manage their own climate related financial risks in order to remain safe. So let me stop here, Bruno.
Thank you very much, Fernando, for all those points. Very good. It's been a fantastic first round of questions and answers, and I think that it's probably raised a lot of questions for many of the participants. We usually, and unfortunately, leave the questions till the end, and by then, a lot of times we've run out of time. So this time around, I want to flip it, if I may, and open it up now to some questions from the floor or from some of the panelists to other members, and then we can return to the last round of questions that I have. So let me invite anyone who would like to raise any points now. There's been a lot of really interesting ideas that have been put forward. Anyone, please come to your mic and just introduce yourself and indicate who you'd like to raise any questions or comments to. Is someone? Oh, sorry, Livio, I see your hand up. Is that right?
And thank you. Yeah, so I have a bit of a comment on what Fernando just said, is which is also reflects very well also our internal discussion. Of course, the issue of the transition is very important. In Europe, for example, we have this taxonomy of green activities that has also been agreed politically. And there was a lot of discussion, on whether certain sectors should be, nuclear, gas should be, not, green or not, and so on. Of course, we see the risk that this kind of taxonomy is also, used in a too static way. And while as Fernando said, what we want to do is to accompany the transition. The question is a little bit, okay, so some people say, given this, then we need to use pillar 2 because the supervisors are better able to see, project by project in a forward-looking way, whether you are financing, a brown firm or a brown project or a green firm, a green project. Yeah, so that's I guess the question is whether this is true or not. It's more this question rather than the question, is this a micro or a macro prudential? So a pillar 1 instrument, even in a macro prudential setting, is open to the same criticism as a macro prudential, in principle at least, as a macro prudential instrument. So the real question is, how important is the discretion of each supervisor and the knowledge of each project, as compared to something that is applied in a blanket way using some taxonomy. I mean, note that also in Europe, we also need not to undermine the taxonomy also. So that's an additional also constraint because, we can also not say, the taxonomy is irrelevant also. Yeah, so it's not an easy combination. Thank you.
Thank you very much. So, Fernando, I think that one is to you. Rules, discretion, and anything else you want to add. And then we have another question by Junkyu. So maybe we'll take the second question, and then we'll open it to Fernando and anyone else.
This is sort of very good time, and to
introduce yourself.
Yeah, to somebody and who is a little sleepy in this afternoon session. My name is Junkyu Lee. I'm Chief of Financial Sector Growth. I think our DG is very wise enough to put this comment session. It's in the middle of our discussion. Actually, this is very interesting, the discussion and regulatory capital and also the macro potential policies. And I have a question for Chris for regulatory capital, and also I have a question for macro potential policy to Chris and Livio both, and the Fernando and Livio. Actually, first one is Chris mentioned, if I'm here correctly, in incentives of the regulatory capital might incentivize some transition, and if I hear it correctly, and so this, this kind of regulatory capital, so it's what will be the incentives of disciplining this regulatory capital? What will be the mechanism you want to highlight and to incentivize the transition? Because what we discover here, everybody agrees that importance of transition even in Europe, its transition is very important. We think it is Asia as a transition is very important, and this is a new discovery. Is happy to discover. So, if there are many options, but regulatory capital plays a role and to incentivize this, the transition. I think that will be also the very interesting side. And if you elaborate a little more, and that could we learn the lessons or your insights. And then to Livio and Fernando, actually the capacity of implementing, designing, implementing capacity and of macroprudential policies is very important. But the end outcome might be different. For example, Asia, many countries is an issue of the foreign exchange and their exchange rate issue, right? So depending on specific target from the beginning, and if they don't have, inadequate capacity in terms of designing, in terms of implementing, the end outcome might not be that kind of thing. So certainly affect exchange rate. And we don't want to see that, volatile exchange rate situation in Asian context. So in that case, and how much do you think it is the capacity of implementing design is very important, and how we can raise that capacity also? And, is there any specific ways, and it's including just policy dialogue and things like that, and what others you want to recommend and for this one? Thank you very much.
Very much, Junkyu, for that question. So maybe we can start with Fernando on Livio's point, and then go to Chris on Junkyu's first point, and back to Livio and Fernando for the second point on capacity.
Yes, thanks. Thank you, Livio, for the comment on this. I cannot agree more with you in terms of that sometimes actually the separation between macro and micro is a bit artificial. But this happens even in the regular macro-prudential policies, those which are basically trying to address macro-financial imbalances. Particularly when you focus on one of the two actually main objectives of macro-prudential policies, which is increase resilience of the financial sector, right? A good macro-prudential supervisor has to pay attention actually to macro development, to the extent those macro developments could actually affect the safety and soundness of financial institutions. And therefore, a good microprudential regulator would have actually to introduce potentially capital add-ons if they feel that there is particular exposure to those macro developments. So this is not very different actually to the macroprudential policies when macroprudential policies focuses on this actually resilience objective. Of course, things become different when you actually want something else, which is try to mitigate actually the actual risk, the actual macro risks, by actually sort of somewhat steering or providing incentives for banks to move their credit policies in a particular direction. Is where this is something, of course, which is not the role of macroprudential policies, could be seen as a role of macroprudential policies. Indeed, is the role of macroprudential policies. And this is the one, this important, the most interesting actually objective of macroprudential policies, the one which is particularly challenging in the case of climate-related financial risks. That is actually what creates the complexity that you need. It's not only information, it's not only data. Of course, we need a lot of that, but more than that, actually, you will need actually sort of to make sure that you are actually sort of applying the right instrument for the right objective. And sometimes by just simply that penalizing actually sort of brown exposures across the board, this is something which is not going a good job, particularly more respects transition risk. Let me put you on a very clear example, right? Now we have the CBA has just actually proposed, actually they use some sort of indicators, sort of green asset factor, whatever, or green asset ratio, or something of that sort. So we have to be very careful about that, because of course, the taxonomy used to classify what is green, what is brown is pretty much firm-based. So that rate, you can hardly actually sort of incorporate all these nuances and the relevance of specific elements, such as actually a firm which is brown now wants to become actually clean. For that, it needs actually finance. So this type of very sort of relatively simple indicators, while it can actually help sort of increasing awareness, at the same time, it's true that it incorporates some elements that could actually create the wrong incentives, could actually create some distortions, could, at the end of the day, may not facilitate actually sort of availability of sufficient funding to for actually sort of support an orderly transition to a more sustainable economy.
Thank you, Fernando, for that.
So if I may here, Bruno, because on this question and second question, let me just mention, I think I cannot agree more with the importance that this question, the person who actually made this question actually attached to training and capacity development, and that is key. And we are very proud. The FSI actually, we are coordinating basically the training arm of the network for the Green for the financial system. There are a number of activities in that regard, including so-called climate train alliance, which puts together actually initiatives taken by different jurisdictions, by different regulators in that particular domain. That is key. Of course, there are many initiatives that can be taken in different parts of the world. We are actually supporting many of them. And also, what is important, of course, not only about training personnel, but also to have the right culture, to adapt the right culture in the supervisory organizations. So this tone from the top, actually, to be fully in line with the relevance of the climate-related financial risk and how this may actually change a little bit the mindset of regulators which are on the field.
Thank you very much for that. And maybe that gives me the opportunity to ask our physical participants in terms of the capacity development constraints, say across the three pillars. How do you see that from where you're sitting? What are perhaps some of the areas that you feel are getting greater traction and others that you feel that capacity is limiting your abilities?
Sorry. No. Building capacity within the supervisory body and as well as its regulated financial institutions is actually a challenge. But since we anchored, for instance, our regulations on earlier issued risk management guidelines of the BSP, it brought more clarity as to our expectations into managing this. Having said that, I think that would facilitate feeding assessment into our Pillar 2 assessment. But for Pillar 1 per se, that would be, we are actually looking at developments in the standard setting bodies as well as in other jurisdictions in this space, and see how this would impact as well exposures of Philippine banks. For Pillar 3, we would subscribe to the disclosure requirements of the International Sustainable Standards Board, and that would be an automatic adoption locally. But in terms of measuring actual GHG emission, wherein you could anchor your targets for reduction, that's one area where we need also collaborative engagements with development partners as well as regulators from other jurisdictions to see what approach or what would be more suited to the jurisdiction, to our jurisdiction.
Good points. Mr. Alam?
Thank you. Regarding capacity building, you look the countries, developing countries especially like Bangladesh, there are lots of problems in the banking sector, right, and financial sector. But this area is very much new. Climate change is issues for those countries. There are a lot of issues to get priority other than this. But nowadays, it is important for all the nations to have climate risk. If you want to build capacity, especially this area, we need support. I think not only Bangladesh, all the developing countries, they need capacity support, technical support from the development partners. So when we will be able to get this capacity building support, then I think Bangladesh, all the developed countries will be able to have capacity building, and they will be able to contribute in this area a lot. Thank you.
Thank you very much. Maybe we can turn to Chris on Junkyu's question on incentives for regulatory capital to facilitate that transition, recognizing there's still a long ways to go. Any further thoughts on that one, Chris?
It's a great point, and I think it goes to the core of some of the considerations that we have. So governments are incentivized to ensure that the transition happens. As a central banker, my incentivization is to ensure that risks are managed and do not crystallize in an undue way. And actually, the Bank of England it's got two remits. It's got a micro-prudential supervisory remit, which looks at the banks and insurers that we supervise. And within that one, our key focus is just ensuring that risks do not crystallize. So in a way, we're relatively ambivalent to the speed of transition as long as risks are managed. But we also have a financial stability remit. And in our financial stability remit, it is very clear from the scenario analysis that we and others have done that the longer you wait for a transition to happen, the more disorderly a transition is, the greater the risks in the system. So with that remit, we are very clearly incentivized to ensure that there is a smooth transition. So we need to balance those things. But I think there's a really important point about maintaining the integrity of the microprudential regime. The risk weighting regime, the capital regime, was put in to ensure that risks are managed and capital is held against risks. Essentially, if you start adjusting risk weights for green supporting factors, penalizing factors in a way that's not directly linked to risks, you are creating incentives that go outside of the original intention of that regime. And it could actually create a dangerous precedent, because if you do it for climate, there's you could argue there's a good reason for doing it for climate. Why not do it for other points? And then it could just exacerbate. So we're very within the Bank of England, we think it's important that we have a risk basis to any adjustments that are made. So in terms of using that regime to incentivize transition, we don't think it should be manually adjusted. But we do see that there is a role of regulatory capital in incentivization. So we think that firms need to look into the future, as with any regulatory capital or risk analysis, to determine what risks will arise, not just in the next 6 months, not just in the next year, but 5, 6, 7 years ahead. So they should be thinking about the near to medium term risks that could crystallize, and then they should be adjusting their risk frameworks, adjusting their investments in line with that. So that means that firms should be actually leaning into transition to the extent that it is happening to the short to the medium term. But the challenge is that might not help to incentivize transition that goes beyond that term, goes beyond the regulatory horizon. So it would be surprising if they were taking actions now that would maybe look at risks that could crystallize in 15, 20 years. And maybe and we wouldn't be totally supportive of that if they were. So there's a delicate balance in terms of incentives that we need to manage here. But we think it's important that that doesn't trump the integrity of the regime that was developed over the last 10, 15 years. Thanks.
Thank you for sharing that. Some possible unknown unknowns out there, right? I have a question from Lynn to, I think.
Yes.
Please go ahead.
Just one quick question. Taxonomy is an important rail in promoting the sustainability agenda, not just to identify sectors that are actually aligned with our sustainability agenda, and also I guess for capital charging purposes. But there are several taxonomies issued across the globe. Is there scope for, say, regulators to come with common ground to ensure interoperability of this taxonomy? This would also promote comparability of, say, capital charges or financial indicators across the globe. So are there discussions on, say, mutually recognizing taxonomies issued by different jurisdictions to promote comparability and ensure that when we talk about green, it's really green, regardless of the jurisdiction who issued the taxonomy?
While we allow our panelists to think about that, mull over that, we can take maybe one more question, and then let's turn it back to the respondents. I believe you had a question, yes, and then followed by you. Yes.
Me, Chaudhary Liakutali, Director, Sustainable Finance Department. As you know, as a macroprudentials, disclosure obligations under Pillar 3 is very much important. As we also know, the TCFD, Task Force for Climate-Related Financial Disclosure, has developed a set of voluntary disclosure recommendations the cover climate risks. My not answer asking to the Eastern Governor, what is the scenario in Philippines regarding the TCFD guidelines issues?
Okay. The BSB regulations on 1085 actually provided some minimum disclosure requirements, governance, risk exposures, and risk management on ESG-related risk. But we basically anchored our requirements on the disclosure requirements of the Securities and Exchange Corporation, so as not to make it onerous for banks in terms of coming up with their disclosure reports. Having said that, we have an interagency body called the Financial Sector Forum. It's comprised of the BSP, SEC, and Insurance Commission. So after the issuance of the International Sustainability Standards Board of the disclosure standards, automatically that will be adopted by the financial sector to have one common, robust disclosure requirements across the financial sector.
Good, thank you very much. Let's take that next question, and then we'll come back to Lynn's question.
Thank you so much. Ernst Rauch from Munich Reinsurance. Let me try to add an angle from a risk management company. So first of all, thanks for the fantastic interventions of the panelists here in the room and online also. I have a question on physical risks. We as an insurance or reinsurance company, we do see the changing frequency and intensity of losses from weather-related events very clearly, and we heard this several times this morning and in the afternoon or so. So now when it comes to financing long-term projects, be it mortgages or loans or infrastructure projects for 20, 30 years or so, the chances are high if in a warmer climate, and that's by the scientists what they tell us, certain locations deteriorate with respect to the underlying hazards. So probabilities for flooding or for droughts or cyclones are changing or so. How much is this on the radar of those who are working on regulation, especially on capital requirements? Thank you.
Okay, so we've got the question from Lynn, and we've got the question from the gentleman from Munich Re, who would like to take these questions. Any volunteers? I'm looking at our virtual panelists in particular.
I can start if you want with the taxonomy.
Yes, please.
So as far as I know, as Lynn said, there is no coordination on taxonomies, and also it's also true that key emitters don't have a taxonomy at all. Like, so as far as I'm aware, the US does not have a taxonomy. China does not have a taxonomy. And also, I don't know if this is discussed still actively in the, there is a working group with the G20 on sustainability. So I'm not aware of how active this is still discussed in the G20. But as we discussed before, the more fundamental issue is that taxonomy has limitations. In the EU, the taxonomy, you have to keep in mind that it's only a designation of green activities. It's not a designation of brown. So you cannot say this activity is not in the taxonomy and therefore is brown. So this is only a designation of green activities. So there is also this plus is static and so on. I also had a comment on the. I mean, there was one question before on the exchange rate. If I understood correctly, the question was whether climate-related regulation would affect the exchange rate. Just to mention that there is an interesting working paper by Galina Hale precisely on the impact of climate risk on exchange rates. So I mean, I don't know what this paper says, but I know this paper exists. So those who are interested can read this paper. It's precisely about the link between climate and exchange rates. Thanks.
Now let's go to, I believe, Chris, followed by Fernando.
Yeah, thanks. To the point on physical risks and the relationship with long-term investments, it is on our radar, and we are thinking about it. To develop a better understanding of how risks might arise over time is one of the reasons that we're undertaking these scenario analyses. So the exercise that we did at the bank and the one that Olivier talked about at the ECB, these are exercises that don't just look 5 years into the future. They look 3 decades into the future. And what they seek to understand is how, under different physical risk and transition risk pathways, risks might arise. Now, to be absolutely honest, these exercises are embryonic. There's lots of gaps in them. They've been done for the first time. We've learned a lot. But what we are saying in the UK, and I know elsewhere, to banks, insurance companies, is this is the kind of capability that needs to be built up to help understand how risks might arise and to help the fight to price investments over longer periods. And one of the one result from our scenario analysis that might be relevant here is that when you looked at all of the scenarios for banks and insurers, the greatest losses came from the asset revaluations of life insurers over a 3-decade period. And those asset revaluations, a lot of them were driven from physical risks, from changes in the business models that would be necessitated from physical changes. So it is on the radar. I would be lying if I said that there's a really good understanding or framework for thinking through all the different possibilities of risks that might arise. But that framework is developing. And I think it is something that we need to develop sooner, because what we cannot have is a situation where, one, long-term investments are mispriced and we start to see significant write-downs in the future, or two, even more dangerously, long-term investments start to dry up, because that will have broader issues, particularly at the system level. Thank you.
Very interesting point on the asset revaluation, in this case on the insurance companies. Fernando, I think you have a hand up.
Yeah, basically to follow on a little bit what Chris said about this second question, I think it's very, very interesting, because actually it clearly raises important issues and trade-offs. I mean, that we all have actually when looking at regulatory policies, right? I mean, certainly if you talk about the prudential framework, how the prudential framework should evolve in the future in order to fully take into account actual implications, climate-related financial risk. I mean, it's clear that by definition you will have some sort of regulatory action in respect to exposures which are more subject to say physical risk in the example. So it's clear that the prudential policy can only actually sort of somewhat introduce additional constraints actually for the financing of some projects in the future, right? And this happens on the asset side, but on the liability side, well, it's clear that this physical risk in particular, basically makes even worse the current protection gap for physical events, right? So this is actually what is there. So the point here is how to address those issues, right? I mean, because of the new climate environment and the evolution of prudential policy trying actually to incorporate some safeguards in relation to climate-related financial risk, there could be some side effects that we should all take into account in terms of financing on one side, protection gap on the other, right? The issue is how to address this. And I think it is a mistake, actually, just to ask regulators to compromise a little bit, not to be too stringent, because at the end of this may actually have side effects on the economy as a whole. No, you need actually other instruments. And those instruments basically are, government policies that should certainly complement actual regulatory policies, and are the ones which actually should be the responsible policy areas in order to facilitate this smooth transition. A way which is very complex, which has plenty of trade-offs, but I think the solution for those trade-offs will not be to overburden regulators with too many objectives, because they don't have the instruments actually to be able to do that.
Thank you very much for that, Fernando. Good point on the trade-offs. I'm going to now see, unfortunately, my battery has run out, so I don't know if there's any questions coming in virtually. If there's anyone who has access to that, and if there are any questions from the virtual world, please do help me out. And if not, we can, in the meantime, maybe go to the last closing round. We have another 15 minutes to go. So I take it that there are no further questions from those today in the audience. If that's the case, maybe we can go to the last round of questions. And if you feel that some of these questions may have been covered and you want to talk about something else, you have that freedom. So let me start this time with Bangladesh Bank. So how should the policy framework around the financial sector evolve to achieve the objectives that we're discussing? Maybe from a financial stability perspective, do supervisors have an interest in supporting the transition policies? Is there a kind of a clear direction given the capacity constraints that we've discussed, given the large potential natural disasters that you face in Bangladesh with floodings and so on and so forth? What do you think is a realistic goal in some ways that your financial system can help?
Sorry, again, please repeat.
So my question is now looking at it from the point of view of sitting in Bangladesh, you've heard a lot of the discussions earlier. What is a feasible set of objectives that you feel you can build on, recognizing capacity constraints, but at the same time recognizing the real losses that our participant from Munich Re was mentioning?
Thank you. Yes. Bangladesh is a flood affected area almost in this rainy season. We face every year loss. In that case, regulatory body as of central bank, we usually assess the damages and on that time, and we that formulate on the basis of damages by the floods or other calamities in the country, and we give waiver or delay of repayments of the clients or special programs by central bank and government as a whole. There are many social programs also there from the different ministries of the government of Bangladesh for support those victims of floods or other calamities. And central bank in the financial sector gives support to the banks and financial institutions by giving special fund or soften the rules or delay to repayment the loans, or sometimes waiver, including principal, and by supported by government fund. Thank you.
Thank you very much. It's almost asking for another conference where we bring in the fiscal authorities with the supervisory authorities and see how they work together in addressing many of these challenges.
In that case, financial, fiscal policy and or monetary policy, we just give priority in the total development of the vulnerable group. So in that case, again, we propose the government for support through fiscal measures, and government come forwards. In that case, government raise special funds from fiscal under fiscal policy, and side by side, Bangladesh Bank also from their monetary policy under monetary policy program, there are some programs, special programs, so that they become benefited, the vulnerable group especially, and as well as we also see the inflation. Otherwise, if we supply money, soft money, there will be effect negatively in the on the market, and ultimately they will be loser. So central bank also careful for adopting monetary policy also. Thank you.
Thank you very much, Dr. Alam. Maybe Lynn, turning to you. Again, we've seen the many disasters that have struck from a kind of a scenario analysis, business as usual. How much has that changed over the past few years? You mentioned at the outset Typhoon Haiyan. If there is a country where that mindset is now looking at different scenarios coming in a big way, has that made the big shift, or is it still a kind of a business as usual, but with a little bit of an incremental pathway?
Actually, when you look at the impacts of climate change and we look at the different scenarios, that would again depend on the country context. I mean, the level, your economic status, your contribution to global GHG emissions, and your level of climate risk. We've run some stress testing exercises under the FSAP mission, Financial Sector Assessment Program mission. It's a physical stress testing scenario. And based on the result of that scenario, under extremely rare typhoon event, the impact on the GDP growth would be systemic. But the capital in the banking system would be able to manage it, considering also the reforms implemented in the past. But I guess having said that, beyond again the scenario and stress testing analysis that we're conducting, the policy framework should be robust as well. For instance, as prudential supervisor, the policy framework first should be aligned with national government aspirations and commitments. We cannot say that you have to go green or promote sustainability agenda if, say, the energy plan is not aligned with this one. Second, we have to have that mandate to implement it. Since we recognize that this risk pose serious safety and soundness concerns on individual financial institutions and to the financial stability, then we have to manage this risk in the financial system. Third, we have to issue regulations that are proportionate and strikes a critical balance between promoting effective risk management and then allowing financial institutions to actually see the opportunities in adopting the sustainability agenda.
Very much. These are good points. Maybe that's a segue to question to Chris, Bank of England. How you mentioned a little bit the role of government and how it can facilitate that transition planning. To what extent do the supervisors need to speak louder to governments to help that process, or how do you see this unfolding? As we move forward and bearing in mind the points that were raised earlier on this transition pathway.
So, what a question. So I think it's really important that we as supervisors, both the institutions and the system, make it clear to government what some of the risks are of different transition pathways. And that's what we've done. That's what we've done in the UK. So we've flagged what I think governments already know, that if you've got a deadline for getting to net zero, the sooner that you get to the sooner that you start to transition to net zero, it's likely that the lower the risks will be. So we're working with government on that. But there's a number of different ways that we can have useful engagements with governments. A really key one, and the UK will not be unique in this, is that in order to deliver some of the structural changes that we need in our economies, you need a patchwork of different institutions to undertake a role. So in the UK, what we're looking to do is is to embed a sustainable disclosure framework that will significantly increase TCFD aligned disclosure and likely ISSB disclosure in the future. To do that, we need government to make changes. We need the listing authority to make changes to those firms that are listed. We need the prudential authority to utilize their Pillar 3 disclosures. So coming together in those groups is really important, and maintaining a fluid dialogue. And I guess one last point that I do think it is worth drawing out is that through this transition, there will be some impacts to some parts of the economy and individuals that will be suboptimal. And it's really important that those like us that have the ability to see where those impacts might be coming, speak to those that have the policy powers to be able to mitigate those issues coming, so they can then take that action. Really good example of this is that it's likely that as floods increase, the cost of mortgages and the cost of insurance of properties in flooded areas will also increase. that could actually have an impact on the equality of mortgages, which could actually have a social impact. We cannot make policy to impact that. It's not for us, but it is our responsibility to speak to governments so they know about this and they can take appropriate action using their powers. So yeah, I think dialogue across a number of different areas is not only it's not only nice to have, it's absolutely essential.
Thank you for those points. I have a next question, which is, I think, a too broad a question, Livio. So I'm going to go a little bit off script, and if that's something that makes sense to you, please let me know. But one of the points that we haven't discussed too much about is the data that is required for the modeling on the part of the banks in the Euro system. I guess that is something that is important, and I guess like many areas we're looking at constraints. Is there anything that you would like to share with our representatives from BSP and Bangladesh Bank in terms of how do we look at the data question? What any tips, any lessons? You don't have the data. Do you work with some more generic data? How do you build that whole process? We haven't touched that. I know sometimes it's not as sexy as other things, but any thoughts on that, Livio?
No, thanks for the question. I hope you can hear me because actually I have some connection problems. I don't see your videos.
We can hear you, but we can't see you.
Okay. Sorry for that. I don't know. I mean, I'm connected from the office, so in theory, there shouldn't be any network problem, but I don't know. Anyway, I hope we can hear me anyway. So I guess the data issue is complex because my impression is that also from colleagues who work very hard on these issues is that actually there are a lot of data out there, and there is also the risk that the data problem is used a little bit as an excuse. So on the one hand, one should not overemphasize the data limitations that are there, because if you look hard enough, data is in particular on scope 1 and scope 2 emissions, are now widely available. There is a variety of sources, so I don't think that there should be a kind of a crippling factor. But there is certainly an issue. There's certainly an issue with scope 3 emissions measurement. We see it even in our own institutions. I mean, even in in central banks, it's hard to measure scope 3 emissions. And generally, there is a big issue of data harmonization. So different jurisdictions have different data and so forth. So my impression is the problem is more a question of harmonization and simplification rather than absolute scarcity.
All right, thank you.
Data. Because again, so if you look hard enough,
okay, I think
data find the relevant data. The question of lack of data necessarily, but I don't know about the emerging markets, to be honest. So it may be different in some emerging markets.
Okay, I think we got the gist of your points. It faded away a little bit at the end, but yeah, I think it's the lesson is not to feel that you can't do much, and obviously not to be the pretext for not trying new things. My last question then goes to Fernando. Again, from a financial stability perspective, any new ideas that are coming into that framework on the part of supervisors that support the transition policy? Any kind of new thinking that may still be work in progress that is worth sharing in this forum?
Okay, thanks for this. Of course, supervisors have a genuine interest in sort of contributing within their mandates, of course, to facilitate a smooth transition towards a sustainable economy. Basically, because this obviously supports the financial stability goal. That said, I think my conviction, it could be very too orthodox on this, but I believe that the best contribution the supervisors or regulators can do in order actually to facilitate this transition is precisely to preserve the safety and soundness of financial institutions, because this transition is going to require a huge reallocation of resources that could only be actually possible with the adequate contribution of financial institutions. But for that purpose, the financial institutions have to remain obviously safe and sound. So I think it's not that we have to modify the current mandate of financial regulators. Is that actually we can even strengthen the dedication of financial regulators to this very basic and core objective of preserving the safety and soundness of financial institutions. And this is not actually sort of an easy task, as we have been discussing. There is much to be done. There are important changes that have to be adopted in what respects the regulatory framework, probably more important given the supervisory framework. And this is hard enough, actually, just to be able to develop the adequate adaptation of the current regulatory and supervisory framework in order to be able to preserve financial stability in the new context, in order for this framework to be able to address the huge, actually, challenges that climate developments are posing, actually, for the economic and the financial system altogether.
Great. So on that note, recognizing the magnitude of the challenge ahead of us, we bring this session to a close. Before doing so, I'd like to thank all the great panelists we've had. Mr. Mohammed Khurshid Alam from Bangladesh Bank, Lynn Javier from BSP, Livio Straka from European Central Bank, Chris Faint, Bank of England, Fernando Restoy, FSI. Thank you so much. It's been a very stimulating time. We've been able to get a lot of good insights from everyone. I pretty much enjoyed every minute of it. I wanted also to thank all of you, all the participants, for joining us. I'm sure there's a lot of food for thought. We'll hopefully be able to discuss further on the sidelines. And again, maybe thank both the Christine, Junkyu, and the teams for organizing this great session. So on that note, thank you to all. And for those of you here, we hope to see you this evening. Thank you so much, and have a nice evening.
Thank you.
We start today's session with three interesting presentations. I was just browsing the newspaper headlines today, and the World Meteorological Organization, in its State of Climate update, I found has warned that there is a 66% chance that average temperatures will exceed or increase by 1.5 degrees Celsius for one of the years between 2023 to 2027. So the only silver lining in that report is that it says that it does not mean we will permanently surpass that threshold. So possibly they have in mind is the Paris Agreement, which will prevent it from happening. So what they mean is we need to be prepared. Forewarned is forearmed. And today, in the second of the final day of the conference, we will be discussing about preparing for a prosperous, inclusive, resilient, and sustainable future, which is the tagline of Strategy 2030 of ADB. Before we start the session, too, let me welcome the Chief of Finance Sector, Junkyu Lee, for a short recap of day one and look ahead of the events today. Thank you.
Thank you very much. Good afternoon, everyone. I hope that all of you guys had a very good lunch today, and also in following our very productive session yesterday, and we also want to have a very good session today, and a lot of good topics. But basically, I'm just want to welcome everybody and back to this conference on the title. I just want to remind you one more time in greening financial systems and the role of MDB and IFIs. And as you know, this is a very crucial topic, and we all strive to respond to the climate crisis. As just mentioned, the newspaper browsing, and I think we set a very high bar in our discussions yesterday, including very specific options like how to work together with the existing financial institutions and including Green Investment Bank or regional development banks and other, the national development banks, and also the very specific policy discussion. And so I just want to before I get into a little bit of summary, and I just want to extend a special welcome to member of the Board of Commissioners of the Indonesian Financial Services Authority called OJK, and Pak Inando Dizazadi. And actually, he just joined today, and I think so I really should give my special welcome. And where is, I think he is around, right? Oh, okay, all right, okay, thank you. And then also His Excellency Undersecretary Pen Tirong and Cambodia Ministry of Economy and Finance is here, right? Was there? Okay, thank you very much. And as always, and my great accolades, and actually should also go to our finance colleagues and making this wonderful the conference, useful conference for everyone. And I noted with a particular interest yesterday's discussions and raised some excellent points. We heard from both our Managing Director General Woo Chong and Director General of SDCC, Bruno Carrasco, both repeatedly say that the huge need for innovative approaches and investment, such as Green Investment Bank yesterday, it's a heavily topic, and in climate change adaptation and the mitigation requires participation from the private sector. And as you know, we have a private sector session separately lined up. And session one, we discussed importance of regulators supporting for the economy and finance transition to net zero, including green taxonomies and also the international coordination on the taxonomies and climate-related stress testing, importance of this climate-related stress testing, and also the status of those stress testing, and as well as micro and macro-prudential policies and the framework, and pretty much, you know, the green macro, green micro, climate-related the risk framework, and measures and disclosures, and so-called the Pillar 3 and Pillar 2 together. And so the discussions about regulatory capital, it was very interesting yesterday, and including the green supporting factor and role of the international community, and I believe it is very, very useful. And we want to continue to have that discussion and very useful to our DMCs. And we also learned that complementary action from government development institutions and regulatory authorities are all needed. It's not just one side story, and we all need to work together. And all three can help provide a guidance that firms and financial institutions need in determining how they can contribute. And the first two can both catalyze and contribute to new funding in numerous ways. And today, pretty packed schedule, and so we got to run very fast, but we want to be running very effectively. And I want to say that we have a very impressive group of financial authorities and experts lined up. And I want to say really very impressive group, and in terms of their expertise and their hands-on policy making and the market experience. We will closely examine the role that multi-development banks and international financial institutions can play in ensuring financial systems are resilient to the expected climate risk. And our other broad theme will aim to expand on the role that multilateral development banks can fill in putting financial sectors in our region on a sounder footing, and how the private sector can tap into these efforts. This afternoon, we commence with session 2 with our Vice President Ahmed and to moderate. And the session 2 will bring together senior officials from our region, supervisory and regulatory officials from Indonesia, Republic of Korea, Japan. All will join peers from Cambodia and Kazakhstan. And I think this is really promised very live discussions and useful discussions. Among the issues likely to come up is financial institutions' public disclosure of their own climate and environmental risk. And clearly, with more detailed information in this area, we can give market participants insight and into the risk exposures they need to manage and the disclosures they need to mandate to expand market efficiency. Supervisors and regulators can support each action with guidelines to companies on how and what information to disclose. And this will expand pricing power in financial markets for financial risk and give companies tools to better prepare for a low carbon economy. And this discussion, I am sure, will help set the stage for our two final sessions. One is for MDBs live discussions, and the other is private sector. And I really look forward to, I'm also looking forward to participating in one of a panel session and with other MDB colleagues. And we will do our best and to make our, the MDB session is very, very effective and useful. And also, the private sector session, which is the last session, but very important session, and this will bring us very exciting roundtable. And this one, I believe, this private sector session and can leverage and these and other multilateral development banks to support the transition to net zero economies and advance our fight against climate change. I think you remember, and I said yesterday, and the Wizard of Oz and the famous word, as Alice said, and we are not in Kansas anymore. And not only we are not in Kansas anymore, if we don't take an action right now, our generations, next generations, our daughters and sons, and they will not be in Kansas anymore. It's a very different world, so we got to handle very urgent mind and actions. So ladies and gentlemen, I wish you a very excellent day and stimulating discussions. And so let's gear up. Thank you very much.
We must run fast and we must run together at the same time. Thank you, Jung-kyu. Session 2 will be on how supervisors and regulators in Asia are supporting green financial markets. This should provide fascinating insights into how Asian supervisors go about confronting the challenge of making their financial systems greener in terms of managing climate-related financial risks and getting financial systems to scale up climate investments. Let me welcome our ADB's Vice President for Operation, Mr. Ahmed Saeed, who will moderate this session. Thank you very much, sir. The floor is yours.
Sorry, let me just begin again by welcoming everyone and expressing our appreciation for you joining us here at ADB. And thank you again for joining us for this session on how supervisors and regulators in Asia are supporting green financial markets, and a special thank you to my fellow panelists. My name is Ahmed Saeed, as was just noted. I'm Vice President for East Asia, Southeast Asia, and the Pacific here at the ADB. Now, we all know that much has been written about the role of financial supervisors in fighting climate change. This is a topic that has been explored in many venues, including the NGFS and other international supervisory bodies. I think that many of us in this room would concur with the assessment that climate risks, whether they're physical risks or transition risks, can clearly become financial risks, and as such fall squarely within the mandate of supervisors, whether that's to assess and identify these risks for domestic financial institutions, whether that is to develop and implement risk management expectations for supervised institutions, whether that's to support and help implement climate risk disclosure frameworks for firms, or whether that is to support the implementation of risk mitigating actions where appropriate. Supervisors must take mitigating measures when financial institutions do not adequately manage risks of any sort, including climate risk. That is, of course, their central responsibility. Up until now, supervisors have not taken steps, such significant steps on climate risk, but they're clearly, and in a thoughtful and considered way, beginning to explore both the necessity and the possibility. We know also that climate risk mitigation measures can be incorporated into macroprudential policies as more and more supervisors are acknowledging that climate risks are potential systemic risks. Systemic buffers and concentration buffers will also, of course, be options that supervisors could consider. Against this background, it's interesting and timely to take stock of where Asian financial supervisors stand in this regard, to compare experiences with each other, and to share lessons from other countries. I will not say more advanced countries, because I think that that is a presumption that has to be proven in this context. In particular, as to how to address possible challenges in implementing these various recommendations. And before introducing this session, and just by way of mentioning, in case anyone considers these topics, at least at a theoretical level, to be settled, I would just note that just last week, actually just a couple days ago, I happened upon an article in the Financial Times referencing some recent statements from Federal Reserve Governor Christopher Waller, who expressed his view that there's no need for central banks to pay special attention to risks to the financial system from climate change because there's no obvious danger to financial stability, at least in the near term. I share that with you not necessarily to concur with it. I, in fact, don't agree with him, but just to say that there are people still asking sort of foundational questions as to these very, very important issues. So let me begin. I'm very, very pleased and excited that we're joined by this extremely distinguished and insightful panel. And I'll just introduce them very briefly, beginning from my left. Satoshi Ikeda, thank you for joining us. Ikeda-san is the Chief Sustainable Finance Officer of the Financial Services Agency of Japan. We're also very privileged to be joined by Anar Sadikova. She's the Head of Prudential Regulation Methodology Division of the Department of Methodology and Prudential Regulation of the Agency of the Republic of Kazakhstan for Regulation and Development of Financial Markets. That is a very long title. I'm sure your comments will be worthy of it. Next, after that, Inarno Jajadi, Chief Executive of Capital Market, Financial Derivatives, and Carbon Exchange Supervision in OJK, the Indonesian Financial Services Authority. His Excellency Pen Thirong, Undersecretary of the Cambodia Ministry of Economy and Finance. Dr. Kim Kwang-il, Director of the Fair Market Division of the Korea Financial Securities Commission. And I'm also very pleased to mention that we have with us online Bushra Shafiq, joining us virtually, who is the Senior Joint Director, SME Housing and Sustainable Finance Department at the State Bank of Pakistan. Thank each and every one of you for joining us. And let's dive right into it. So let me just begin by opening questions, but before that, remind the audience that we will be reserving some time for Q&A from the floor, and please do use the Q&A chat box. We'll be coming to those questions towards the end of the session. So let me begin, Your Excellency Pen Thirong, with you, if you would permit me. Could you share with us the needs in terms of sustainable investments in order to achieve a successful transition in Cambodia? Thank you.
Thank you, VP Ahmed, for the question put to Cambodia. You see, I divided this into 2 or 3 points. Number one is about the policy commitment of the government, the high level of policy commitment from the government, starting from, you see, the public sectors, the banking, as well as the non-banking sectors. In the public sector, there's a commitment, the high-level commitment of the policy, that we have the strategic plans, whatever you call it, it's a roadmaps, 2013 to 2030 on the climate change action. It was adopted in 2013. Along the time until now, and recently, late last year, our government adopted the 6 principles of the Coalition of Finance Minister for Climate Action, Helsinki, 6 principles. I don't need to mention the 6 principles. So we are member of the Coalition of the Finance Ministers for Climate Action. That's at the policy level. Then point number 2, how could we or can we mainstream or incorporate such kind of requirements or commitment, policy commitment in our country system? So there's public sector, there's a private sector, and private sector, there's a banking sector and other non-banking sectors. I'm from the Ministry of Economy and Finance, so I will not know in detail in the banking and non-banking, but just to say a few words on banking and non-banking. We have central banks, and central banks always endorse. You see the proposal of the bankers, commercial banks, to go for green financing projects. And for the non-banking sectors, banking sector, we have also the Bankers Association, which Banker Association also work closely with, you see, under the regulators of central bank, and they also raise the awareness and encourage, you see, the implementation of the policy commitment of the governments in terms of green. So they support the green financing activities or projects also. In the public sector, we have also the what we call SERC, the Securities Exchange Regulators of Cambodia. I mean, Cambodia Securities Exchange. So they just adopted, you see, the handbooks for green bonds issuance, I think in corporate bonds sector. So it's part of the Ministry of Economy and Finance structure, but it's a regulator to for government for securities, for bonds, capital markets in general. So this is the policy commitments and the implementation of policy commitment gradually. Of course, due to the massive budget requirement to implement the green projects, then we just set policy and then implement the policy gradually based on the capacity of our budget. On public sector, under the public financial management reform agenda, number one, we usually have modernized our system by using the ICTs. Of course, we usually improve or we modernize our tax collection system from manual to the ICTs or digital tools. So you don't need to bring the cash to pay to the general tax department. You can also use the digital tools to pay a tax also. That's also helpful. FMIS business process have been adopted by the government, by the PFM reform agenda to do that. Under the public investment management system reform strategy, we have the regulations at the government's level. Then we invited also the IMF, World Bank to review our public investment management cycle to incorporate the climate change action into elements into the project cycles. So all this has been assisted technically and financially from the MDBs, especially the ADB. So I would like to take this opportunity to thank the ADBs. I think since time is very limited, I should stop here and then give a chance to others. Thank you very much, VP Ahmed.
Thank you. Thank you very much for sharing that overview and perspective from Cambodia. Anar, could you share with us how you are approaching and how you believe financial institutions can provide some of the funding that will be required, and which financial institutions are best placed to do that? Thank you.
Yeah, thank you very much. First of all, on behalf of the Agency for Regulation and Development of the Financial Market of Kazakhstan, I'd like to express my gratitude for inviting us to this conference. It's very exciting and to share experience and to exchange opinions with all the participants. So as we know, the transition to sustainable development and increasing the share of green financing in the economy is one of the key trends, key global trends at the moment. So to this end, Kazakhstan has taken an approach of phased-in approach of implementing this ESG principles in the financial sector. So today, Kazakhstan has formed all the necessary legal environment for issuing green bonds and to develop green financing, basically. In 2021, a new environmental code was adopted, which introduced the concepts of green financing, green bonds, green projects, and also the taxonomy, so the classification of green projects to be financed through green bonds and green loans. The taxonomy itself was approved by the government in 2021, and it provides for separate categories in which the green projects are grouped, like renewable energy, energy efficiency, clean transport, green buildings, pollution prevention, etc. Along with this, the state policy is also aimed at the moment at stimulating decarbonization and providing support in the form of fiscal, financial, and other support forms, basically, for this kind of projects. The use of funds through the issuance of green instruments is seen as one of the ways of implementation of sustainable development goals under the ESG standards at the moment. So the government also provides for certain measures like subsidies for bonds that are being issued on the Kazakhstan Stock Exchange and the Astana International Exchange. For the further development of the green financing market, last year we approved a law which provides for legal framework for issuing and for the circulation of this kind of green bonds in the Kazakhstan Stock Exchange, based on the recommendations of the International Association of Capital Markets Association. These are basically the green and social bonds and sustainable development and related development bonds. So the target areas for the use of funds from the placement of these bonds have also been fixed. They are specifically targeted to environmental, ecological protection, socially significant projects. And also to prevent the cases of misuse of funds that are basically from the placement of these ESG bonds, we've also introduced mandatory procedures for mandatory verification, which is to be done by the external auditors or external consultants, international financial organizations, basically that have experience in this kind of verifications with the ESG bonds. So the practice-wise, since 2021, we've already had 12 issues of ESG bonds for a total amount of more than 171 billion tenge. The issuers were the Eurasian Development Bank, the Asian Development Bank, the Development Bank of Kazakhstan, and also some quasi-public entities of Kazakhstan. Another important aspect that I want to mention now is the creation of the necessary methodological environment for financial institutions. Currently, because some of the big Kazakhstani banks are already reporting ESG-related information in line with the GRI standards, but still we have smaller banks that are not very familiar with the ESG standards and principles, and also with the need for managing, monitoring, and identifying this kind of risks. That's why at the moment we have also been working on setting some guidelines for the financial market participants in terms of information disclosure, in terms of risk management practices, and corporate governance practices as well. The guidelines are based on best practices like TCFD, GRI standards, or the Sustainability Accounting Standards Board. And basically, we've already published these guidelines on the official website of the agency. This year, the financial market will be complying with these requirements on a voluntary basis. And then further in 2024, we plan to move from voluntary disclosure to mandatory disclosure of information. Apart from that, we also want to integrate this ESG risk management practices into the annual supervisory review process. And also we are, right now we are formulating some stress testing scenarios for climate risks that will also be part of supervisory stress testing processes. So yeah, this is basically a short review of the experience of Kazakhstan.
Thank you for that. That very robust and wide-ranging set of initiatives. Thank you for sharing that. Mr. Jajadi, if we could turn now to Indonesia, perhaps you could share with us what supervisors like OJK are currently doing to help financial institutions scale up sustainable investments, and perhaps you might also share with us some thoughts on how ADB could help. Over to you, please.
Thank you, Mr. Ahmad Sayed. Let me just take a few moments to thank ADB for having me on this prestigious event. To begin with, at the SEAD Symposium last March in Bali, Finance Minister Ibu Sri Mulyani has mentioned that based on a study, total climate finance required to achieve Indonesia NDZ in 2030 is 281 billion US dollars. While to achieve the net zero emission target in 2060 will reach almost 7 times as much as the need for 2030 NDC. While the government establishing innovative financing mechanism through blended finance, from the financial sector side, in particular the capital market sector, we have been doing several efforts to support financial institutions in scaling up sustainable investments. We develop financial instruments that are ESG compliant, like green bond and green funds. We develop guidance for financial institutions in implementing sustainable principles throughout their business operation and investment. An omnibus law was just enacted in January this year, and it is clearly regulated that sustainability shall be implemented within all aspects of the operation and investment strategy of all business entities in financial sector. We promote sustainability reporting, especially among issuer or listed company. We establish the taxonomy, Indonesia taxonomy. Version 1 was launched in January 2022, and version 2 will be soon. And we strengthen the awareness and build personal value among domestic investors in investing in ESG-based instruments. So they will become part of the transaction process, and this is also very important. Lastly, Indonesia issued a national policy on carbon market to accelerate the achievement of NDC commitment, and carbon exchange is expected to be launched this year, hopefully in September live, and it will be under OJK supervision. Next, how can MDBs contribute to this process? There has been a long record of contribution from MDBs like ADB in joint effort with the government to mobilize financing to accelerate the transition process. MDB's contribution also goes to national authority like OJK to support the policy development and the building of authorities' internal capacity, and also assist in building the capacity of the market. And I believe support that can be provided by MDB like ADB is not only in terms of financing, but also in terms of expertise related to policy, system, infrastructure, technology, and many more. I think that's all for my answer. Thank you.
Thank you very much for those very succinct and comprehensive set of thoughts. Dr. Kim, perhaps you could share with us what FSC is doing also to support financial institutions in scaling up sustainable investments. And I understand you have some slides for us, which we'll put up on the screen. Thank you.
Thank you, Vice President. My name is Kwang Kim from South Korea government. I prepared a short slide for you. Along with the global society, Korea is trying to make a transition to carbon neutrality. Please, next slide. Recently, we set up some policy directions to promote such a transition. So today, I will briefly show you some of them. First, next slide, please. Firstly, we are reorganizing funding flow to sustainable activities. Now we are reducing the investment in brown industry and increasing financing in green sectors. Especially, Korean government are adjusting the proportion of sustainable investment by working with state-backed financial institutions. Our goal is to expand the size of loan made by state-backed financing institution from $20 billion to $100 billion by the end of 2030. We are also defining objectives and category of sustainable investment, like utilize the taxonomy system. We worked closely with the other government body in South Korea and create our own green taxonomy systems that minimize greenwashing in South Korea. Effort on the way to make sure that the works well within the financing industry. We also set out a green finance handbook to provide a kind of guideline in the finance sectors. We are also in progress to form a condition to promote a sustainable investment by revising stewardship code. You may know that stewardship code is a set of rules that institutional investor must follow in order to responsibly manage its capital. Also, Korean exchange, stock exchange, create a sustainable investment benchmark. This led an increase in index-linked ETFs in field of sustainable investment in South Korea. Next slide, please. Secondly, we are creating a sustainable investment infrastructure that focuses on ESG finance system. We are gradually making ESG mandatory disclosure starting in 2025. We'll make sure that all the KOSPI listed firms publish a sustainable report by the end of 2030. In addition, we also make a ESG rating and data more transparent. You may know that the purpose of a ESG rating system is to rate performance of firms' ESG activities to help investors make right decision. In Korea, there are some concerns about the transparency of a ESG rating. So we are preparing a set of measures that will enforce rating agency to set up for their own internal control standard to prevent this kind of bad negative effect. Also, we are strengthening the management of climate risk in the finance sectors with distributed guidelines, as well as conduct climate risk stress tests on banking sector to measure financial industry's exposure to climate risk. Next slide, please. Lastly, will strengthen ESG capacity of financial sectors. We ask the financial institutions to create ESG division within their organizations. We also encourage education and IR activities. Finally, we also promote knowledge sharing of green finance. For example, Korean Exchange is running a sustainable investment platform in which users can obtain all the kinds of information on the sustainable investment. Lastly, we are trying to enhance international cooperation. Korea serves as a member of a Sustainability Standard Advisory Forum, SSAF, of IF Foundation, to contribute to make a global standard of discourse system. Personally, I am serving as a representative of Korea of this advice group, SSAF, of IF Foundation. Foundations. This is a short picture of current policy measure in South Korea. Thank you.
Thank you very much. And then the last person here on the panel before we go virtual, Ikeda-san. We heard, I think, some very interesting comments there about how one changes the mix within investment portfolios, and perhaps you could build on that and share with us a perspective from Japan FSA about which financial instruments will be very promising in support of the scale-up of green finance. Thank you.
Thank you for that question, Ahmed, and also thank you for having me at this very important event. Well, fellow panelists mentioned already green bonds, and that's a typical case for greening the financial markets. And that's, as you already know, that the use of proceeds type instrument, and that is very closely linked with the development of green taxonomies. And other possible option is the sustainability-linked bonds or loans, which could act as a kind of a policy-based loan that ADB provide for the third country. But in the case of sustainability-linked bonds or loans, it's with the company. So company promise to do something and target something, and investor monitor the progress. And if the company fails to fulfill that promise, there's certain penalty. So if that the target is set in the way that certainly promote the green transition of the company, that will promote the greenness of the overall economy in the end. But I think the matter is not necessarily the choice of instruments. Rather, I think the design of the instrument. For example, in the case of green bonds, we often hear the certain criticism because, well, some small portion of the company activities is separated out for the issuance of the green bonds, but maybe the rest of the company activity remain brown. So that is not necessarily a desirable course of action for greening the economy. So we need to make sure that the issuer in entirety will move towards the greener operation, a greener business strategy. So in that case, the issuance of green bond itself is not necessarily a good way to go. Rather, we need to go into details of the overall company strategy. So maybe sustainability-linked loans and bonds are a good option. But again, in this case, if that certain sustainability-related targets are set in a lenient way, that could go against the whole purpose of issuing sustainability-linked loans. So I think in encouraging the desirable design of each financial instrument which truly promotes the green finance, in the case of Japan, we issued a certain supervisory guidance for the financial institution to fully engage with the issuers so that overall their company strategy will be well aligned with the certain climate targets which set by the Japanese government. And so in setting that kind of expectation of financial institutions, that will cascade down to the overall financial activities of the banks and other financial institutions in Japan, so that the the borrower companies or investee companies eventually align with the overall climate goals set by the government. And in designing that kind of greening element of the financial instruments, probably UK government's efforts in setting a certain labeling for funds is also probably a helpful course of action. They set a certain 3 categories of labeling for the ESG funds, and one of them is sustainable improvers. That is intended to capture certain climate transition improvement efforts by companies, so that the fund flows really contribute to the a change of business and the change of the business strategy by the companies. So I think when issuing a certain financial instruments, going for green bonds and sustainability linked loans, that is a good choice. But I think in a deep dive of the issue requires the proper design of such instruments, so that the issuance of those instruments will eventually lead to the greening of the economy. So that's my comment. Thank you.
Thank you very much for that. And last but certainly not least, we're going to go online to Bushra Shafiq. We're sorry you couldn't be with us in person, but very pleased that you're able to join us virtually, and we can benefit from your perspective. State Bank of Pakistan has been playing a very important role, one that's been quite noted in recent years, in driving the successful implementation of green banking initiatives. I understand you formally launched a sustainable finance framework, including the green banking guidelines. Could you share with us a bit of that story and how it's facilitated financial institutions and helped them to identify and finance green projects and help them to do a better job of reporting on their green finance portfolios? Over to you. Thank you.
Thank you very much. And thank you very much for inviting us to this conference. And as you mentioned, unfortunately, I could not get the visa on time and could not interact with you physically. And it was now coming to this question of our journey of launching different regulatory framework regarding green or sustainable finance and the reporting of the financial institutions. That I think it's very important for me to share with you all that Pakistan, as you know, that Pakistan is one of the most vulnerable countries to these climate events. And this has made us to prioritize or categorize our priorities even within the main focus of the sustainable finance. So in 2017, when we issued our green banking guidelines, which is like a mother document, and it was covering all 3 major aspects. It was covering risk, so integrating risk into the core risk of financial institutions. Then the sustainable finance, we wanted financial institutions to enhance the sustainable finance. And third is the sustainable operation, which is related to their own impact reduction. But when the events of these climate-related events, the frequency of these climate-related events has risen, so this has made us to focus more on developing the resilience of the banking sector. In 2002, with the help of the IFC, we have issued the ESRM manual, which is the Environmental Social Risk Implementation Manual. And here we have the major focus was on building the resilience of the financial sector. And very importantly, we have included the social sector, social risk in this overall framework. With this, when we have issued this ESRM manual, we have also developed the monitoring and evaluation template, which is coming from the international standards like TCFD. As we have just issued it in the last year, November, so we are expecting that by end of this year, we will be getting some data which will help us to come up with some mitigations and monitor the financial institutions in a better way. As far as regarding the enhancing green financing is concerned, I would also like to share that on the product development side, we have another scheme which is known as the refinance, which is the financing scheme for the renewable energy. It is prevalent in the market since 2017. And under this scheme, we are offering subsidized financing to the end customers. And this scheme has been very, very successful. It has provided financing to almost 2,400 projects, which is equivalent to capacity of 1,660 megawatts. So these are the major initiatives which we have undertaken. However, we know that there's a journey that has just started and we need to work more. So in our roadmap, the other two things which I would like to focus is, one is that we are in a very initial phase of that we have to develop the taxonomy, and it is our next milestone which we want to achieve. We have at the central bank level, we have started doing some stress testing, but it is at very, very initial level. And that's another thing which we would like to incorporate in our as our next milestones. So that's broadly, these are the initiatives which we have taken over these last few years. Thank you.
Thank you. Thanks very much for sharing that perspective. I see we've got about 12 minutes left. And Arup, should we go to questions or maybe we'll go to questions? Okay. And do we have some questions online? Or should we just call from the audience? Okay. Gentleman in the back, please.
Thank you for great presentations and insight about your counter cases. My name is Rustam. I'm from Central Bank of Azerbaijan, leading Financial Stability Department. Recently, we adopted Sustainable Finance Roadmap and started to implementation. A few challenges that we faced while preparation and implementation, I would like to get your insight about that. First of all, when we talk about sustainable finance, besides environmental, there are social and governance, and we had a difficulty in quantifying and converting specific actions of the social and governance aspects. So if you have any some hints for us in that case, how to convert these objectives to measurable specific actions. And second, when we look at awareness, we understand it's very important. Besides the awareness in financial sector, it's important to have the awareness of the private sector, I mean households and MSMEs, because there should be some demand for such products along with some stimulus, etc. But it is outside of the remit of central bank. So if there are any cases to share about how successfully develop programs in partnership with different entities to increase awareness in households and MSMEs. Yeah, thank you.
Thank you very much. So 2 questions. The first on how to quantify certain intangible actions, especially social and governance. And then second, how to build awareness. Let me ask if anybody on the panel would like to offer. Ike-san, please.
Let me answer the first question. I think the quantifying the social aspects or governance aspects is a universally difficult task. So I think even the ESG rating and evaluation agency are struggling one. So I think when dealing with that social aspects or the governance aspects, we need to sometimes go for a certain questioner-based survey so that we can quantify through that survey that the progress we will make in terms of the social aspects and the governance aspects. And probably it requires a certain, not only quantitative analysis, but qualitative analysis. So I don't have any silver bullet or magic wand for resolving that issue. But I think in partnership with certain, as I mentioned, ESG rating or data providers, you can find a certain scores or the certain evaluation that will be best suited to your objective.
Thank you. Anyone want to take the question on building awareness? I think communications increasingly moving to the center of focus for central bankers globally. Anybody have any reactions to that?
Ahmed, can I? Sure, yeah. So I would like to take both the questions and would like to share our experience of the Central Bank of Pakistan. Before I go to the capacity building and awareness raising, I will briefly talk about the disclosures that the financial institutions. So when we started the green banking guidelines in 2017, we have started taking some information, the portfolio from the financial institutions, but that was all qualitative. And even after the issuance of the ESRM manual, it is initially the qualitative, and then we expect that with the time we will be introducing the quantitative measures in this. So with this, I just want to highlight that when you are sensitizing the market and when you are just introducing it, so initially maybe you cannot put those quantifiable measures initially. So with the time you evolve from that, and then you can bring in the quantitative measures. And as has already been mentioned, particularly with respect to the social, it gets very, very difficult as well. Now, coming to the capacity building and awareness, yes, even when we are when we have issued this framework, we realize that it's not only the issue on the demand side, when we are saying the customers and then to households, it's also on the financial institution side. The awareness is very low and they need the hand holding. In case of Pakistan, we are adopted a multi-pronged strategy. We are not only doing different programs on our own and with the help of some international stakeholders, but we are, and we have got a training subsidiary as well. So it is doing very customized and targeted program, not only for the banking industry, but they're arranging with the help of the banking industry different seminars to increase the awareness of their clients as well. Even with this ESRM manual, and when we are saying then they have to, we are working on another project which is like the Green Business Facilitation Manual. It is like a guideline for the banks which will help them to help their customer to come up with a different kind of strategies or technologies which will help them to go towards the green financing. So in this way, we are doing it from both the sides. We're not only using different seminars and conferences for this purpose, but we're also making banks to help their customers to come to their side, which is the green finance. Thank you.
Thank you for sharing that perspective. Maybe we'll take a question from online. I'll read out a question and turn it over to the panel. Thank you to moderator and panelists for the insightful comments. For any of the panelists, the question is as follows. What specific steps are you taking to support green finance for MSMEs? Awareness raising, monitor and reporting of greenhouse gases, for example, provision of incentive and financing mechanisms. This question is from Kelly Haddle of ADB. Anyone here or Bushra online would like to take a stab at a response? Yeah, please.
Well, it's also universally difficult problem, but at least the bank-centric financial system, like in Japan, we need to first go through the banks to kind of educate those SMEs for certain awareness of the green issues. And at the end of the day, failing to address green issue could mean that a loss of business chances or the failing to comply with government regulation in the future. So that kind of urgency should be shared with those SMEs, and in sending that kind of message to the SME sector, the channel of the banking sector is, I think, very effective. So in our case, we are intensifying a certain capacity building for banks, particularly for small banks, to get a good knowledge of the how the green issues really relate with the business models of their borrower companies. And the another example is, well, many SME sector is connected with the certain supply chain of the big companies. And for example, a big automotive company in Japan had a huge base of suppliers throughout Japan. And so we are working with such big companies to also raise awareness for such SMEs and set a certain roundtable format to bring together those SMEs and big companies and also financial institutions to discuss how that the green issue, particularly climate issues, should be addressed throughout the world supply chain. So I think that that's one approach everyone can take.
Thank you very much. Any more questions from the floor? Or actually, before we do that, let me ask if any of the other panelists would also like to respond. Please. Yeah.
Okay, thank you for the question. What kind of support from for green finance for the MSMEs? Yeah, from the, of course, from the capital market view. Yeah, we always give the awareness of the stakeholder, including investors, and also for the MSMEs, of course. And especially in the capital market, we give support for MSMEs through crowdfunding mechanism to raise funds from the capital market. From the data 2019, yeah, the crowdfunding mechanism is launched in 2019. And speaking of data, now we have 16 crowdfunding providers and almost 400 MSMEs who have used this mechanism, with total fundraising of $58 million US. I know it is still low, but the growth compared to last year, there is a 200% growth in the terms of number of MSMEs and over 300 growth in terms of amount of fundraise. Yeah, so this mechanism has a very great potential, and what we need to keep doing is intensify our awareness program so that this mechanism will continue to grow, reach more MSMEs, and attract more investors. I think that's all. Thank you.
Thank you very much. Any other reactions on that question from our panel? If not, then let me see if we have any further questions from the audience. Yes, please.
My name is Suhaili Abdulwahab, National Bank of Tajikistan. So my appreciation to the speakers for such valuable insights. Provided information is vital for us to grasp the new reality where we live and work now. So the question is, for countries that have not yet started their path in implementing the supervisory framework for climate-related risk mitigation, what can be considered as a first step, as a right step to begin this journey? Thank you.
I think the first step would be to disclosure of information, because when the banks or the financial organizations, they don't start managing those risks, some of the banks might have already been doing some sort of disclosure, for instance, on international stock exchanges. So you would probably, as a regulator, would first find out the stage at which each financial organization is at the moment. What are they doing in terms of some aspects like, I don't know, diversity, some payment system inside the financial organization. Maybe they have some products, or they provide for some policies internally without any requirements from the side of the supervisor. So when you find out at which stage each organization is, you could find the benchmark and set some standard, for instance, level of playing field for the whole market. And once they start disclosing some information, the next step would be to move forward and go to the some requirements, maybe regulatory or some guidelines in terms of risk management system that the supervisor would expect from those organizations. So just going further. But initially, you would just start finding out what is the situation in the market. That would be our view.
Any other responses from the panel?
I think there are several steps. I agree with her. Promote sustainable disclosure. Development sustainable instrument. I think it's interesting to and also the development, the ecosystem, like laws and regulation, green taxonomy probably, awareness program for investor and for the stakeholder, and of course, lastly is collaboration work, national cross ministry, market participant, association, stakeholders, and of course, international also by MDBs like ADB or ACMF like Asian Capital Market Forum if it is in Asian. So that's my additional answer. Thank you.
Thank you very much. Well, I think this has been, we're just approaching, or we are at the end of our allotted time. Let me just maybe just close with some observations and a word of appreciation. This has been a relatively brief discussion, but I think it highlighted a few things for me and reminded me, and I think also enlightened me. You know, just maybe three takeaways that I was thinking in the various comments. You know, the first is just the enormous scale of the challenge. I was struck by the numbers just for Indonesia to achieve its NDC targets, not just the 2030 number, but the 7 times the 2030 number. And we know, of course, it's not just the quantum of capital, but I think, as was noted with respect to Kazakhstan and other areas, just the fact that this is an economy-wide transition. So the first takeaway for me, really a reminder, was just the enormity of the challenge, both in terms of scope and scale. The second thought for me, listening to the various presentations, was that it really is a new world for central banks taking on this challenge, which I think is right and appropriate. But it's a new challenge. It involves new goals and objectives and the development of new tools, whether those are some of the frameworks that we heard about in Kazakhstan, whether that's very different approaches, like we heard, you know, in the Korean context. It almost seemed like a 3-layered cake that the central bank has to build the capacity, build the tools, and change the flow of capital in the markets. And I think the last takeaway for me was that there's no way to figure this out in a lab. I think, Akeda-san, your comments about green bonds, good initiative, but can it get divorced from pursuit of the ultimate objective? You know, can we end up in a cul-de-sac, which is not actually advancing our objective? I thought the questions about, how do you quantify the S and the G? I mean, those are things, and I think, Bushra, your response to that, I think, illustrated that you learn by doing. You set out on the journey, and then you evolve over time. So let me just end again by expressing my appreciation to this excellent panel and this excellent audience. And thank you all again for giving us the privilege of your perspective and thoughts. Thank you.
Thank you very much.
May I request VP Saeed and the panelists to just convene in the front for a group photo, please. Thank you, Vice President Saeed and panelists for a very illuminating discussion. Session 3 today will explore the role of multilateral development banks and international financial institutions in the transition to a more resilient and greener financial system. Yesterday's session on green investment banks highlighted the limits to mobilization of private sector capital, working solely through the channel of commercial financial institutions because of the high cost of capital and risk aversion. There is a general recognition that MDBs will have a greater role in the climate transition and particularly to assist with the establishment and capitalization of the GIBs. Let me welcome our ADB's Vice President for Finance and Risk Management, Mrs. Roberta Casali, who will moderate this session. Roberta, the floor is yours. Thank you.
Ladies and gentlemen, good afternoon and welcome at this conference on greening the financial system and the role of MDBs. I am Roberta Casali, Vice President Finance and Risk Management at ADB, and I will be the moderator of this very interesting session today, which will explore the role of MDBs and international financial institutions in the transition to a more resilient and greener financial systems. Given the pressing challenges of climate change, biodiversity loss, and sustainability, we find ourselves at a critical juncture where this decisive action is not only desirable, but it's imperative. And we all know that finance is a key enabler, and we all know that we all have a great responsibility, and the financial system's role is definitely crucial and will be even more crucial in the future. The financing gap to achieve SDGs and net zero and sustainable economies are in the order of trillions US dollars. And in fact, in developing Asia, we estimated that we have a requirement of $1.7 trillion. Of course, we know that both public and private capital is needed to reach the scale of investments required. It's huge, and again, we are all responsible and we are all called for cooperate in reaching this great challenge. Multilateral development banks and international financial institutions have a unique role to play in catalyzing the transformation of our financial systems. And with our global reach, expertise, and capacity and financial capabilities, we or these institutions possess the potential to drive sustainable development on a scale that is really difficult to match otherwise. And MDBs and IFIs serve as pillars of support, working in close collaboration with governments, private sector actors, civil society organizations, to channel resources, build the capacity, and foster innovative solutions. You all know that a big debate is ongoing on the role and the mandate of MDBs, and how, especially for my area of work, is very much important, and we are really working a lot on strengthening capital management and the capacity of the financial capacity that can be put and serve the clients, which are our developing member countries. In the next hour, we will explore the topic of our role in more detail, and especially how MDBs and IFI can further support the transition to more resilient and greener financial systems. Let me introduce this amazing panel, and starting one by one. So on my left, Dana Kupova, Head of Green Economy Transition, European Bank for Reconstruction and Development. Tatiana Didier, Senior Financial Sector Specialist, World Bank. Tao Chang, Chief Representative for Asia and the Pacific, Bank for International Settlement. Online, Saeed Hussein Kadri, Director of Resilience and Climate Action, Islamic Development Bank, and my colleague, Jung-Liu Lee, Chief of Financial Sector Group at Asian Development Bank. Welcome to all of you. And to start this panel discussion, let me start with a question to Tao. What can MDBs and IFIs do to get financial institutions and other financial industry players, such as asset managers, for example, to better manage climate-related risks and scale up climate and other green investments? Please, Tao, the floor is yours.
Thank you. Thank you, VP Robata. And first of all, of course, good afternoon to everyone. Let me start by thanking Bruno and other colleagues at the ADB for inviting me to join this very important conference. And for myself, it's very special because I have worked here for quite a few number of the years during my early careers in ADB. So for me, it's a home returning. And so very glad to be here after so many years to see old, not old, but still young, familiar faces, and to catch up. So let me say a few words about ourselves, particularly the BIS. BIS represents the Bank for International Settlement. We are a bank, but unfortunately, we don't do lending. Then people may question why you're here if you are not lending. Then I have to say that for those people who may know or may have little knowledge about BIS, is we are basically a group of major central banks around the world, represent 95, at least 95 percent of world GDP. Not only that, we support, and also, indeed, in the matter of the fact, we host a few number of the financial, standard setting bodies, including the FSB and BCPS and the CPMI and those names. That's why I think we should also play some role in this very important topic, which is how to address the climate change, and particularly the climate change, the finance related issues. But I would like to address these issues through the eyes, particularly of the central banks. But I do know, the topics is quite large. Possibly difficult to address each and every aspect of this topic in such a short period of time. But I want start with or focus on one of the important aspect of these issues, which is, the climate change itself, pretty much related to the negative spillovers impact from the climate change itself to the society, and also, of course, to the economy itself. And so given the complexities of the issues, and which is multidimensional, I personally don't think there are the solutions to kill all the issues, meaning there's no panacea. So I don't think there is a sort of the solutions to all the problems. However, when people try to address issues, then people normally go to the framework. So in my eyes, and I see a framework which consists of 3 pillars, which I consider themselves are quite relevant, which I call the 3 pillars, basically the MPC, which is, okay, don't confuse MPC. I'm not saying this is the Monetary Policy Committee. But by MPC, I mean, first, this has to be market-based. Second, the framework has to be policy-oriented. And third, the framework has to be cooperation dependent. So that's MPC. Let me very briefly to explain what I call market-based. Basically, what we are saying is we need to let the carbon emissions and the pricing signals related to that to be handled by the market. So that's fundamental, the fundamental point. We need to get the incentives and the carbon pricing right to reflect the social cost, or what we call by economists externalities of the productions and consumptions of the high carbon intensive goods and services. But today, I'm not trying to focus on the attention to how to build, for example, the emission trading systems or the carbon crediting mechanism. And these are obviously have been widely discussed and indeed in many parts of the world being practiced at this particular moment. But I want to emphasize what is the role of the central banks can play in terms of enabling the net zero transitions. First, of course, as you know, central bank has a mandate to keep the price stabilities and the financial stabilities. And to us, keep the two stabilities, particularly the price stabilities, is our ultimate objectives. And these days, as we've seen it, inflation is at a historically high levels compared with the last few decades. And we know the reasons. And here, I want to emphasize, in the foreseeable futures, we have seen there's the rising attentions on the so-called long-term supply factors related to inflations. Let me briefly name a few. The first one is the geopolitical tensions that lead the world to be less receptive to globalizations, and particularly right after the COVID. And we have seen that there's great disruptions in terms of the supply chains. And second, of course, there we see the reversal of the early positive trend in terms of the demographic trend, meaning in many parts of the world, particularly the advanced economies, and partially in emerging markets like China, the population aging problems. So, and of course, the transition to the greener economy itself also entails the cost of premiums, particularly in the short terms. So the crucial point is how to manage these long-term supply-side shocks in order to have orderly transitions to the green economies. And certainly, there's no readily answer to that. And whether or not this carries the implication to the monetary policy framework, or it requires different monetary policy approach or monetary policy tools, that's pretty much at the core or center of today's debate among central bankers and to a larger extent among the policymakers. So that's one point. Second, pillar two, policy matters. Obviously, policy matters, including carbon taxes, including how to determine the levels of the subsidies, how to arrange the subsidies, how to eliminate or the exit of subsidy policies. But here, what I want to say about central banks, in terms of what they can contribute in themselves, other than providing enabling environments like the setting up the monetary policy framework. One, central bank can focus on assessing sustainability related risk. I think that Bruno and other colleagues has done that tremendously yesterday. I am very much agreed with the discussion they pointed out yesterday. And second, of course, the central bank can contribute directly to the economy-wide transitions toward net zero by steering investment towards low-carbon economic activities using various policy tools. And of course, central bank can also enhance the development of market in the sustainable finance. And of course, the number three, central bank can encourage the adoptions of new technology, particularly the digital technologies. I wanted to highlight that in the Innovation Hub of Hong Kong centers, they launched a project called Genesis, which serves to that kind of purposes. So if people are interested in it, so I would encourage people to look for the details. Okay, now to come to the pillar three, cooperations. Needless to say, these issues go beyond the national borders, and the international cooperations has to be there. And carbon pricing works most effectively if there is a consistent cross-border approach. And of course, the international corporations can play the role as investors in issuing and investing in green bond markets, particularly those international standard setters. They can play the role that to make sure there's a consistent and comparable and transparent the ways so that people can work on this stable environment. So in all, I think before we're talking about how much money we can put it in, we need a stable, predictable macro environment. We need to ensure financial stability, particularly make sure the financial institutions in the health conditions, and we will have to make sure all of us will be on the same page to work on the same issues. Let me stop here. Thank you.
Thank you, Tao, and thank you for having raised this topic of the importance of the framework, the importance of the role of central banks and monetary policy tools. You mentioned to greening the financial system, but only you mentioned the very important role they have to foster innovation in this field. And now let me go over to more specific questions from the MDBs or to the MDBs colleagues. I would like to ask Dana, what do MDBs currently do to advance the greening of domestic financial systems in recipient countries? And what are the main challenges that they are facing? Thank you,
Fantastic.
Dana.
Thank you, and good afternoon, everyone. It's absolute pleasure to be here. It's my first time here, so I already must say that I'm falling in love with Manila and Philippines. So I'm from the European Bank for Reconstruction and Development. I don't think that many of you know our regional bank because we don't necessarily cover this part of the world. So let me introduce EBRD very briefly. We are currently operating in 36 economies, from Morocco to Mongolia, from the Baltics to Egypt, as we describe it. Our capital base is 30 billion on annual basis. We finance about 12 to 13 billion across the region. Out of this, about 40% are actually going through our partner financial institutions. We work with 300 or around 300 partner financial institutions across the region, banks, microfinance institutions, insurance companies, you name it. Our key focus is on private sector, and that is why I'm mentioning this, because it links nicely to what we heard previously today and yesterday as well, that without engagement of private sector, it will be really difficult to reach the net zero and to really move the dial on Paris alignment. In line with other MDBs, EBRD has been making a lot of climate-related commitments, and to name the few, of course, as part of the greening of financial system, we have a commitment to deliver a certain volume of green financing. We have a commitment to do 50% on annual basis by 2025. We already hit this target last year. We also prepare our TCFD reports. So this is part of our engagement on climate as well, to show that we walk the talk. But the most exciting part of our work that I wanted to mention today is our Paris alignment work. Because all MDBs by now have made Paris alignment commitments. The commitments are the same, however, timelines are different. Given our shareholder mix, we were actually asked to move forward our deadline for aligning our financing with objectives of Paris Agreement. So from January this year, we actually have to have all financing screened and aligned with the objectives of Paris Agreement. Now, when this commitment was made, that was about a couple of years ago, we in financial sector could see that this is going to be a bit of a challenge, because back then there was no cookbook for Paris alignment. There were not many tools in place. We could definitely see that the financial sector was moving in a certain direction, because it was just when the network for greening financial systems has emerged, the TCFD guidance was becoming more and more refined. So we could see that that was the direction of travel for financial sector. However, we did not have the full picture of what is happening in our region. So as a first step, we actually did a survey of our partner financial institutions, if you can move to the next slide, to look at how our 300, more or less, institutions actually look at climate. And we put particular focus on climate risks, how the institutions look at impact of climate on their portfolio, but also impact of their portfolio on climate in terms of carbon emissions. We asked about, for example, what are internal arrangements? Is, for example, risk involved in discussions on climate risk? When we got the results back, I actually heard some of our board members saying this is really alarming and that they had a few sleepless nights because it was clear that financial sector was not ready to look at climate from the perspective of climate risk, but also it was not seeing climate as something that is relevant for the entire organization. It was very much constrained to individual green products. I'm sure that it resonates with our ADB colleagues as well. So our partner financial institutions had certain financial products, but they were not looking at how their climate governance is. Do they have the right people on the board? What is the governance structure for climate? What is the strategy? How are climate risks factored into their investment decisions? And what sort of transparency are being put in place? So we took a leap of faith and we designed our Paris alignment approach in a very transformative way. We thought, okay, if we have to do, if we have to look at Paris alignment in financial sector, we better look at it as the biggest opportunity of the decade to be transformative. And we built the Paris alignment for financial sector around the topic of transition planning, which means we will gradually expect our partner financial institutions to actually have an institutional plan how to address climate change. And that will, in return, help us to scale up our green financing. I will stop there, but I will be happy to take any questions. Thank you.
Thank you, Dana, because I think you gave in few minutes the exact sense of what does it mean going through a process inside an organization and understanding what's going on in the market and how we can really play a role that is relevant for the financial system, for our clients, for all the organization.
Absolutely. I would call it a bottom-up approach. Exactly. We hear a lot of
exactly.
top-down, but working with the financial institutions and helping them build their internal capacity will be absolutely crucial.
So, and this is a great example of concrete work on the topic. And thank you for sharing this experience with us. So now, over to Tatiana. What is the toolbox that MDBs can deploy to these ends, and the value of each instrument, if you can give us an idea of this? So investment, advocacy, policy dialogue, all those. Thank you.
Thank you. Thank you so much. Thank you for the invitation. It's a pleasure to be here. And so I'll start with the toolbox, and you have on the screen. This is based on a set of policy tools for greening the financial sector. That's one of the approaches. And this kind of shows the range of policies that take to green of the financial sector, thinking both of risks and opportunities, right? Takes both sides. And the policies go all the way from strategy and coordination, working with the various ministries, the central bank, the regulatory authorities. What is the main roadmap for the country in terms of where we're going? Before you even think about the financial sector, what is the vision for the country? Of course, there is capacity building, skill sets. This is new. This is new for everyone. So there is a lot of awareness raising, capacity building for the various stakeholders, not just the financial sector, not just policymakers, but also the private sector. Firms, I mean, at the end of the day, they are the ones that need to make that transformation. They are the ones who are going to undergo this economic transformation, right? There's the risk side, and I think you had a session yesterday, and apologies for missing that, discussing all the regulation, the supervision role in dealing with this, managing these climate risks, and what it means for the financial sector. Of course, the role of transparency, improving information, climate information. Again, this is all new. There is a lot of work to be done in there. Taxonomies, setting standards. What are we talking about? What exactly are those risks that we're measuring? Disclosures. How do we get financial institutions, the private sector, to follow, to track those risks? of course, tracking risks would help better decision-making by everyone, policymakers, firms, financial sector. And so MDBs have been extremely active on that front in helping set standards, improve transparency, give guidance to the different players and the different stakeholders on what exactly matters, how do we go about it. So it's not even just identifying, it's also implementation, right? It's setting standards, but also how do you implement? How do you go about implementing those standards? Developing markets. How do we foster financing for sustainability? Are there specific instruments that may be more catered, more suitable for these new types of investments that we're looking for? Investments to mitigate emissions, investments for adaptation, to deal with climate risks. And here it's fostering corporate, sovereign, green bonds, sovereign-linked, sustainability-linked bonds, loans, but also background, like think of the enabling environment for that, or other types of support, indirect supports like guarantees, greening all that could support the development of some of those new instruments. And of course, greening financial institutions, the developmental institutions like the development banks, the country level ones. There's a huge endeavor there. You can green that financial institution and you can green the operations, but you can also green the way it tackles, it reaches out to financial institutions, to firms. So there's a whole agenda on that front. And I think the way MDBs, or at least that's how we do it at the World Bank, a lot of that support comes from capacity building through technical assistance, direct investments. But I believe there's also, I think, 2 additional roles for MDBs and IFIs. In addition to this country-level work, you go and you work directly with countries, but I think there's 2 additional ones that MDBs and IFIs are in a very unique position. One of them, it's a convening role. These toolbox, for instance, this is very specific for the financial system. But when you think of risks and opportunities, let's zoom in on the opportunities, because the risk, we already had a discussion, the opportunities. When you're thinking about scaling up sustainable finance, what are you talking about? You're talking about complex challenges, both from the financial institutions, because there are market failures there are financial market failures, but there are also challenges coming from the private sector. And talk to the bankers, what they're going to say. Many will raise the issue there's a lack of investment opportunities. There's a lack of bankable projects. This is a reflection of an issue in the private sector. So when you're thinking about financial sector policies, it's just one side of the puzzle. You need to think of private sector challenge, developing the enabling environment for business to make these investments in the first place. So you need to talk, when you think about developing, greening the economy, you need to think of not just the financial sector policymakers, you need to have it at the table, the real sector, the ones that are dealing with companies. Bigger, I think the way and the convening role, it's bringing to the table, putting at the table all these different stakeholders in the country, make sure they talk to each other, make sure that the range of policies is coordinated and it's developed in a very coherent way. So what I am doing as a financial sector policymaker is not being undone by another set of policies. Think of, I'm trying to green the economy and there are few subsidies from the other side. So if I don't put MOF in the table, then I'm missing that linkage. So I think this role of convening, on putting everyone sitting down and talking, I think MDBs and IFIs are in a very unique position to put them all on the table. And lastly, my last sentence is advocacy. I think MDBs play a very crucial role, especially the regional IFIs and the ones working with developing countries, which is bringing the emerging market perspective to global policy making. Because, as I mentioned, there is a whole set of new financial infrastructure being built, taxonomies, disclosures, all that, in many instances, they are being developed by high-income countries for high-income countries. So you need that voice of emerging markets. How are those policies affecting and what is the impact? What are the challenges that emerging markets will have in adopting these policies? And I think MDBs have a role in bringing that up. So I think that advocacy role is also there. And I'll stop there. Thank you.
Thanks a lot. Very clear toolkit of many different instruments to reach real and concrete results for our clients, but let me say for everybody, because it's the good It's an action for good, not only good intention, but real actions. And holistic vision to do all this is what we definitely get from your intervention. Thank you again. Said, okay, yes. Good afternoon, and thank you for joining this conference. How MDBs could help further assist in strengthening local capital markets in Asian developing countries to facilitate, inter alia, the green bonds issuances? Please.
Thank you.
The floor is yours. Thank you.
Thank you, SVP. I hope you can all hear me and see me well. I first of all apologize that I wasn't able to join my fellow panelists in the session in person, but this is a great opportunity and an honor to represent and discuss on some of the most pressing issues on how do we green our financial markets and instruments. As the Islamic Development Bank, as many of you would know, we've got 57 member countries and we operate across different regions. We share 14 member countries with the Asian Development Bank, and we've always had a great number of opportunities and projects to discuss some of these issues within not only our operational and financing instruments, but also specifically on innovations in climate financing areas specifically. I also wanted to mention that I completely agree with a lot of my preceding panelists that mentioned Dana and Tatiana and Dao in terms of the fact that let's get a few things out of the way. That's very simple. MDBs then provide and have a critical role to play in capacity development, technical assistance. We've watched the tremendous work that the Asian Development Bank has already done with the government of the Philippines on the green bond frameworks and other instances. We've also seen how IFC has partnered with in India for the G1 Ultra Solar Development projects and things like that. And I've already gone through various different catalytic initiatives over there. But some of the areas that we really need to focus on as MDBs is on risk mitigation and credit enhancement. That's where a lot of the innovation is required. And I think it was Diana or Tatiana just before me was mentioning about how we need to have those supporting guarantees. The Islamic Development Bank has a guarantee issuing entity, ISIC, we call an African, and similar ones in Nigeria as well. Those are some specific examples that we can look into that. The next item is to see how we develop these markets and have a demonstration effects. MDBs play that very essential role in capital markets. We act as anchor investors in these green bond issues.
Said, sorry interrupting you. It's a little bit choppy. Can you please, yes, can you please speak a little louder and probably closer if possible?
Is this any better?
Much better.
Okay, fine.
Everybody's clapping here. So.
I think the most relieved person in the room would probably be Michelle, because she already did some testing with us yesterday, a couple of days ago. Okay. So I'm sorry, I will have to probably quickly repeat some of the points I was making, and a lot of these points were already made by the panelists in a more eloquent fashion than I would probably do so. But that was around technical assistance, capacity development, playing a more catalytic role when it comes to PPPs. And the point that I was trying to come to was on playing a more essential role on risk mitigation and credit enhancement. How do we support the issuance of green bonds and local currency lending for these things? These are the instruments that play a definitive role when it comes to that. And the next point that I was coming to was on having a demonstration effect. The more the MDBs come in developing the local capital markets, by acting as anchor investors, it creates a demonstration effect. It brings others on board, and it really adds on to our convening ability as well on these items. And lastly, what I really want to touch upon is innovation in green financing. And that's where the MDBs need to keep on continuing to push on the envelope. I'll give you a specific example of the Islamic Development Bank. We adopted a sustainable finance framework where we basically try to come up with the right financing models to tailor social and green projects. Our Islamic bonds, we call them as sukuk, we've issued since 2019 nearly $5 billion worth of them.
And they go through this virtuous cycle. The more projects you come up with, the more opportunities you have to issue those bonds, the more, the better funds you'd be able to raise, and the more you would be able to help the domestic financing systems as such. So those are some areas which have really had a great impact. And to be fair, a lot of our financial instruments have actually moved our climate ambition targets. I'll give you an example. We, despite coming from half of our 57 member country in membership are from a least developed country background. Despite that, we have a Paris alignment targets, which we're hopefully going to be achieving by the end of the year. And we have climate financing targets of 35% by 2025. We are already at 33%. So it's a dual win. It not only supports our member countries and the regions in which we operate, but it also actually improves the way we conduct our own businesses and make ourselves a lot more green. With that, I'll pass it back to VP Roberta. Thank you.
Said, thank you very much, because you raised a very important point, explaining very well, I think, our role in the sustainable capital markets, not only when we issue our thematic sustainable bonds, but also when we help our DMC, so the development member countries, to issue and develop their own capital market. And again, a big role, a crucial role when we act as anchor investor for some corporate issuances of thematic bonds in our developing member countries. And thank you for giving, again, practical and concrete examples of this role that is relevant. Last, for this first round, Junkyu Lee, how ADB can help in greening the financial system. For example, ADB's strategic framework, supporting, again, our DMCs, supervisors, and ADB toolkit. Please give us some example, concrete example of ADB work as well, and what would be the recommendation for ADB's actions and products on climate risk in supporting climate investments. Thank you.
Thank you very much, PP. And also, I just want to thank all of our colleagues. And as you know, there is a benefit as in terms of the sequence in the last panelist, and I have a vantage point to compare. Every renowned panelists already said about the good things, and telling me and also reminding me what ADB is doing is really great, or we remain on the right track or not. I think this is a great opportunity. And as you already mentioned about the framework, and let me talk about this journey of our discussion is really the framework for us. And ADB actually have been this framework, and we say the strategy 2030 and the 7 operational priorities. And this strategy 2030 and 7 operational priorities, and actually including, when you look at it, can you go to the next slide? And okay, go to the next slide. All right, so it already sees that when you look at the ADB's vision, it's sustainable. And then it has on the right side in number 3, and this out of these 7 operational priorities, and third operational priority is tackling climate change and the building climate and disaster resilience and enhancing environmental sustainability. This is ADB's journey, and fortunately, ADB's journey began 2019. So in terms of the framework and to help our DMCs and also help ourselves, ADB itself, and also working together with other MDBs and IFIs, and ADB in some way was well poised to work together. And then the next slide, and based on this, our framework, and we also have put in place very recently, the last year, and so-called the sector directional guide. So based on this vision, based on these operational priorities, and we look at this climate, such an important, direction. We should work together. Very simply, we should work together between sectors and the theme, across ADB, knowledge, and the regional department, operation department, everybody. So we discussed about putting in place a sectoral directional guides. The sectoral directional guides, actually, we have 7 sector groups: education, energy, finance, health, transport, urban, and the water. All of these 7 sectors have this sectoral directional guide, and looking at this climate component, the green component, and under this, the strategy 2030 and the 7 operational priorities. And especially narrow down a little bit, and the next one, and to financial sector directional guide. And this financial sector directional guide begins the understanding of what is the most biggest challenges. The biggest challenges, definitely 7 challenges we have put in place. One of them is climate change. And then we discuss a lot, and then how we want to be, where we want to be, how we can make it. So in terms of the what we will do, how part, and we agreed, put in place 6 guiding principles. The 6 guiding principles is innovative modalities in the products, and private sector operations, and also tackling differentiated approaches, and quality finance operations, and also effective collaboration, building skills and resource in emerging areas. So begin from the journey of 2030 and framework, and the 7 operational vision, and the 7 operational priorities, and all sectoral guides, especially financial sector. We put in place this financial sector directional guide, and it was approved the last year. I think it is October or November around. And then the ADB's toolbox, next slide. And it is pretty much similar, and together with other colleagues already mentioned about this toolbox. But one of the interesting toolbox I just want to mention is that sort of, ADB's support to implementation of the reforms and the standards, and of course, international institutions and standard setting bodies. We think, setting the standard setting, working together with the standard setting bodies is very important. For example, for the security side and IOSCO, and also the ICMA, and for that, securities, and also other institutions, and IMF and other BIS, definitely. And I think this is also the very important why we need a standard. And to assess and to monitor, we need a standard. And then another interesting point that I'd like to share with you is a strategic partnership. This strategic partnership we put in place, for example, the GFANS APAC. It's, as you know, the Glasgow Financial Net Zero Alliance, and this is one of the things we are currently putting a lot of effort in to spread the knowledge, and also the looking at the specific projects. And also the loan condition in investment, it's pretty much similar to others. But in our roles, the next slide, and this in our roles, and I believe one of the most important thing is that not only assessing, we ADBs helping assessing and identifying climate risk, DMC policymakers for assessing and identifying climate risk, and also for developing and implementing climate risk management expectations. Very important thing is that we are working together with the government and the private sector both. This is one of the AB's very strong, I believe it's a strength, working together with the government and private sector together so that ADB can help facilitate the market, transform the market, catalyze the market together. I think this is one of the things, and how we can work together with our 2 things, and I'd like to say. We actually reorganized right now our whole ADB structure, working structure, so-called new operating model. So operation and the knowledge together to provide a very hands-on, effective solutions to our clients, government and private sector both. And another one is that very important thing is that working together with these very knowledge excellence partners to provide a very innovative solutions, including innovative facilities, innovative modalities, and the products. And one of the interesting things that I'd like to mention is IFCAP. Very recently, 2 weeks ago, IFCAP was launched. The full name is Innovative Finance Facility for Climate in Asia and the Pacific. This is actually has a very innovative component to leverage ADB's capital. So this one is to building on the guarantees and supported by donors' credit, and to ADB's sovereign operations, so it'll give more room to ADB's the capital to support additionally to the sovereign and the non-sovereign project. So we say $1 in, up to $5 out. So these kind of innovative approach, and closely working together with those knowledge partners, and also the private sector. I think that is very, very important. And one very last thing, and before I close, is very latest signing ceremony. The 2 weeks ago also, ADB and JPX MOU, and this is very interesting. Why? And JPX is basically a Japan exchange. So this Japan exchange, what we're doing is we want to facilitate ESG bond issuance and with improved disclosure to market players, and also the sharing knowledge on using digital technologies in financial services, and also the providing support to startups. So they have knowledge, we have operations, and then we can combine this knowledge and operations in a very innovative way to support this ESG bond issuance. This is also one of the good example how ADB is working together with our partners to provide innovative solutions to our DMC governments and to our DMC private sector partners. And I stop here. Thank you very much.
Thank you very much, because again, we have just heard other concrete examples of work at ADB, but in general, that the work that MDBs can play. Be a solution bank, you said. Client centricity was very clear in the message, and some specific example, such as IFCAP, the facility that we have just launched, that the President has launched at our annual meeting 2 weeks ago. So thank you again. We have only 8 minutes to finish our panel, so we can have, I think, a second round, or please, if there are first some questions from the audience, we can also decide to take your questions or have a second round of short answers and then open a discussion to the floor. Let me ask if for the moment are there questions, or we go on with some other. Yes, please. Introduce yourself.
Hello, good afternoon. This is Khurshid Alam, Executive Director, Bangladesh Bank, the Central Bank of Bangladesh. Many thanks for a nice presentation, especially the last speaker from ADB. There are lots of programs. You know, we all are aware that the developing countries like Bangladesh are very vulnerable position in context to the climate changing issues. Almost every year, there are lots of natural calamities, like devastating floods, cyclones, drought, and sometimes the government of those countries faces lots of fund crisis to maintain their regular financial and economic activities. My question is, other than ADBs, do you have any special programs for countries like Bangladesh for capacity building for resilient and green financial system of those developing countries? Thank you.
Thank you for your question. Jungli?
Thank you very much, our Bangladeshi colleagues. And I think that is one of the most and the fundamental question, and very important question, actually. And it is true, and like we agreed yesterday, climate change is real, and especially in Asia and the Pacific and the DMCs like Bangladesh, and has been very much subject to the natural disasters. And in that case, what ADB, in terms of the capacity building, and I believe in our regional department colleagues and also our SDCC itself, we have many knowledge products, and also we have each department has their own capacity building program. So probably in terms of the capacity building, the importance is there. But for your information, and I think because it is really, you get to the point, the importance of the disaster risk financing, that is also the BP's, the one of the important initiative. And, support to DRF, disaster risk financing solutions, what ADB is doing, maybe it's a very good reference to you. First one is that contingent disaster risk financing is one of our solutions. And contingent disaster finance actually including grants and loans and so far, and totaling 1.17 billion extended to 12 countries under 22 operations today. And also we have a Philippine city parametric disaster insurance. And also interesting is we have a pilot project already and for Bangladesh, and it is a parametric crop insurance pilot project. And the gentleman next to you, and probably he gave you more details about this parametric crop insurance pilot. And also India and the Fiji, we have a disaster insurance solutions for microfinance and MSME sectors. And currently we are also working on that, the regional initiative like a coral reef finance and insurance. And once we connect these knowledge product and then pilot work and also the capacity building to support DMCs like Bangladesh and to deal with take on and these natural disasters. And I think that will be also our, we are seeking right now and closely working together. That's a very great question. Thanks.
Thank you. Someone else would like to add something? Said, if you like to intervene, please tell me, okay? You are with us anyway. So we have another question for Dana. Received from who is following us online. In terms of Paris alignment, is EBRD able to measure the carbon intensity, positive, negative CO2 emission reduction potential of each financial sector client engagement?
I think this is a very good question, but it also links back to the awareness and capacity building, because especially in financial sector, we are limited by what our partners can also provide in terms of data. I must say that in our region, especially outside of EU, the data at the moment is more or less non-existent from the financial sector. So we need to really work hard on building up the capacity of the financial sector to provide this data, and hence also work with real economy to feed that data to our financial institutions. Now, we do have technical assistance program for our clients. So we do have donor-funded program where we can provide targeted consultancy for financial institutions. Unfortunately, not in Bangladesh, but in our countries of operations. But when it comes specifically to Paris alignment and these topics, this is such a fast-moving environment with so many even private sector-driven initiatives that the most important first step that any financial institution can do is to really link to the best practice knowledge hubs that there are. There is a lot already on TCFD reporting. There is a lot of initiatives such as PACTA, PCAF, you name it. Yeah. So there is already a lot out there, and financial institutions will need to build on that as well. I hope that answers the question.
Thank you. Tatiana and Said, if you want to tell us something more on how can more and adequate concessional support be targeted for the poorer and more vulnerable countries?
Sure.
Few words.
I'll try to do that in 30 seconds as quickly as I can. So when it comes to concessional financing, a lot of times we are looking towards the private sector. But what is the track record? We need to be also very mindful of that. I mean, there are some studies that suggest that in the last 3 years, we've mobilized $300 billion of concessional financing. That sounds like an okay number, somewhere around the lines of $1.7 trillion on the way there. But the devil is in the details. Of the 70% that was mobilized, they went to the middle income countries, and the least developed countries only received about 10% of it. So we have to be very mindful of what we are doing, how we are doing it, how we are developing those capacities, and where are we channeling those resources with the challenges that we already have and face. And that comes with a two-way knowledge generation, capacity development type of initiatives and such. So that would be my last message for the day. Thank you.
Thank you, Said. Tatiana.
Thank you. I'll go in 2 seconds. I would echo what Dana said. We need data. We need more data, better data. You can't target if you don't know who are the most vulnerable, who are the vulnerable to transition risk, physical risks. And that $1, where should it go? Where it would be most effective? So data, data, data.
Tao, a last comment from you as well. Whatever you think it's relevant to leave the audience now.
I agree. Data, disclosures, everything. But I think in order to, for country authorities to mobilize the more resources, the fundamental way is to enhance their understandings of the necessities and the urgencies of to address the climate issues. And the time is clicking, and if we don't act sooner and in the greater effort, then we will eventually have even more difficult and meet even greater challenges to address these issues. So hurry up. Thank you.
Thank you. Thank you all. And I think we have to thank these wonderful panelists, and with a big round of applause, right?
Without further ado, we move on to the final session of this conference, which will comprise of a roundtable on how private sector can leverage multilateral development banks to support the transition to net zero. Let me welcome Kathy Marsh, Deputy Director General, ADB's Private Sector Department, who will moderate this session, and all the panelists on stage.
Thank you, everybody, and welcome to this final session, the graveyard slot, I guess. So we hope that the discussion that we have in the next hour will be, suitably interesting to, hold everyone's attention in what is always, I think, the trickiest spot of the day. But my name is Kathy Marsh. I'm the Deputy Director General for the Private Sector Operations Department here at ADB in Manila. So during the course of the last day and a half, I think, people have, heard about, ADB and, our products and our interventions and so on. What we would like to do in this final session is, turn it around a little bit and talk about, the private sector, and how the private sector can leverage, the MDBs to help support the transition towards net zero. And joining me for our conversation this afternoon, I'm very pleased to welcome on stage, just starting from my left, Ernst Rauch, who is the Chief Climate Scientist for Climate Change Solutions Development at Munich Re, and Max Thomas from the ESG Solutions team at HSBC with coverage across the APAC region. Kelvin Wong, Managing Director and Deputy Global Head for Energy, Renewables and Infrastructure at DBS Bank in Singapore. And Connor Donaldson, the CEO of the Global Asia Insurance Partnership, which is a partnership between academia, the global insurance industry, and regulators and policymakers on the development of the insurance sector. Last but not least, joining us virtually is Asif Chima, who is the Director for our Financial Institutions Division in the Private Sector Operations Department here in ADB. Asif is usually based in Manila, but I think is in PRC right now. So Asif, thank you for joining us on screen. We'd like to mix it up a little bit and start with a brief discussion around an innovative approach and solution. So we're sort of starting, if you will, from the back end, and then we will take our conversation onwards from there. If I could possibly ask Ernst to talk us through Munich Re's approach to, and your thoughts on how the private sector, can help can leverage MDBs with a particular emphasis on insurance. That'd be fantastic.
Thank you, Kathy, and thanks to ADB for inviting me here to this important panel. I guess I'm the only representative from the insurance, or better to say reinsurance industry here, and therefore I think it is really hopefully of interest to you to learn more about how we can collaborate, not just the private and the public sector within the financial service industry, but especially what the insurance industry can bring to the table to support the greening of the financial industry. Could I have the next slide, please? So on the next slide, you would see sort of what the DNA is of an insurance or reinsurance company and how this fits into your targets, ADB targets, with respect to supporting the greening of economies or so. What you see here is going from left to right is the understanding of risk. So that's sort of the core of our activities as a risk management companies. And understanding of risk when it comes to weather and climate-related risk, that goes back for more than 3-4 decades or so. We started actually in the 1970s working on climate change and the physical risk and physical impacts on climate change. And then the measuring is putting a price tag on these risks. That allows to really make calculations how much value certain investments bring into sort of the resilience domain, investing in reducing the vulnerability of people and societies. What does it mean and what does it cost? So that's the risk and the measuring element. And the last one is on the management. So our role as a risk management company is to transfer certain risks to our balance sheet. And certain risks can be on natural catastrophes and the challenge with respect to improving resilience. And that's not limited to high-income countries. It also extends to developing and emerging countries. I will bring an example. Then ultimately, the role is enabling, really helping relieving investments into both resilience measures and also on the technologies, reducing emissions, renewable energies and the like, by transferring certain risks to our balance sheet. And and that's also our role, not really the main focus, but nevertheless we had collaborations with MDBs also on the investment side, providing capital or so, blended financing or so for certain projects in different parts of the world. Next slide, please. That's the one example which I have here for the resilience piece, natural catastrophes and the role we have. What you see on the left-hand side, a bit blurry, I think, at least here on my monitor, is the Philippines, the country of the Philippines, in an investment portfolio that's indicated by these blue bubbles. Long-term investments, be it loans, long-term loans for infrastructure projects, or be it mortgage portfolios in the homeowners and residential dimension. And what we do is we analyze the physical risks, and what you see on the left-hand side with this colorful circle is that for the present hazard situation, there's a certain risk score and indicating which part of your portfolio, of your investment portfolio, is exposed to natural disasters with a certain degree. And on the right-hand side, and we discussed this here on the panel, or the colleagues discussed it on the panel yesterday, is what is going to happen to my long-term investments and the risk on these investments under climate change scenarios. And on the right-hand side, this is an IPCC scenarios. We can also run NGFS scenarios, and that's indicating the change of the underlying risk, which helps understanding or better understanding the investments into these projects and what it means also for the financing piece. Still, this is a lot of work in progress. We also had this in discussions or so, but the more we see discussions and even pressure coming from the regulatory authorities, we see this as elements for stress tests and happy support here. And the last slide I'm having here with me is on the role of Munich Re and the role of the insurance industry in supporting this transition towards low carbon technologies. What you see here is sort of the suite of low carbon technologies, we as Munich Re have invested in, and you see, and insured, and you see the 55 gigawatts in power generation capacity in some 80 countries, so that's of course including countries outside the OECD world. We do this with our own capital, but we also do it with unfunded capital with support of project developers and others. So that's the role which we are having, and that's, we believe, also where we can collaborate the private sector and the public sector in helping greening the financial services. With that, over to you, Kathy. Thank you.
Thank you very much, Ernst. And if I could just, for those of us sitting up here, I think something's gone slightly awry with the clock, so don't worry too much on that. Very interesting, and and very innovative. And I mean, Connor, I imagine that the points that Ernst has touched on in that conversation, are areas that you've also been thinking about in GAIP. Is that right? And how we might look at that for organisations such as ourselves at ADB.
Yeah, maybe in the first instance, you'll have to humor me for a moment so I can give maybe a further elaboration on who we are as an organization. So the Global Asia Insurance Partnership was founded by the Monetary Authority of Singapore, the insurance industry that's active in Asia, regulators from across the region, and our primary academic partner is Nanyang Technological University in Singapore. And the idea behind GIP was to provide a platform for the insurance industry to be able to come together with regulators, with academics, to talk about new emerging and accelerating risks. Now, understandably, climate is number one. Climate is an existential risk for us as a society, but in particular for the insurance sector. We definitely, I think, have a deep appreciation for the way in which the physical environment around us is changing. And as a result, I think we have a deeper appreciation for some of the things that need to be done, hopefully to enable the transition to net zero, and hopefully over the longer term, create a more resilient future. But I'm going to ask everyone to humor me for a moment, and I'm going to ask people to give a show of hands on a couple of questions. So the first one is, how many of you know what a protection gap is? This is what happens when you have the two insurance people on the last panel of the event. The second thing is, how many of you actually spend any time thinking about the importance of protection gaps in your work? That's the same hands. So I think maybe just for the benefit of people in the audience who might not spend that much time thinking about protection gaps, a protection gap is basically total possible losses versus insured losses. And that's the simplest way to describe it. But it's not actually a very good way to describe it. And so when we talk about protection gaps, what we end up talking about is this small sliver in terms of total possible losses in the event of a major event, a catastrophe, a disaster, that is actually transferable, that the insurance industry can play a role in actually providing protection. And that sliver is quite small. The most important thing that we can do to address protection gaps, and I tell you the truth, in Asia, these are measured in the trillions of dollars. When we think about catastrophes in Asia, when we think about the risks that each of us as individuals face, we're talking about trillions of dollars of possible losses in the event of a catastrophic event. But when we talk about this, unfortunately, I think we get into this cognitive dissonance. Because the numbers are so big, we lose track of the fact that we're actually talking about individuals, we're talking about families, we're talking about businesses, we're talking about communities, and we're talking about entire countries who might not be able to respond, might not be able to recover in the event of a catastrophe. So it's very personal. It's a very human element to it. And now if we want to make progress against reducing some of these significant protection gaps within the region, We have to think about it from the perspective of what can we do to invest in prevention, adaptation, and mitigation? What can we do to actually enable greater insurance penetration? And here it's really about how do we bring insurance into the broader financial inclusion landscape in such a way that we encourage people to actually get coverage for the risks that they face at the individual, family, and business level. And then lastly, what are the different mechanisms that we can bring out that are going to enable better risk transfer? What are the new sort of instruments and models that we can be considering? And so when we talk about protection gaps, unfortunately, and the sign for me was here when only a few people raised your hands, is because people think about it as an insurance issue. It is not an insurance issue. It is an investment issue. And if we're going to actually strengthen resilience in Asia, we have to unlock the investments that need to be made in prevention, mitigation, and adaptation. And so here, the insurance industry can play an important role. We can help to draw attention to these protection gaps. We can help in terms of the different elements that Ernst touched on in his presentation. We can help to maybe de-risk some of the solutions. And hopefully the insurance industry can also play a role as an investor to be able to actually increase the amount of capital that's available to support the investments that are necessary if we're actually going to see a narrowing or reduction of these protection gaps. So I'll stop there, Kathy, and turn it back over to you.
Thank you very much, Connor. Kelvin and Max, having heard, the perspective, from the reinsurers, from Munich Re, and Connor then bringing that to discussion of the protection gap, and highlighting the fact that this is in fact an investment issue, and we collectively need to figure out how to unlock further investment to close those gaps. What additional insights, thoughts do you have from the commercial bank perspective? There's a lot of liquidity in the market, but particularly in Asia and the Pacific, it's challenging markets as well for international commercial capital. I just welcome your thoughts on.
Thanks a lot, Kathy, and thanks Connor and Ernst for kind of teeing this up. I think it's quite clear over the past couple of days that a lot of investments, particularly financing, needs to be mobilized into kind of greening the financial systems and the real economy. I think Connor spoke about climate mitigation and adaptation. I think if you look at any data, whether it's from BNAF or even from ADB, a lot of investments actually have gone into the climate mitigation part of the equation, much less into the climate adaptation side of the equation. And in fact, there's a World Economic Forum report that was published April 23, which is i.e. last month, that actually indicated that a country like Indonesia, as an example, needs at least $10 billion of investments into climate adaptation alone from now to 2030 to get ready for some of these issues that was discussed by Connor and Ernst. But I just want to kind of bring it back to point, if you were, as to how the multilateral development banks can actually assist in crowding in the necessary private capital that's required to actually greenify the financial systems. And I'll break it down into climate mitigation and adaptation. So one clear example in terms of climate mitigation, even though renewables is already mainstream and everybody is investing and financing these assets across the APAC, an institution like ADB still plays a very important role. So I'll give a concrete example in the form of ETM. I think it was mentioned just now that ETM was launched by ADB two kind of COPs ago, and we are actually now working with some of your colleagues for a pilot project in Indonesia that does exactly that. That we recognize that someone like ADB needs to come in and actually do the first transaction and actually seed it and lead the way to crowd in more private sector capital to accelerate the shutdown of coal-fired power plants in Asia. pure and simple. And then after that, ADB can then form vehicles like ETM, funding vehicles, and so on and so forth. The second bucket of it is climate adaptation. Climate adaptation, by definition, the projects are smaller, it's a lot more nascent. It's very hard for international financial institutions to make a commercial case to actually finance each and every single one of these projects. This is where MDBs actually can come in, kind of do the initial investments, and create a portfolio for them to be further kind of liquidated or refinanced in the public and private capital markets. Max?
Yeah, I think absolutely. I think that the role of the MDB, ADB is essential. I think if we go internally to risk, and we highlight to Connor's point where there's trillions of dollars of unprotected risk there, and we need to finance it, we're going to get kind of the door slammed in our face straight away. We're not going to make much progress. But I think to Kelvin's point there, where we have these pilot programs, where we have proof of concept, where we have some risk sharing mechanisms, actually then we can start to actually pull together a proper thesis, something we're able to take to credit, take to risk, and demonstrate how you're actually managing that risk in a responsible way, and how we're actually going to distribute it out and reduce what the potential risk to our book is. So the guarantees, these potential guarantee facilities, can really help us understand the risk, help us provide support for these types of unfunded risks currently, and enable us to crowd in the capital that's actually required to support these the expansion of finance for this space.
Thank you. Yeah, I mean, interesting. And I think as well, you know, Kelvin, you talked about the challenge of adaptation in particular. And, you know, that's obviously something that, you know, we are very conscious of in ADB. Also, mitigation financing, in honesty, is sort of far easier to come by, whether from ourselves or from the private sector. And so I think that collectively we need to think of, again, as you touched on, innovation in the risk-sharing mechanisms, innovation in the products. Asif, we've sort of chatted about this. Perhaps I could invite you to share some of your thoughts on that topic. Thank you.
Thank you, Kathy. It's great to be on this webinar and great to hear from Ernst, Connor, and the other panelists, Kelvin and Max, some of the ideas. I think in terms of just some innovative financing structures and what Kelvin mentioned, first, I'm really happy to hear that he highlighted ADB's ETM for the climate mitigation projects, that clearly blended finance and bringing an ability to bring public and private sector finance together for de-risking certain investments so that private sector capital could be mobilized is a great way, and ETM is an excellent example that ADB initiated. And hopefully through other funds would continue to finance new projects in DMCs. I think I agree with him on the mitigation side, where investment projects are often too small and risky with respect to institutional investors' appetite. And MDBs can perhaps play a bigger role in structuring and pooling projects to address this constraint. There could be public-private risk-sharing mechanisms that can make structures more attractive. But then an important question is what kind of mechanisms to use, whether it should be credit enhancements, co-investments, or specific risk guarantees. While it could be determined based on the investor feedback, but I fully agree that such structures could be very useful. For example, a public co-investor backed by an MDB financing can support and could invest in the equity tranche to improve private sector confidence for a portfolio of loans to, for example, small and medium enterprises, which could be pooled under an ABS structure, or home mortgages that finance energy efficient homes, and it could be structured into green mortgage-backed securities. But what this also requires is development of local capital markets, and I would just quickly highlight some of the work that MDBs can do to support and what ADB has done. So for example, local capital markets are going to be an important element, and this infrastructure to provide a foundation for capital market depth and liquidity and ability to raise and issue such instruments. Well-regulated and liquid local bond markets can lower transaction costs for issuers and investors and facilitate the creation of specialized databases to guide investors through better quality of publicly available information. So MDBs can explore the opportunity to align green, social, and sustainability bonds with local climate transition paths and help sovereign issue on local markets, but also a number of local corporates support their issuances of such bonds. ADB has been issuing sustainability bonds across green, education, gender, health, and water themes, and has completed a total issuance of more than $7.9 billion as of March 2022. We have also supported private sector clients in developing green and social bond frameworks, as well as acted as anchor investors in inaugural issuances. And I'm just highlighting some of these things that this could also be then done by supporting some of the structures that Kelvin and Max has mentioned. And I would also finally mention that climate finance can only flourish if we enhance capacity and strengthen local institutions. Financing is just a part of the solution. We must improve the availability and quality of climate risk data and promote international best practices, such as green finance standards, taxonomies, ESG frameworks, safeguards, and public disclosures. By doing so, we can achieve more accurate market pricing of risks, enable more informed investment decisions, and promote the growth of climate finance. So for example, ADB and the Asian Bond Market Initiative helped rating agencies in Malaysia and Thailand become certified green bond verifiers, boosting the green finance potential of both countries to comply with ICMA's green bond principles. And this really can support now the furthering the capital market developments in those countries. So just wanted to make some of these points to support what panelists have said earlier. Thank you.
Sorry, as if I'm going to jump in there, I was scribbling some notes while you're talking. There are many great points there. But I think one of the key things is this is not a small issue. This is a substantial issue, and there's many capital providers required to support it. Multilaterals are one of them, the lenders, the banks, we're part of it, but also it's the investors. And I think one of the real issues that we're facing are we are inundated with incoming from investors. They want to support coal decarbonisation projects. They want to support adaptation projects, but they just can't find them to align with their portfolio. They have a portfolio, they have a mandate that has to be certain size, it has to be liquid, it has to be a certain credit worthiness, and they're unable to find the projects, the scale to actually be able to invest. And unless we create the instruments that align with those portfolios, then we're never actually going to get to the requisite investment to support them. So I think where we've seen real effectiveness from the multilateral banks is actually where they've been able to build these platforms, kind of work on this thesis of how do you pull together a series of assets, how do you actually then distribute it to those investors, and actually that's how you can get real scale and you can actually get alignment with those investors. There is capital there and waiting, but they want us to be innovative, but they want it to be innovative within the structures that they understand and they recognize. And I think there's absolutely a solution for that. Everything that we're talking about, everything on the innovation side is leveraging prior structures, it's leveraging prior experience, but it's just applying it to new situations which we haven't faced before.
Yeah, just to add on to what Max just said, I think absolutely right. I think if you think about the crowding in of kind of the capital markets, if you will, particularly debt capital markets, I think it's twofold. I think one is scale. So, just even a normal kind of green bond or project bond, the kind of smaller size that for the current market to kind of make it economically feasible for issuers is about $300 million US. And if you kind of think of that number in terms of the scale of climate adaptation type projects that's required, it's just massive, right? So that's first point. And then second point, it's more about risk and credit enhancement tools, right? Which clearly the MDBs have a large role to play in, right? Whether be it to provide kind of credit support or first loss support, and the various structures they were all quite familiar with, to kind of crowd in both the international bank capital as well as the international kind of bond capital into the equation. And then just one last point to add to that as well is, I think increasingly impact investors also have a part to play in terms of being a provider of equity into some of these blended finance type of cases. Thank you.
On that exact point, I think the ETM structures, I think the ETM is a fantastic idea, that there's multiple developments around that and ideas around it, but there's not going to be one singular solution there, and you're going to need several different layers of finances with different requirements from a returns perspective, and they're not just going to be pure economical returns, they're going to be impact returns as well, and we need to kind of find those different linchpins that are going to work together to actually unlock this capital and unlock the benefit and impact that we require.
Yeah, I think that's a really interesting conversation, you know, the different layers in, you know, the capital structure, in the life of, you know, transactions, you know, different slices of the capital coming in at different points in time, and, you know, taking different risks as well, because, you know, impact investors, you know, may come in up front, for example, through, you know, our facilitation, particularly in a blended finance context as well, to, you know, help de-risk transactions up front. And, you know, then you have a different type of investor down at the back end of that transaction. So I think it's a really interesting conversation about, you know, the MDBs helping to catalyze those upfront investments through, you know, all of our usual classic techniques, just applying them, you know, into this, you know, evolving asset class. And then getting a little bit creative about, you know, what we then do with those transactions once we have executed them. And I think, you know, I'm the sort of, we're starting to talk about, you know, the ABS market again here, I think, where, you know, one of the roles that we could think about, you know, as MDBs is the fact that, you know, we have a multiplicity of smaller assets that we can bundle and slice on a cross-jurisdictional basis, on a cross-sector basis, and, you know, bring that back full circle. You know, Ernst and Connor, you know, we all remember the days of, you know, the insurers, you know, wrapping these instruments as well, and
monoliners.
Yeah, and Asif, you know, tying that back into the capital markets development. Also, I mean, to what extent do we think that that's a, you know, potential pathway?
Yeah, maybe in the first instance, I'll add my perspective, and then I'm sure Ernst will have some additional words to add. Now, one of the things that we've come to appreciate within the insurance sector when we think about some of these blended finance instruments is that we have an important role to play in terms of supporting essentially that de-risking element. You know, the insurance industry does have the capabilities, but also I think the ability to put some of the capital at risk to support de-risking. The second thing that I would say is that, you know, when we think about some of the challenges of unlocking insurers' balance sheets as investors in some of these instruments, you know, they encounter many of the same issues that Max and Kelvin touched on. You know, essentially, you know, these are instruments that are, in a lot of contexts, unknown. And so there's a lot of question marks. And insurance companies, I think it's fair to say, are pretty risk adverse. It's in our DNA. And we're not generally going to be first movers. That's not to say that we're not going to be contributors to helping those first movements, but just to say that the expectation that insurers are going to unlock the balance sheets and, you know, provide huge investments to support climate risk financing, it's a little bit hard at the moment to conceptualize that. I think there's a complementary aspect that we have to think about, and this is really on the policy and regulatory side as well. You know, it is very difficult for the insurance industry to look at some of these instruments, recognizing credit quality, various other sort of risks that some of these instruments present, and think about how this works within their overall capital management. And so I think we have to be very well aware of some of the limitations that we have to work through. And some of it is going to be in conjunction working with the regulators and policymakers to hopefully create an environment where there isn't a discouraging factor. I don't want to say a green factor or a brown factor, but really a discouraging factor. Because I think that part of the challenge is really working through some of those processes to make sure that the regulator is, in a supportive way, recognizing that some of these investments, they're different, and they are going to present a new range of risks.
May I jump in here? First of all, I have to start with what Conrad just said. The insurance industry is risk averse. Well, that might sound logic or so, but the reality is that when it comes to climate-related or natural catastrophe in more general terms, our industry has paid out the last years as an annual average more than $100 billion to protect people against the consequences of natural disasters. So that's sort of what the industry, our industry, can do. Another comment on bundling risks and then making them easier investable. That's not necessarily always true. Now, speaking for Munich Re as an institutional investor, we prefer to really see the individual risks in order to put what I had on my slide, a price tag on it. Because when you bundle risk, there's always a chance that you dilute the risk, and by the end of the day, the investor cannot really be 100% sure what he or she is taking on the balance sheet or so. So that's why sort of a balance needs to be found between providing transparency on the individual projects within a bond structure, for instance, and looking at the appetite of the investors. And one word also on the insurance gap, which was also mentioned earlier. So the insurance gap as sort of the difference between the overall economic loss, for instance, from a natural disaster, be it a typhoon or cyclone or flooding or so, and what is insured. What we have observed, and I think that's really of interest to MDBs as well, what we have observed is that in OECD countries, so high-income countries, especially defined under the parameters of the World Bank or so, is that over the last 40, 50 years, and this is since we have been working with this data, this insurance gap has decreased. So currently we have in OECD or high-income countries around 50%, so half of the overall economic losses not insured. Still 50%, but going back to the 1980s, this was 75%. So there has been progress made on both sides, the supply and the demand side. So obviously that has brought economic value to the people. Now looking at the low-income countries, especially at the sort of the poorest or lowest income group of people, it is frustrating, that's my very personal comment, that this gap is still between 95 and 99%. So the result is when it comes to natural disasters, and yes, also supported by our data, we see this increasing frequency, intensity, and increasing economic losses. That's now on the shoulder of the people, of the individuals and businesses and national economies. And I think this is where we need to find solutions together. This is also where I believe MDBs do play a role. The private sector can't do everything. But also sort of part of the sort of a factual view is that when we look at the supply and the demand side, the insurance industry is interested in growing also their portfolio into the developing and emerging countries or so providing more risk transfer solutions. And we rather see a lack of demand, quite frankly. That might sound strange to many of you, but we have been working together with governments in the developing and emerging world on platforms like the Insurance Development Forum with the World Bank and other developing banks. And it's a very, very hard call to get engaged with governments in those countries. And so my message here is sort of we as a private sector and together with the public sector and really in collaboration, we can do much more than we have done in the past. And climate change is an additional stressor and will increase further losses and also on the humanitarian side, and I think so joint efforts are the way to go.
Thank you, Ernst. And yes, I mean, I think we all agree with that. The scale of what we are collectively looking into is far too enormous for any one set of institutions, never mind an individual institution, you know, to be able to even consider going this alone. This all has to be a very collective effort, and you know, creative thinking is needed as well, and I think that everyone is aligned on that. And I think there's some very interesting ideas that we have talked about in this session so far. Asif, I don't know if you wanted to add anything on that topic.
No, thank you, Kathy. I was just going to say, I think if I understood Max and Kelvin's point earlier, where they see MDB's role in terms of development of the pipeline, right? So if I understood you correctly, Max, that the issue really is also identifying these assets, pooling them, and then, of course, just bringing them forward, which is also the case that while there is a lot of discussion in terms of the need for climate finance, but when we look at the pipeline of projects, I think there is a dearth of pipeline of projects. It's very, very difficult to find. And MDBs do play quite a big role in this. So far, a lot of our work has been, at least from an ADB point of view, when we are looking at, and again, me being on the financial institution side, working with banks, identifying, helping them put together the green or sustainability frameworks, identifying assets which could be qualified, working in terms of developing taxonomies, raising and financing them to promote green lending. I think the next step could also be that helping these banks issuing the ABS or the mortgage-backed securities, issuing these sustainability-linked bonds in local capital markets to promote, and then being anchor investors in some of these issuances. So to answer your question, yes, I think MDBs should be playing a bigger role in terms of pooling and bringing some of these investments for institutional investors. And we are currently working on it. It is also a process in terms of for us to learn and our clients to learn so that we are able to put some of these structures together.
Sorry, just to add on to that, and just to be absolutely clear, we're not saying only kind of institutional investors need to be in this game. Obviously, that's a huge pool of capital, but the kind of the bank capital also needs to be mobilized more than just, say, the local banks, but also the international banks, right? And I think, as we all know, the standard kind of project financing type of techniques, which includes credit enhancements on the part of off-takers, FX convertibility, and all the usual nice things that we can have in a 4-point cover, would be relevant in any climate mitigation or adaptation type of project or portfolio of projects, right? So I think just to be clear, when Max and I were kind of talking about it, while we gave the specific example of the bond market, that's not necessarily the only source of capital that we are talking about that the MDBs can actually crowd in.
And just to add to that and stress the point, I think it's the international capital. From the perspective, we don't want the risk getting trapped within a certain geography, within a certain country. It needs to be distributed more broadly. If it gets trapped within the local banks that have the best understanding of the risks, that will inherently create more issues. So it needs to be distributed internationally, and that's why we need the international banks to support here.
Thank you. I think that we could probably carry on talking until quite late into the night on all of these topics and ideas. But I am quite conscious of time. I have a clock in front of me here, but I imagine there may be some questions from the floor, or no? Okay, so we get to carry on chatting, actually, which is fantastic. But I think it is this, it's this interaction of, the classic techniques that you were touching on, and, the classic role of MDBs in these transactions, the halo effect, the 4-point cover, the guarantee products that we can bring, our relationships with, our DMC governments in our case. All come into play, in different ways, and also, in the policy responses. We touched on ETM. We touched in our earlier conversation around, JET-P, which is all, part and parcel of the overall response, obviously. So, additional thoughts in that context, that intersection of, policy, upstream, regulator intervention combined with, capital from, both the MDBs, the private sector, other types of impact and other investors, bringing all of that together.
One thing we haven't touched on thus far, I think, is the regulators. And actually, kind of Ernst's earlier slide on the risk mapping. I think from a bank's perspective, we don't have climate risks fully embedded in the full detail that we should do, and I don't think that there's been adequate data to actually incorporate that into our methodologies yet. We know that if you have a catastrophic event, it's not going to hit Philippines homogeneously. It's going to be different impacts across the islands. There's going to be different impacts to different cities. But at the moment, our models are not sufficient such that we can actually truly reflect that and incorporate that. So I think there needs to be some support from the regulators on developing the information around the risks and how we actually assess that, how we build that into our methodology. That model that Ernst shared earlier, that's phenomenal that you can actually pull that information, but that takes a significant amount of work. It takes a specialist to really work on that and be able to pull that together.
And just to add on to what Max is saying, I think I was just going to say that the role, particularly of the banking regulator, actually does play a huge part in kind of the mobilization of capital. So just take the ETM as an example, right? Since I kind of raised it. I think, there is, as you probably know, many financial institutions around the world have kind of stopped financing coal, full stop, right? Regardless of what it is. But ETM involves coal, right? So that inherently is a kind of a juxtaposition, if you will, of where banks are at. So I think that's where I think the banking regulators across, the financial systems need to kind of think about this sort of thing. And obviously the ASEAN taxonomy for transition of kind of managed coal phase out is a helpful starting point, but I think it needs to go beyond ASEAN and so on and so forth. So that's just one example of how an institution like ADB can actually help.
I think that's a very interesting point. And I mean, this actually brings me back to the question of insurance as well, because, when we talk about coal assets, it's not just banks. Insurance companies don't like to underwrite coal risk anymore either. So I think there's all sorts of challenges that we need to consider in both a commercial and a regulatory context if we are going to succeed in the transition work that we're all looking to do.
Absolutely. So we, just like many others in our industry, have started also to decarbonizing our liabilities. So actually we do it on both sides of the balance sheet, the assets and the liabilities. But what indeed would be helpful is to have clear taxonomies, what can be defined. So beyond the coal is the obvious, and then perhaps followed by oil and gas and other fossil fuels or so. But with a clear taxonomy or so, we can report on these numbers. The numbers can be audited, and that, I think, creates a strong momentum and transparency for all of our investors, and I think for the entire society. So calling to some extent for regulation, which sometimes sounds strange, as an industry calling to be more regulated or so, but I think we need this guidance, put it this way or so. We need this guidance. We need to be clear what is sort of wanted and supported by policy action, and what is sort of out of scope. And that will drive the change much, much faster than we have seen it before. We do have such discussions in some countries, and coming from Germany or so, we currently do have a very extended discussion about our heating systems and decarbonizing the heating systems. And I think it's a pity that we have it at such a late time within this process of decarbonizing. I mean, we are in the year 2023 now. The German target is being carbon neutral or net zero by 2045. So, and then the consequences, we see some sort of disruptive discussions or policy actions. It's still not a hard regulation in Germany. So that's what we need to avoid. So the earlier we see this guidance and taxonomies, I think the better it is to be prepared and to have a smooth transition rather than this sort of jump changes, which are not good.
Yeah, and maybe I could just add a couple of observations. So in the conversations that we've been having with a lot of our insurance company partners, I think that there's a recognition that the easy part's been done with a lot of insurance companies. They've transitioned a lot of their investment portfolios towards more of a net zero portfolio. There's a lot of talk at the moment about net zero underwriting. Conceptually, yes, it's an important consideration in terms of hopefully providing those additional nudges that will move us along the transition pathway. But ultimately, unfortunately, I don't think it's the most powerful lever that's at the hands of the insurance industry. I think that one of the things that's become apparent to me in the conversations that we've been having is that there's very powerful tools that come from very powerful inputs that come from the insurance industry that I don't think we've done a good enough job of exploring how exactly banks, other investors can take those inputs and actually use them in a meaningful way. And here specifically thinking about some of the price signals that the insurance industry can send. And these price signals are very powerful. But I don't think if you were to talk to a lot of bankers, many of them actually spend much time thinking about them. And I'll give you an example. So I'm from Vancouver. It's a nice place. It's a beautiful place. The problem is it's also on an earthquake zone, much like a lot of Asia. Increasingly, the insurance industry has been pulling back from providing earthquake coverage within Vancouver. And while it's a very small example, we haven't had a big earthquake in Vancouver in over 300 years, apparently, if you look at some of the geological records. And apparently we're due for one. Now, the question mark for me is, okay, so what happens if we have one? Well, it's going to be pretty catastrophic. And ultimately, I'm not sure that any of the lending institutions that have been financing Vancouver's really exceptional economic growth and development have been taking those price signals into account in terms of the credit decisions that they're making and the investment decisions that they're making. Because the insurance industry is very clear, this is a big risk, and it's not one that we're jumping at. Not to say that, as Ernst said, the industry is not looking to grow, but there are certain risks where they're starting to say, we need to pull back from this because the risk is too big. The consequence is too catastrophic.
Thank you, Connor. Asif, any final thoughts from you on this discussion? I saw you writing notes. I think that we've got plenty to talk about later.
No, thank you, Kathy. I was just listening to, and I also fully agree that it is important, and the role of central banks is very, very important in terms of just helping build national level transition finance frameworks, which would then support financial institutions. And MDBs can play a very important role. We as ADB are working with a number of central banks across our member countries to help develop some of these frameworks, including taxonomies, disclosure standards, even as I mentioned earlier, climate finance products and incentives that even from a prudential requirements point of view, that central banks can provide for transition finance. So I totally fully agree with you on that, and that's important for us to promote private sector climate finance in our market. Thank you.
Thank you, Asif. We have a question from the floor, and thank you for your question, which is how can the guarantee mechanism of MDBs, I guess you're bringing it back to the classic MDB techniques, right? How can the guarantee mechanism of MDBs be enhanced or made more powerful and material in financing, and what needs to be done for that? Max or Kelvin, what from a commercial bank perspective would make our guarantee product better for you? If anything, it may be perfect, which is also absolutely fine as an answer.
I can start at the most basic, and then Kelvin, if you want to jump in. I think from my perception, it's the level of the guarantee. Kind of a 95 versus 100% guarantee is, again, it's the door opener, it's the initial conversation. If it's 100% guarantee, it's a lot quicker conversation. It allows us to mobilize a lot more rapidly, whereas 95%, that 5% of remaining risk, it remains a huge risk. And even though it's still a very, very small proportion, it gets a lot of focus. So that 5% difference does make a huge amount of impact from a risk perspective.
I think from my perspective, I think if you can start thinking about sub-sovereigns as well, because that would be quite useful. I mean, particularly if you think about it, not just from a broader climate mitigation and adaptation point of view, be it sanitation, be it waste, be it kind of other related projects, they often deal with the sub-sovereigns more than just the federal or central government. So I think that's probably something that could help, actually.
Okay, thank you, and thank you for the question. Are there any other follow-up or additional questions from the floor from anybody before we close? Very good. So I'm very conscious that it is now 5:30. I would like to thank Ernst and Max and Kelvin, Connor and Asif for your inputs and contributions to what I think has been a really interesting conversation this afternoon. I hope that it has been equally an interesting conclusion to the overall sessions that you've taken part in. And thank you very much for your attention and participation.
All good things must come to an end. After 2 days of very interesting discussions, very thought-provoking questions, most of the questions remained unanswered possibly, but you have all asked the right questions, and we have to all work together in terms of finding the right answers. May I like to now invite the Senior Director, Designate Finance Sector Office, Christine Engstrom, to finalize this session by providing her closing remarks. Thank you so much, Christine.
I was just thanking Arup for not embellishing my title as Junkie has done earlier throughout this conference. So good afternoon, everyone, and thank you so much for your attention, and thank you for the great panels that we had today. It's been a really excellent conference, and I've really appreciated everyone's participation here in Manila, which has been great to see you all, and then online. So now's the part where I do the tour de monde of the conference, but it's going to be super short. because over the last 2 days, I think that we've shared many interesting ideas and innovative approaches to greening our financial systems, as well as discussing the key critical issues around climate change and the financial sector. We've heard about how green investment banks in the US and the UK have provided interesting and targeted solutions to scaling up green financing and then catalyzing the private sector. And then just thinking about taking a step back and thinking about, okay, how does that really apply to our own emerging market context? What can we use from these different models as well too? And why were they successful in these countries, and why in some of the other instances that we've had other specialized banks and non-banks, why haven't they been successful? So a lot of good, interesting, I think, ideas to think about. But also critically in terms of kind of the private sector, the real role there of the private sector. And I think the last panel was very good. And thank you, Kathy, and the panelists for doing this and having a really good discussion about actually, how can the private sector leverage what the MDBs can offer? What can we offer more to help the private sector from a whole wide range of products, as well as then with the regulatory environment as well too. So really important topics there that were discussed. And thank you also, Connell, for educating us on the protection gaps in the insurance industry, and a really good discussion also about what the insurance industry can do and some of the limitations there, but also how we can leverage the work that they're doing to bring to the climate change solutions. Importantly, and I know that a lot of people here represent the supervisory and regulatory authorities, and thank you so much for making the time to travel here. This is a key critical issue for us in terms of how you can help the financial institutions gain the resources that are needed to assess and operate and prepare for climate risks. You play an important role in enabling the financial institutions which are indispensable to achieving our region's ambitious climate change goals. Without well-designed policy frameworks, as you know, it will be very difficult for us to address some of these challenges going forward. I think also, one of the things that we talked about earlier was the role that the supervisors and regulators make in terms of ensuring now that the financial institutions themselves are adequately assessing and managing exposure to climate risk. And I was pretty surprised about EBRD's survey. And definitely some of those statistics would keep us all up at night as well too. It just shows you the long road that we have in terms of really raising awareness in the financial institutions and helping them mitigate these risks as well too. In terms of the international supervisory bodies that we've talked about today and yesterday as well too, they have a very important role in recommending setting supervisory expectations for financial institutions. These recommendations, as we've heard in detail during some of the presentations, cover governance, strategy and framework, risk management, scenario analyses, stress testing and disclosure in financial institutions of climate risks. Last but certainly not least, I know that you've heard on a few occasions about what ADB is doing and our role in the climate finance and our ambitions as well too, and really appreciate the other MDBs that were here as well too to join us in this discussion. But talking about what we do on the supervisory end of it, the policy discussions as well too, but importantly, how can we shift and use the products that we have and possibly tailor them to create more bankable projects and stronger environments and capital markets to leverage the private sector. So I think that's a really important discussion that we've had today as well too. And this is of course alongside ADB's traditional financing role in which we've been providing long-term finance to green projects and increasingly more so through a wide variety of different sectors as well as financial institutions. So in closing, I just wanted to say this conference has really provided us an opportunity, and I'm grateful to have participated, to exchange the ideas and perspectives that are really important to climate change going forward. These issues are really complex, but the finance sector has a critical role in driving change and in helping us create innovative solutions to address these climate solutions. As we see here today by the breadth of the conversations as well as the breadth of the attendance here as well too, it really requires multiple people in terms of governments, multilateral development banks and IFIs and the private sector to work together to come to solutions. I think that conferences like this are really important to broaden our dialogue and learn from each other to efficiently and effectively accelerate greening our financial sectors. So I have no grand comments at the end, but just to underscore that I really appreciate all of your attendance here. our special speakers and panelists, as well as our great organizers. And again, I think that we hope to see you next year, possibly, and have more discussions along this. I think it really helps to advance our ideas and knowledge about this critical issue. So I will close with this, and thank you all very much, and safe travels on your way home. Thank you again.
All right, we officially called it a day. Okay, yeah. Thank you so very much. Okay, but don't forget we remain connected. Okay, yeah.